I remember ago we had so many homes we didn't know what to do with them. Now you can't find a home and everything's multiple bids. By the way, let's just talk about what's driving it. Rent. The rents are going up. So you have rents going up. You have people who want a second home because everybody's the CEOs have capitulated. I think there's a great piece to be had about CEO capitulation. I think almost every CEO expected by this point that people will come back. They didn't expect that there would be, hey, you know what, Chief, I'm not coming back. We have a situation, a bizarre situation, where people who are 26 to 32 are telling their CEOs, I mean, I remember when I was at Goldman, the idea of even talking to a CEO and not be like trepid, like nervous, like you wanted to, like, oh my God. And it's like, oh, can I work here like even more hours? Now it's like, yo, pal. Yep. I'm staying home. Not only that, I like Fridays. I don't want to. I mean, before it was like, hey, I'm not going to dress well on Fridays. Now it's like, see you later, partner. Right. I'm surfing.
Yep. Well, we know who has the leverage, which is why Bostic this morning. Labor market continues to be tight, and that has huge implications, obviously, for the Fed, which we'll talk about.
I just think people don't understand when you speak to the CEOs offline. They're like, wow, how did this happen to us? Online, they're like, you know what? Yeah, it's great that these people don't come in. But it's great. You rule. You used to rule. Now you're cartoon rulers. You're emperors with no clothes. I mean, I was talking to a CEO last week who was saying, publicly, it's really great that people have freedom. And then probably says, who are the people who work for me? I don't know them. Like, what are they doing?
Yeah.
Are they having fun?
We will see if that turns. This is Bostic this morning talking about the labor cycle and how inflation, getting it under control, is still the #1 priority for the Fed. Then there's Boeing, as we said, dragging Dow futures lower. This 737-800 jet crashes in southern China with 132 people on board. Our Phil LeBeau joins us this morning with the little that we know as of now. Good morning, Phil.
Very little is what we know right now, Carl. Good morning. I've talked with a couple of flight crash investigators this morning, and I said, look, based on what you've seen so far of what we know about this plane before it crashed, what do you think? Both of them said the same thing. This is a real head-scratcher. This China Eastern 737-800 had 132 people on board, 123 passengers, 9 crew members, and it was powered by CFM56 engines. Those CFM56 engines, that's a workhorse when it comes to commercial aviation. They're built by Safran and GE in a joint venture. Very strong safety record. And by the way, the 737-800 also has a very strong track record. It is not the MAX. It's important to point that out. This was not a 737 MAX. As you take a look at shares of GE as well as Spirit Aerosystems, major contributors to the 737. Remember that investigators still need to get in there. They still need to get the flight data recorder as well as the cockpit voice recorder. That will hold a lot of clues if they can retrieve them and what those two devices tell investigators about why this plane at just under 30,000 feet all of a sudden it went down very quickly. Rapid descent. No indication of a mayday call from the pilots. No indication of some catastrophic failure. Electrical power was working as it went down. So all of those together have investigators saying, okay, what happened here? Was it cockpit confusion? Was there something else that caused this plane to crash? I suspect that once we get a few more days under our belt, we'll get a little bit more information, because based on just what we have right now, guys, this is in fact one of those crashes where you sit there and say, planes almost never just fall out of the sky. The majority of plane crashes happen on takeoff and landing. That's the trickiest part, if you will, in commercial aviation. So again, more questions than answers about this crash of a 737-800 in Southeast China.
Well, I have to, this is one where I find, Phil, right now that Boeing is under the gun with 737, but also 787. Yep. I just feel like that maybe there's just a belief developing in the marketplace that whatever Boeing does, I want to own another stock. And maybe not. Totally unfair, Phil, given their long-term record?
Yeah, I think that is unfair, Jim, and here's the reason why. And especially having covered a number of airplane crashes, the knee-jerk reaction, it may take several months, but at some point, a cause is found for a particular crash, and it may be a component. It may not be something related to something that Boeing manufactured. It may be because of cockpit confusion. We had the Lufthansa crash, which was pilot suicide. There's so many factors that are out there that 99% of the time, Jim, the knee-jerk reaction of sell Boeing, there was a crash, over time, that's never borne out. And I think that to say, hey, look, these guys are snake bit, here's another crash, I think it's premature.
We'll wait for more information. This is obviously something we're going to tread lightly on until we get some confirmation on, as you say, the way the investigation is going to go. Phil LeBeau, thanks. When we come back this morning, Buffett back on the acquisition trail as Berkshire strikes an $11.6 billion deal. Also, Anaplan surging on a deal of its own. Got some other M&A news out of Nielsen and GM Cruise. Take a look at futures. We do have the indices looking to open in the red, although the VIX still below 25. More Squawk on the Street continues after a break. Got some M&A news this morning. Warren Buffett's Berkshire Hathaway agreeing to acquire Allegheny for more than $848 a share, $11.6 billion in cash, already adding to its large insurance holdings, including Geico and General Re. Meantime, software maker Anaplan surging in the pre-market after agreeing to be taken private by Thoma Bravo in a $10.7 billion deal. This is Buffett's biggest deal since Precision Castparts.
Well, it does matter because what's happened is that we've been very concerned about this new FTC, new antitrust department of the part of justice, and we think, well, you know what, maybe M&A's over. But this kind of under-the-radar screen deal, I think, passes. And by the way, Anaplan's very interesting because a big money loser. Frank Calderoni, fantastic guy. Company is lost money, but does have a product people like in enterprise. And Anaplan is the outlier. But those are the companies that have been sold off dramatically. Thoma Bravo sees value, makes me start thinking, okay, all the ones that people have given up on, let's take another closer look that maybe they've got something. Frank's program, by the way, at Antiplane is one that many people use. I know I suggested to a company that they ought to look at it, and they were like, no, it's too expensive. And then they proceeded to do it themselves and had no idea what they were doing.
What about this discussion this morning that Buffett's sort of going back to his roots? And does that, I don't know, in people's perception at least, close doors to maybe going after deals that would be outside of his comfort zone?
Great question. Look, I think the insurance business is a terrific business if you know how to do it. And there are plenty of insurers. There hasn't been a deal in a long time in insurance. Like, look, is he going to be able to buy another company that's a railroad? No, they're going to block that. Anything railroad, they'll block. Pipeline, maybe. Pipelines are cheap still. That could be a place where he doubles down on. That wouldn't surprise me at all. But those are the ones that I think you can buy as insurance and pipeline.
Some also say that this deal, because it's run by a man who ran General Re in the early 2000s, maybe the succession thing has a new wrinkle.
That would be quite a move. I know that I always thought General Re was poorly run until Buffett bought it. Letter Y. I mean, I first saw it, I said, geez, maybe they're buying Allegheny to go with precision cast parts because Allegheny has titanium. But then Allegheny's titanium, that's the that's the ATI kind. Yeah. They have a bad problem with Russian titanium. Russia's got all
the other issue, and I'm sure you guys talked about Berkshire hitting all-time highs last week.
Yes.
Typically not something you see when the macro's about to collapse.
Very true. The railroads have been incredibly strong. The pipelines have come back rather dramatically. The portfolio itself has had a bunch of, American Express is doing well, Coca-Cola is doing well. But then let's talk about the non-elephant in the room, which is Apple. And Apple had Shenzhen come back online. The stock fell 10 on Shenzhen. It's going to go up. There's a lot. Tony Saganegi, good to see him back on. He was talking very positively about the amount of money they can bring in from, let's just say ancillary products. MoffettNathanson had a big piece today about how that the shift of advertising is going Apple's way. I think Apple remains a great own. Don't sell.
Yeah.
No changes for me on that one.
I think JPM this morning reiterates an overweight. And as you said, Foxconn, interesting too, because you got Shanghai Disney closing until further notice, right, where Shanghai's got some problems, but Foxconn resuming what they call normal operations in Shenzhen, which is ostensibly good news.
China is very difficult to figure out. When I listen to to Dr. Gottlieb, I kind of think, well, do they just have the wrong vaccines over there? And because whenever you go anywhere on vacation other than New York, I mean, it's like you wear a mask, it's a complete outlier, except for maybe California. I just think that we can't get to the bottom of anything China right now, whether it be whether they're supporting Putin or what they're doing in terms of healthcare. We have no idea but a lot of people want to come on and claim it.
Yeah.
Good luck.
Yeah. Well, maybe we'll take a listen to what Gottlieb said this morning about BA2 and whether or not we need to be concerned from here on out.
I immediately called my doctor and said, all right, let's get the next one over with. Let's just have it, whatever.
When we come back, Kramer's Mad Dash, countdown to the opening bell on this Monday. Busy week ahead. Don't go anywhere. Time for Kramer's Mad Dash as we count down to the opening bell, watching Air Products today, Jim.
We haven't had just a lot of straight company news. Air Products has got a business coming on in Saudi Arabia. Now, Air Products is one of these companies that has been hurt. Look at this. This is cyclical decline because people feel the economy's slowing all over the globe. This is J.P. Morgan just saying, look, let's not forget, large-scale product going to be very good for industrial gases. Why I like this is because the industrials have really worn, whether it be Deere or Caterpillar or Ingersoll, except for Illinois Tool Works, Eaton, people have kind of said, you know what, the world is slowing. And what this says is, wait a second, before you throw out all companies, some companies are doing the right thing. And I just want to remind people that the economies worldwide are not on the decline, but that if you're involved with something that is directly invaded with Russia, then there are issues.
Right.
Or if you're a big buyer of anything aluminum.
Sure. Does that extend, though, to companies, industrials exposed to Europe, for example?
Yeah. Industrials exposed to Europe are, it's very unclear, although Deutsche Bank was recommended today, and so was Santander, betting that the economies are going to strengthen there. My problem is just simply what happens if they turn off the gas in Russia? What happens? And the cost of energy there is sky high. We forget how cheap our energy is. But I just felt like this is one of those. By the way, this does well because it's the Saudi Arabia energy, very inexpensive.
Yeah, I think it was over the weekend, EU tried to pivot to some supply out of Qatar. And then, of course, this morning, the Russians try to argue good luck, at least for now.
I know. Look, the main thing, the longer-term thing would be able to get the pipeline out of the Mediterranean where Israel's Leviathan field and take that to Europe. That would be the best way. That's a Chevron product. I know Chevron has a strike going on in California, but Mike Wirth is a visionary, the CEO, and that's the way to get that. That's the biggest natural gas field in the world, but you got to go through Turkey. There are geopolitical reasons, but boy, it would be the answer.
Yeah. Also, some reports that we might see some oil executives at the White House. Maybe today.
And maybe Congress.
Yep. I think Reuters said Marathon may show. Maybe.
Right. Well, I just think that when Congress holds its hearings, then you're always worried about windfall taxes in the days of Jimmy Carter.
Yeah.
But I think you buy them on this because in the end, they got great demand.
All right, we'll take a look at that, and we'll get the opening bell in just under 5 minutes. Don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast. Back in a moment.
The near-term risk right now is just this continued uptick in cases as we lift the mitigation, people interact more, and as B2, which is a strain that's more contagious, becomes more prevalent. B2 is 30 to 50% more contagious. So people who've so far escaped Omicron, some percentage of them are going to be infected from this mini wave of infection. But this is unlikely to be a major surge of infection based on what we're seeing in Europe right now. We're likely to see an uptick from where we are right now, but we're at very low levels. And I don't think that's going to be enough to change the policy prescription at this point.
Dr. Scott Gottlieb on Squawk earlier this morning talking about the latest uptick in COVID cases, sounding, I would argue, net bullish. Jim said maybe you get an extension of the mask requirement on transportation, but no huge policy shift.
But he did say that there is a limit to the vaccination strength. And I also got the sense he's just saying, hey, get used to this. This is a new regime. And you have to get the shot, you have to get the shot. I mean, it's kind of like the flu shot. You get the flu shot, you cut the risk. But I know I went to my doctor immediately and said, okay, doc, and he's the guy who's the CBS doc, Dr. LaPoop. And I said, okay, what do you want me to do? Now, we don't have enough data. Now, it's interesting. He said that he spoke with the head of the CDC. It was on Dr. Walensky. She is not allowed to get all the data. The states are allowed to say, no, I'm not giving the data. So that's why we've been relying on Israeli data. I'd rather rely on United States data, but we can't get it.
Yeah. Interesting conversation. You know, Hong Kong is cutting some quarantine time. The question is whether or not these lighter requirements are inflation-friendly or inflation-unfriendly, right?
Look, I think Jay Powell said stuff last week where when I have Stiefel on tonight, a good bank, and they said, a few months ago, they said, listen, we're going to get 3 rate hikes. And now it's 7. So, I mean, what's happened is that Jay Powell has said to his critics, all right, I'll give you the 7, darn it, if it's bad. And that was very positive. Because what it said was he'll preserve, well, I said this on air, I said he'll preserve the ability to be able to keep prices from continually going up.
Yep.
And I immediately got blowback saying, listen, you want to hurt the working person. No. I mean, at this point, everyone is, the working person goes to the supermarket and flank steaks double. And that's the working person.
Yep, yep.
The working person is tired of paying much more at the supermarket and wants to try to figure out why that is. And I think, look, if you slow the economy like Jay Powell does, then a lot of things work better. I really believe that.
I don't know. We'll find out. I think he will take some questions later on today at NABE. Larry Summers, once again on Twitter, saying, good luck catching inflation. You're going to wind up with Fed funds between 4 and 5. You're going to crack the economy.
I really liked Larry Summers when he was the head of Harvard.
And since then?
Good president.
No comment.
Good president. I gave money.
Yeah, we'll see. I mean, Goldman, Jim, this morning, reiterating a call for 7 hikes this year and then 5 more next year.
Yeah, Goldman and then Wilson. I mean, these guys, you got to take away your shoelaces and your ties when you read these analysts. I mean, they're so negative. Well, Costa's not, well, no Costa's in there. I just think that what we saw last week, all these very smart people are saying, was a bear spike. And I come back and say, well, wait a second. There was good news Google. There was good news Apple. We got some pretty good news about Microsoft. We got some very positive news about Amazon and Amazon Web Services doing quite well. We got some takeovers. I mean, can we just admit that some things with companies are doing better? But these guys never look at companies. They've got, they're up here.
Right.
I'm down here, okay? They're like the generals in Paths of Glory, if you remember that. I liked this great movie, Kubrick. They have, no idea what Kirk Douglas
Colonel
is doing.
Dax! You're coming to the quick!
How about when Ralph Meeker, when they kill the cockroaches, now you got the edge on them. I just feel like they're very out of sync with what's really going on. And there's a lot of people, by the way, who are just endlessly negative on the autos. But when I spent some time with Mary Barra, she is making it so that Cruise is major. And then she bought for a song SoftBank's part of it. Now they own 80%. Again, people say, well, that's negative. And why is that negative? I think there's a lot of people who, like I do, have to fight the negativity, what's going on in the headlines in Ukraine.
Yeah, well,
it just really hurts.
Ford and GM, they're in the red. This morning, Adam Jonas over at Morgan Stanley does cut estimates. He takes GM to 50. He was at 55. Doesn't change the target on Ford, but reiterates the underweight. He's talking supply disruption and potential demand destruction, and thinks that the EV valuations, in the case of GM, need to be cut nearly by half.
you know, I hesitate to put this out there, but Farley doesn't share that view. Now, he is only the CEO of Ford, so, you know, maybe I should be going to someone at a lower level at Ford. But, you know, he doesn't share that negative view, and I think he's more in control of the situation than Jonas, who writes every day. I mean, I gotta tell you, Jonas, I mean, like, I write a lot. But, you know, there's Stephen King and there's Jonas. And they just can really put the... I mean, I don't know whose book is going to come out first.
Adam is prolific.
Billy Summers was very good, by the way. And I think he just dashed it. So I love Stephen King. Okay, Stephen King writes more than Jonas. So therefore, if Stephen King says he doesn't like Ford, I'm going to dislike Ford. But Jonas can't write this much. He's got to... That man has the antithesis of writer's block. I mean, I mean, you know, there is like something to be said that maybe you kind of like, you know, maybe like talk to some of those people
scarcity,
there.
really.
I sent Mary Barra a text, congratulations on it. Again, I felt compelled to go to Mary Barra. I can't help myself. I keep feeling that if I speak to the CEOs, I have a better line than Jonas, and maybe Jonas has it. But I mean, I want Jonas. Here's my advice to Jonas. Duke looked good yesterday. I like Nova. He's got to spend more time watching NCAA basketball, March Madness.
Really?
And take a break.
Take a break.
Yeah, he's got to take a break. It's just not fair to him.
We'll see how the stocks react to his note, but it's worth reading today. Energy, Jim, is going to lead us
Always.
up 2%. Is that a comment on global growth, or is this about
I just think
Houthi rebels in Saudi Arabia?
Yeah, the price was up big, and you know, I think that every time you get some negative news, oil goes up. I love oil. I think that the oil stocks are terrific. Ever since they got the religion that came from Devon, when Rick Moncrief said, you know what, we're not going to drill. I had him on for the investing club. And I said, oh, come on, please. 109, come on. He goes, look, by next year at this time is when the oil will come on if I drill a lot. Although I saw Diamondbacks doing it, but it's not new. It was in the Journal today. He said, I'm not going to play that game. The forward curve indicates that it's too high. I just want to make money for shareholders. Mike Wirth, on the other hand, has got a little more ecumenical view. It feels like some places are worth drilling. But I do think that and now my chapter owns Halliburton. I took a lot of heat last week saying, how could you own a company that is so in bed with Russia? Well, guess what?
Yep.
They're out of bed with Russia.
Yep.
So I think Halliburton's good, and I really, really like the like Pioneer, Conoco. These companies are they're like the old days when they're just making a ton of money for you. I'm like the old days, meaning that you used to buy Exxon for the yield. I think Pioneer, Scott Sheffield, is another brilliant man. The guys you deal with in the oil business, and again, I insist on talking to CEOs. This is my predilection. They're coining money, and it's not going away, and you should own these stocks. Yes, you should own Pioneer. Yes, Scott Sheffield's going to do a good job for you.
It's been pretty incredible. Oil, by the way, Bespoke pointed out on Friday, has traded at its all-time low and within a stone's throw of its all-time high within the past 2 years.
Well, I think that throws off all the analysts who are just hoping for calm. You're not going to get calm. By the way, we're seeing some very interesting action in the retailers, which a lot of people have given up on. You know, and yet, I had Williams-Sonoma last week. Oh, my. Laura Alba was telling the greatest story. I look at Lowe's. These are companies... By the way, let's remember this. We're going now into the spring selling season, and that's when the gardens are done. And then I also look at some of these side of the railroads. There's some areas of the economy are so strong that I just hesitate to be as negative as so many of the analysts are.
Yeah. Kohl's out with some comments this morning about the chase for them.
Jeez, Kohl's. I mean, geez, there's so many companies that want them. I don't know what to say about this one. I don't think they're going to give up. So many different. Remember, all this started with Macellum, with John Duskin putting him in play, and John Duskin there's some irony. He's behind the Bed Bath & Beyond conversion with Mark Tritton, and then Ryan Cohen, who's backed by a powerful force, right. The Apes, is in there agitating. I love the fact that the Apes attacked my late mother today, because in terms of like. I don't even think that's 52-week low. That could be like a 50-year low since my mom passed away, almost 40 years ago. But they attacked her, and I like that because it shows me exactly how distinguished and thoughtful they are.
That is terrible, Jim.
Yeah.
Speaking of the consumer, we do get Nike tonight, which has all kinds of riddles within it. China not with just one of them.
I'm going to spend the night studying Nike because the conference call is so insightful. There were people covering their short very aggressively today and Friday, and I think that Nike has surprised. The problem with this quarter is China. Do we have anything? I don't know. I think that I never want to bet against Nike, but at the same time, obviously, you got a big market over there in China.
Yeah. By the way, we mentioned the Boeing story at the top of the hour. Boeing, at this point, will be subtracting about 60 points off of the Dow, which is managing to open and hold some early positive gains here.
Well, look, I was surprised. I saw Boeing down 11 when I got up and kind of hanging in there. I think that's because people, when they found out it wasn't a MAX, felt better. I mean, before the MAX, we used to not presume that it was a Boeing problem. It's really quite interesting.
Yep.
We used to presume that the pilot error, or maybe something involving terrorism. But because of the 2 MAX planes, we immediately presumed that something happened.
Something engineering related.
Yeah, and I'm not sure that's the right way to be.
Chinese state media did say that President Xi was, quote, shocked at the crash, which makes you wonder how China will view this in terms of their regulatory structure regarding Boeing. They just cleared the MAX for service.
They do need planes. I think, I defer entirely to Phil, who said we don't know enough yet. I was hoping that Boeing, which my childhood testimony has been, it's been a trial, that this would be the week where China would show, you know what, we are not against you. We may be okay with Russia. I mean, I don't know what our country wants. Do they want us to say we are on board in making it so that Russia should roll back Ukraine? Because both Russia and China are trying to weaken us. I mean, Russia suddenly is against us, but China.
I mean, Reuters has a piece out today arguing that when it comes to China, or at least China trade, they're being asked to choose between Russia and the West, and that China trade's going to side with the West.
25% of their exports go to Europe. Anyone who's spent a lot of time in Europe knows that China has spent a tremendous amount of money
EU's
there.
largest trading partner.
Right. I mean, when you go to Italy, by the way, is Russia's largest, and they're China's largest. And Italy is a Belt and Road country, which is the Chinese initiative. And it would be surprising if the Chinese just said, you know what, we spent all this money, but forget it. We're going to go with Russia. Russia does have energy and some rare minerals. Titanium they have aluminum, obviously. But yeah, I just think the idea that China's going to wake up and just say, you know what, President Biden, we're with you. That's just not going to happen.
In terms of the curve and rates, Jim, we got 5 10s inverting, 3 10s inverting, 2 10s down to some, I'd say, 20 basis points as we keep our eye on the banks, Jim, and how they're going to trade in this environment.
Yeah, I do think that the banks' bad loans remain, there's just nil. And the banks can make a little extra money. But I just want to be sure there are issues like oligarchs and who do they have their money with. Issues like the idea that that the economy is going to slow because when you put through all these rate increases, I mean, Powell means business. A slowing economy versus good loan growth, eventually the slowing economy wins.
Yeah. Although some argued this morning, I think it was Nat Alliance said maybe Powell talks like Volcker, but acts like Burns, right?
Yeah.
Tries to do a little of both.
Look, I think that Powell is hoping that there be, maybe Powell read the Lennar conference call and just says, you know what, lumber has to come down. Or maybe he's talked to Ford and realizes that nickel has to come down in order to do electric cars, or lithium has to come down. And these are all things that aren't really under his control. I mean, but he can slow housing. He can slow autos. Your number that you gave about what's left in housing, we got to slow that market.
Yeah, we're underhoused.
And houses, the affordability of a house is really being called into question.
Yeah. Especially for first-timers.
Oh, jeez, it's so expensive.
Yeah. Let's get to Bob Pisani as we're at 24 points in the red this morning. Hey, Bob.
Yeah, and Carl, this is actually a very impressive open. The S&P up almost 0.4%. Boeing is weighing on the Dow. It's costing the Dow about 70 points. But considering the wild week we had, we're up 6%. No profit taking after that. I think this is a pretty impressive open. Let's take a look at the sectors that are moving. Energy, which had a down week, oil at 107. No surprise, energy is moving on the upside. Material stocks also up. Banks, a slightly steeper yield curve. They're doing a little bit better. Industrial's a little flatter. Some of the airlines are weak, obviously. Boeing weak as well. In terms of commodity stocks, we got some new highs, actually. Mosaic set a new high. That's been a huge story. Of course, components and fertilizer for their new high there. We're seeing new highs in some of the other commodity stocks. Nucor's at a new high. Not quite in some of the oil names, though, but, you know, Marathon, Occidental, all the usual high beta energy stocks also moving to the upside. The big question, of course, is what's going on? I mean, why did we have such a strong move off of the bottom? Remember, I just want to recap the wild week we had. The S&P was up 6%. The financials were up almost 7%. Tech was up more than 7%. Energy had a down week, down about 5%. But the important thing is, why is the market that was so weak a week and a half ago and everybody was worried about now so strong? What happened? I think what's happening is the market is betting the Fed will raise enough to cool inflation a little bit. People are making a bet here. So the big market issues are, has the market priced in enough Fed tightening? And what is going on there? How far can you hike rates when and if the economy starts to slow? Remember, the rally started at the Powell presser. That's when he pushed off the recession concerns and talked about the stronger economy. So how many companies still have pricing power? These are all issues for the market, but, you know, they're making certain assumptions here that are very different than a week and a half ago. There's still that whole TINA thing. There's no alternative out there to stocks. Raymond James had a note out this morning, some of the analysts over there, saying today the global investment outlook remains a choice between equities with pricing power and a reasonably strong earnings trend or bonds with substantially negative real yields. So far, investors have chosen equities rather than to capitulate into cash or short-term bonds. That's a good summary of things. So we'll keep an eye on that. But just remember, we were in pretty negative mood exactly 1 week ago, and now we're not. And I think the Fed is the main driver here. Big day for Gary Gensler and the SEC. He is releasing later today details of a long-awaited proposed rule series on climate change. And there's a lot of questions. They're going to release the information at 11 o'clock, so we don't know what's in this. But he's given speeches on this before, and he's sort of told us what he's looking for already. So it's likely he's going to require mandatory disclosure of any material risks. That's a big word, material, like risks posed by hurricanes or floods or droughts, things like that. Can they back up their claims? Gensler has been very critical of companies before, claiming to be, say, net zero in their greenhouse gas emissions, but don't provide any details. He's going to say, you got to back up your claims and say what you're doing. And he's been very critical of companies, investment funds that say they're green or low carbon, but are very fuzzy about what criteria they're using. He's going to ask for more information and more data on these funds. He said that before. This is part of one of the most ambitious regulatory agendas I have seen in decades. I've been covering the SEC for 25 years. There are 50 proposed regulations, potential regulations on the agenda list. That's pretty ambitious. And, Carl, we're going to have SEC Chair Gary Gensler on Power Lunch, 2:15 today. Mr. Gensler will be talking, of course, about climate change, but also that very ambitious regulatory agenda that he's got. A lot to talk to with Mr. Gensler about. 2:15 today.
Wow, Bob, great summary. I think that Gensler may call for an audit. May say that you have to have, say, an EY come in and say, and audit you, because no more, hey, I'm green. How about we have a standard? It wouldn't surprise me if he demands a standard. His staff doesn't have enough to be able to do it. He may, you may have to hire someone to grade yourself. And I think that it's going to be very eye-opening when we see so many companies that claim they're green and Gensler doesn't think they're green. It's going to be very good at 2 o'clock. Got to watch it at 2.
Yeah, Bob, thanks for that. We'll be watching this afternoon. Bob Pisani. Quick reminder here, you can always get in on the CNBC Investing Club with Jim. Just sign up and find out more at cnbc.com/join the club or use the QR code on the screen. In the meantime, as we go to break, let's take a look at the bond report. We mentioned some of the inversions in various parts of the curve today. We did get the 2-year back to 2%. First time since 2019 on that one, and that 10-year hovering just above 222. Back in a moment.
We think that as competition increases in crypto, and this is not a call on crypto or Bitcoin prices or anything like that, but we think as competition increases amongst the exchanges, you're going to see fee compression. And as it is, Coinbase will probably not be profitable this year with a $40 billion market cap.
That's renowned short seller Jim Chanos Friday on Closing Bell Overtime talking about Coinbase, down 5% today. Jim, what do you think?
Look, I listened to him, and by the way, Scott's show is incredible. Scott Wapner, for me, you're just going to get provoked, and that's what matters. And I listened to Chanos, and I've known Jim for, 30 years. I thought it was a very compelling decision to get out of it. To say bad thing, I like Silvergate, by the way. I don't know if he cares for that one. But it just seems like to me that Coinbase is the one that is tussling with Gensler. And, Gensler, when you go review, there was a really good piece in the New York Times this weekend about, it was everything you need to know about crypto. And, of course, it sends you to a Gensler class. So, you've got the SEC and you have Coinbase. And what he said to me, Gensler, was Coinbase ought to come in and just talk about their practices. And I don't know whether they've done that, but I do know that I don't want to go against, in this particular case, I don't want to go against Chanos. There have been times where I don't think Jim is right, but I thought this was well thought out.
Right. Overall, the argument, especially when we got that executive order a couple weeks ago, was that the industry has tried to avoid throwing bombs. But Coinbase has been, I guess, maybe one of the more aggressive players.
Yeah, I've always learned that the commission wins in the end. Don't try to move the commission. Go with Gensler. And I'm very surprised because they've got a terrific lawyer there at the top. But you go against Gensler at your own peril. He's in charge.
Yeah, he is the commissioner. We're down negative territory in the S&P. Bostic continues to speak, says the Fed should get moving quickly, in his words, on the balance sheet. We're going to watch that along with a bunch of other Fed headlines all week long. We're back in a moment. Get Stock Trading with Jim. It is time for Jim and Stop Trading.
You know, Carl, a lot of the strategists were after the stocks that moved up the most last week, and one of them was NVIDIA, moved from 213 to 260. Now, there actually is a substantive reason. Tomorrow, Jensen Huang, the CEO and a visionary, gives his keynote. Every year, his keynote has been very defining. This year, I think it's going to be software. The stock was up in pre-market trading. It's now down. But be aware that this stock is not up idly. It's up because of a very important keynote.
All right. So, I see Stiefel tonight? What do you got?
Yeah, you know, I'm trying to focus on every single one of these financials that people have kind of just aren't focused on. There's some great opportunities here, particularly because this is a firm that makes a lot of money. Wealth management makes a lot of money if rates go higher. So let's focus on them. And I refuse to be as bearish as the people who write at the top. But I don't blame them if they read the New York Times over the weekend and they read the top. I don't know how you can be anything other than negative.
Right. Yep, there's a lot going on, Jim. Yep. We'll see you tonight. Mad Money, of course, 6 p.m. Eastern Time. When we come back, the latest on that Boeing 737-800 jet crash in southern China. We're back in a moment. Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan. David Faber has the morning off. Pretty light morning of corporate news, but that NABE conference is going to make the Fed headlines fly fast and furious. Already a bunch from Bostic today, and of course the Fed chair later on this afternoon. Dow's down almost 100, Morgan.
We're 30 minutes into the trading session. Here are three big movers specifically that we are watching. We're going to start with Berkshire Hathaway buying insurance company Allegheny for $11.6 billion in cash. Allegheny will operate as an independent subsidiary of Berkshire. And as you can see, both of those stocks are higher. Berkshire up 1.5%, those Class B shares, and Allegheny's up about 25%. Speaking of deals, PE firm Thoma Bravo buying Anaplan for $10.7 billion or $66 per share in cash. You can see those shares are jumping 27.5% right now as well, 64.54. And Boeing, finally, those shares under pressure after a Boeing 737 jet crashed in the mountains of southern China with 132 people on board. Phil LeBeau has the latest for us. Hi, Phil.
Morgan, investigators are going to try to find the cockpit voice recorder as well as the flight data recorder. That's the priority as they go to the scene. It does not look like there is any survivors. We do not believe there are any survivors from this crash. This plane was in a rapid descent when it crashed into a mountain in southeast China. And already analysts are saying, okay, what are the implications for this in terms of Boeing, in terms of its business? Remember, China is the second largest commercial aviation market in the world. It's critical to Boeing, even though they haven't had a sale there in a couple of years, even though the MAX deliveries are not resumed. So it brings up the question, what does this portend for the future, at least over the next couple of months, for Boeing and its relations with China and Chinese airlines? A couple of notes that have come out today already looking at this aspect of things. First of all, there's Cowen saying given Boeing's problems with the 737 MAX, there is some chance that consumers may not want to fly on a 737 until the cause of the China Eastern crash is determined, not to be a design or manufacturing issue. RBC out with a note saying one potential consequence to this tragedy could be the subsequent grounding of the 737-800 fleet in China. By the way, China Eastern has grounded the 737-800, but other Chinese airlines continue to fly the plane. And finally, Baird saying the flight was at a cruising altitude when it nosedived over into a vertical dive, which is highly unusual. You want to see how unusual this was? Happened in less than 2 minutes. This is according to FlightAware. This is the data of the altitude of the plane as it descended rapidly. There's no indication that the pilot had a distress call. This took less than 2 minutes. They were at 29,000 before they started falling. A brief uptick there where it appears that the pilots were trying to do a recovery, and then you see ultimately the crash. And again, less than 2 minutes. As you take a look at shares of Boeing, it has not resumed 737 MAX deliveries to China. And that's important to point out because they are in the process of hopefully resuming those deliveries. The Chinese authorities just approved it to be flown again in December, but none are in commercial service. And we can't stress this enough, guys, because I've already heard from some people. They said, well, was this a MAX? No, this was not a MAX. This is a bread and butter 737 NG, the most popular of the 737s flown around the world. There are many of them in China, powered by the CFM56 engine, which is a workhorse engine. Both have very strong safety records. And again, at this point, more questions than answers. Guys, back to you.
And I realize more questions than answers, but do we know how long potentially an investigation into all of this could take? I mean, presumably they're going to find a black box if they haven't already, and they'll be able to start to get some of those questions answered.
It could take months. Morgan, okay. It could take months. And you look back to past investigations of commercial airplanes, sometimes investigators are able to put together what happened relatively quickly. Other times it could take several months. You look back to there was a crash in Indonesia in early 2021, and or late 20, early 21, they were still investigating, and they finally had a better sense of what happened. That took months, and that's what we could be looking at here.
Phil, appreciate that. We're going to watch it closely. Obviously, Boeing is going to be the worst performing Dow component this morning. That's Phil LeBeau. Turning back to the market, stocks are coming off the strongest week in more than a year, recouping nearly half of the S&P's correction losses. Can that rally continue, though? Let's bring in senior markets commentator Mike Santoli, who's already done a few hours of television this morning.
Yeah, this feels like just barely anything tacked on the end. No, it's a fascinating thing, Carl, because last week's rally hustled the indexes right up to that exact point where it creates this very two-sided debate as to whether, in fact, it's something that can last. You had very strong what are known as breadth and momentum indicators. 4 consecutive 1% days, a huge majority of stocks making a new 10-day high. So all these things that people look for to say, was there real force behind the move? There seems to have been, all, by the way, happening in a week. When we got the first Fed rate hike we were all expecting, when the S&P had a death cross on Monday. So all these excuses why you might have expected to have the market back off, and it kind of went up in the face of that. The fever broke in terms of macro stress. VIX crashed below 30 from above 30. You had the credit spreads also narrowing. So I think it's a pretty good case that 4,100 to 4,200 area in the S&P has proven itself for now as the low end of this range. I think that's the minimum you can say. It broke this sort of downtrend that's been in place all year. We haven't seen earnings estimates get revised much at all. The question is that a shoe that's still to be dropped? Because the valuation got okay on the earnings we think are coming through. The question is, will they, given all else is going on?
Yeah. Meanwhile, the NABE conference is going to result in a bunch of headlines, as we said. Bostic this morning on the balance sheet, which we have been thinking about as a summertime dynamic. He says they should get moving quickly, in his words. Does that pull forward some anxiety?
I don't know that it does incrementally, just because we've been saturated with Fed tightening, withdrawal of stimulus talk. And to me, the message is that Fed officials want to convey the idea that they have some sense of urgency about normalizing, however you define that. That's going to include the balance sheet, and there seems like they'll take whatever slack the market gives them to get moving on things.
I realize that you can make the argument there's a lot already priced into the market here, Mike, and we're sort of parsing through just how meaningful that rebound last week actually was. But, I mean, you see energy starting to move higher again. There's a lot of concern about food inflation as well, too, from a global standpoint. And then, of course, there's some transportation issues. We've got more bottleneck issues. You've got that Canadian Pacific lockout, that strike that's playing out with its workers. We're going to have another set of labor talks on the West Coast with the ports coming into the summer as well. I would imagine that we haven't actually yet seen a peak in terms of inflation data. So how much of that is actually priced into the market now? Do we even know the answer?
We don't. We never know the answer in advance, unfortunately. Morgan, I think it's totally fair to think that those are all the reasons why you can't really sound an all clear on a lot of the things that have been hounding this market. It's just one of those deals where when the market goes almost straight down on a steep angle from January 3rd into mid-March, you know, even if it's going to be a rough year, usually you get some relief. And that's why I think this is very much a rally in the eye of the beholder. I think a lot of people who were bearish coming in said, that's very nice. It didn't really prove anything until you get the S&P up another, let's say, 5, 6%. I'm not going to be persuaded that there's really been a tidal change.
Mike, thanks. Good setup as we discuss the markets this morning. That's our Mike Santoli. For more, let's bring in Eaton Vance, Chief Equity Investment Officer Eddie Perkin, and Wedbush Securities Yigal Arunian. Gentlemen, good to see you both. Eddie, you know, 44.50 would have sounded pretty good a couple of weeks ago. Do you think this is a natural place to lighten up if that's your long-term view is more cautious?
I think it is. I think it's, you know, we had a powerful rally last week, up 6%, and really not a lot of new information, right? We didn't get a lot of new news from the situation in Ukraine. We didn't get a lot of new news on inflation. We got the Fed rate hike that we knew we were going to get. So we didn't learn a lot new, and yet we had this big move upward. And I think a lot of those risks are still on the horizon, still out there, still remain to be to play out.
Interesting. Yigal, you agree? Are we still in a sell the rip kind of environment?
Yeah, I would agree on large part. Really, the only news last week was the rate hike, which again was expected. There's still a lot of risk on the horizon coming from a lot of angles: the war in Ukraine, inflation, the health of the consumer, which feels a little bit balanced right now with a strong labor market, but with inflation and rising gas prices, I think there is some risk around the consumer and how healthy the consumer can be for the rest of the year. And that's going to have a lot of impacts across the board, whichever way that falls.
Eddie, I'm looking at your notes. You say it's, quote, this time is different. Secular change is underway in 3 areas. Lay those out for me and what that means for how an investor should navigate the markets right now and all of these changes.
Yeah, it's always very dangerous as an investor to say this time is different, but I think you can have some confidence in that this time around because there is secular change underway. Certainly, I think we're now in an era of deglobalization that was already likely to happen as a function of COVID, and now with the situation in Ukraine, I think companies have to rethink supply chains, do more onshoring, do more dual sourcing. And then inflation, inflation, I go back to my Milton Friedman. Milton Friedman said inflation is everywhere and always a monetary phenomenon. So the very loose monetary policy we've had over the last couple of years is a contributing factor in inflation. But then you've got all these idiosyncratic things as well, like supply chains, like the situation in Ukraine, like the move in oil prices and the way that feeds through the economy. And so I think you have to rethink your priors. You have to be willing to consider that we're in a new environment where you don't just buy the dip, but you look long term, and that's what we're doing at Eaton Vance. We're dusting off our very long-term playbooks and looking for opportunities in the near term that are going to play out over many years to come.
Yigal, same question to you. I mean, how are you approaching the market right now, and what does that mean for an investor playbook?
Well, you guys kind of led into this with Mike right before the segment on downward estimate revisions. We've actually seen a fair amount within my coverage, at least in the tech universe, of downward estimate revisions after the first quarter. Valuations have obviously reset significantly lower than they were kind of at their peak over the last couple of years. The big question now is, are those downward revisions now kind of in a good place, or can they potentially go lower? I think that's what the market really needs to get a good handle on as we go in the next couple of quarters. Again, that comes back to the health of the consumer, what we're seeing around the supply chains, around inflation. I think there's still a lot of unanswered questions that kind of leads to kind of being focused on the best of breed, the highest quality companies right now that maybe have the least risk on downward estimate revisions. But I think we're still in a market where you're focused on the best in class companies.
Yeah, Yigal, I did notice that you got outperforms on both Uber and Lyft. And Eddie, it does remind me whether or not, despite all the consternation regarding geopolitics and Europe and energy prices, the reopening trade, does that seem to you to be a bit of a rich zone, at least in this turbulent environment?
It does, and those stocks, frankly, over the last few weeks have not performed particularly well. So we're looking elsewhere. We're looking at some of the stocks that have lagged. Large cap tech. I'm a value investor, but large cap tech looks more interesting to me than it has in a while. I think Western Europe looks more interesting than the U.S. in terms of where valuations are. And if you've got some tolerance for risk, then I think you go to emerging markets because, yes, there is risk there, all the risks we've been talking about, but you are at least getting paid for it in terms of the valuations that you're buying in at.
Yeah. Eddie, Yigal, appreciate it very much. Good to see you both kicking off our 10 a.m. hour. Thank you. As we go to a quick break, take a look at the roadmap for the rest of the hour, including a lot more on rising inflation and how it might impact your next meal.
Plus, satellite makers getting caught in the middle of cyber warfare. We're going to discuss that with the chairman and co-founder of Viasat.
And we'll check in with UBS Director of Floor Operations, Art Cashin, as stocks try to build on last week's momentum, although the Dow, a quick session low here, down 161. A lot more squawk on the street is still ahead. Don't go anywhere.
Welcome back to Squawk on the Street. Over the weekend, Russia releasing video claiming to show a hypersonic weapon destroying an underground ammunition warehouse in western Ukraine. The country's Ministry of Defense saying it used the long-range missile in strikes 2 days in a row. The Pentagon has not confirmed that hypersonic weapons were used, but experts do say in a war that has been very missile-centric from the outset, use of hypersonics, which would be the first time, would mark a shift in strategy, and it also highlights American efforts regarding the technology. Hypersonic missiles travel at speeds comparable to ballistic missiles, very, very fast, but they're more maneuverable, not following an expected trajectory, and thus capable of evading more traditional defense systems. Now, Russia has already deployed such weapons. China is believed to be close. The U.S. is developing programs of its own across the military branches. The Army's top general, Chief of Staff James McConville, telling me just earlier this month that the Army's first hypersonic system, the long-range hypersonic weapon, is on track to be fielded next year.
Hypersonics is one of our #1 priorities. We only fall behind China and Russia if we let them. We certainly have the capability. We have top-notch scientists. We developed hypersonics in the past. That's why we're able to field it so quickly. But at the time, it just was not a requirement. But now it is.
Air Force Secretary Frank Kendall also recently telling me that the U.S. mix of weapons won't be a mirror image or symmetrical with adversaries. Still, the Air Force has several programs that are under development, including the flagship Arrow, which, after several failed launch attempts, has seen some funding slashed in the 2022 budget. The U.S. government is expected to spend $15 billion on the effort between 2015 and 2024. And it's not just offensive weapons either, pursuing things like space sensors and glide phase interceptors that can, quote, kill an incoming hypersonic missile. That's according to Tom Carrico at CSIS. The names to watch from an investor standpoint when it comes to all of this technology and how the U.S. is developing it are Lockheed Martin, Raytheon, Northrop Grumman, also names like Leidos and Aerojet Rocketdyne. But, Carl, we're expecting a number of both policy and funding, strategies to be released by the Biden administration in coming weeks. And hypersonics is expected to be a key focus of all of that reporting that comes out of the administration and its stance on defense longer term.
Yeah, we're having to get educated on the development and innovation in these defense technologies, Morgan, no question about it. As we go to break, check out the biggest laggards on the S&P this morning. You got some weakness in consumer discretionary, some tech, but Nielsen is going to be the biggest laggard as it rejects this takeover bid by a consortium. We'll be right back. Welcome back to Squawk on the Street. Let's get to our senior economics reporter, Steve Leisman, down in D.C. for the NABE Economic Policy Conference with some highlights so far this morning. Good stuff with Carney this morning, Steve.
Yeah, Carl, I'll come back to that in just a second. The debate here so far looks to be over the issue of the Federal Reserve and inflation. How far, how fast the Fed has to go, how you layer in and think about the uncertainty of war, which is going to raise prices, but also could end up affecting growth and demand down the road. Raphael Bostic, the Atlanta Fed president, was the first Fed speaker to speak here. And he talked about this idea of he willing to do more and be more aggressive, but also has to factor in what's going on with the war and how it may affect the U.S. economy.
I'm comfortable with more aggressive movements, if that's what the data and the evidence suggests is appropriate. So I'm not wedded to only moving 25 basis points. I'm not wedded to moving every other meeting. I'm going to be very, very open in terms of my approach to figuring out what appropriate policy is.
Bostic describes himself as more of an owl who's looking around to see what's going on rather than a hawk or a dove. He said $1 trillion, $1.5 trillion could come off the balance sheet over time because that's just excess liquidity that's out there. To get a gauge for what the group here at NABE, the National Association for Business Economics, thinks, take a look at the results of this survey they did. 77% think the Federal Reserve is too stimulative. This is a group that usually agrees with where the Fed is. That's up substantially from an already high number in the last survey. So these folks think the Fed ought to get a move on or get on the stick here and do a little bit more work. On that score, Goldman Sachs out with a report over the weekend in which they said, quote, we still expect 7 25 base point rate hikes in 2022, but now expect 5 hikes in 2023 and a higher terminal rate of 3 to 3.25%. Getting back to where Carl started with Mark Carney, Carney thinks the Fed has to get to a positive real rate. So take out inflation from that. That means they've got to bring down inflation and raise the rate to get to a positive point. All of this points to Fed Chair Jay Powell, who is speaking here in the noon hour, and we'll see how aggressive he wants to be, Carl. We know he's talked about the idea of perhaps going faster if needed, if the data don't cooperate, inflation does not come down. Carl?
And Steve, really quick, the latest read on Q&A, do we expect the chair to take some questions?
I do believe he is going to take some questions. There's going to be prepared remarks, and he will take some questions. So we'll be listening. I would expect the questions would be not too bad coming from economists here to the chair. Not as good as journalists, as you know, Carl, but maybe not too bad.
Yes, we know. Steve, thanks. We'll keep tuned to it all day long.
Pleasure.
With your help. That's our Steve Leisman. Meantime, as gas prices continue to soar and inflation hits new records, companies are passing along the cost to consumers. Our Kate Rogers is here with a look at the companies best positioned in that environment. Hey, Kate.
Hey, Carl, good morning. Recent data from BOFA looking at spending by income groups notes that higher prices are starting to create some headwinds, but that overall spending is steady. For lower income groups, the biggest slowdown was in clothing and furniture spending on a 3-year basis, but restaurant spending did remain resilient. Some names, though, are better positioned with pricing power in this environment, many of them catering to a higher-end consumer, according to BTIG. That firm's top 2 picks for 2022 are Chipotle and Starbucks. Chipotle's raised prices about 10% over the last year, and executives remain confident in the brand's value proposition. Starbucks similarly caters to a higher income demo and can lean on pricing in this environment. Sweetgreen and Shake Shack are in a similar position, both with loyal followings and the ability to raise prices again in this inflationary environment. Now, a name with a lower price point in the space that's also seeing success despite inflation is Wingstop. In its most recent earnings, it noted that despite multiple price increases in 2021, totaling about 10 percentage points, it's grown transactions without any negative impact. Now, chicken wing prices are also coming down a bit, which is good news for Wingstop. Remember, prices are higher at grocers as well. Consumers still need to eat, and wage inflation is not coming down anytime soon. So an immediate pullback here isn't expected just yet. Morgan, over to you.
Kay Rogers, thank you. It's now time for our ETF Spotlight. And speaking of inflation, take a look at the iShares U.S. Consumer Staples ETF, ticker IYK. It's taking a leg lower over the last month after big gains amid the reopening. It's up fractionally right now. But it's the same story for all of its top holdings, Procter & Gamble, Coca-Cola, Pepsi, which make up more than 35% of the ETF. They're all in the red for March, still within 10% of their highs for the year, though. Squawk on the Street is back in a moment. Stay with us.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. No surrender. That is a response from Ukrainian officials to a demand from Russia that fighters in Mariupol put down their arms and raise white flags. In exchange, Russia said that it would let civilians leave. Hundreds of thousands of people remain trapped in the besieged port city. Speaking at Washington's Holocaust Museum in the last hour, Secretary of State Antony Blinken accused Myanmar of committing genocide. He says evidence shows attacks against Rohingya were widespread and systematic, with a clear intent to destroy the stateless ethnic group. Also within the last hour, Supreme Court nominee Ketanji Brown Jackson left her home for a short trip to Capitol Hill. Her Senate confirmation hearing is scheduled to start about 30 minutes from now. Some Republicans have criticized her for representing criminals in court when she was a public defender. And Supreme Court Justice Clarence Thomas should be going home in a day or two. He's in a Washington hospital with an infection that's causing flu-like symptoms, but is reportedly responding well to treatments with antibiotics. Morgan, I'll send it back to you.
Rahel Solomon, thank you. We're now getting back to Boeing. Shares are under pressure after a Chinese Eastern Airlines plane with 132 people on board, a Boeing 737-800, crashed in the mountains of southern China. Joining us to discuss, former CEO of Frontier Airlines and current CEO and founder of Manifest Escapes, Jeff Potter. Jeff, thanks for being with us today. As Philip Bowe put it earlier, he said more questions than answers right now, but just in terms of what we do know and the information we are gleaning from this crash, your insights.
Well, you know, we oftentimes in an unfortunate situation like this, we tend to gravitate immediately to certain areas. And, you know, so from what it appears, there was quite a altitude drop immediate. So, you know, it can range from catastrophic failure in terms of airframe, where the pilot's incapacitated at some point. So yeah, there are a lot more questions that are answered. So, you know, what's happening on the ground right now is obviously, you know, searching hopefully for survivors. It doesn't appear, unfortunately, that to be the case. Putting out the fires, and then ultimately finding the black box and the cockpit voice recorder. Until those are found, it's really going to be more questions than answers.
In terms of how an investigation into all of this could play out, and I realize that it's a big question mark around timing.
Sure.
But what would that process look like, particularly in a country like China, where I realize this aircraft had a very strong safety record, but Boeing in general has had somewhat of a fraught relationship over the last couple of years due to another member of the 737 family, the MAX.
Right. Well, I think it's important to note that the Chinese aviation industry has come a long, long way in the last couple decades, actually. And so their training is very good, follow the regulations, not legally towards the FAA regulations that we have here in the U.S. But, you know, I think it's a process that at the end of the day, whether it's Chinese aviation, U.S. aviation, airlines, you know, we ultimately want to find out what occurred here. And as terrible circumstances this is, we need to learn from it. So ensuring that there's nothing systemic anywhere in the operation of this aircraft is critical to all parties. So there's a common theme here that we do want to find out the real answers to what occurred with this flight.
Point, Jeff, that you're making regarding the progress they've made in civilian aviation, I wonder, would you argue they've made more strides in maintenance and inspection, or the sort of softer sciences of what we call cockpit resource management, that's understanding the psychology and the teamwork behind pilot work?
Yeah, I think all the above. I think they have had a lot of progress on the maintenance side of the aircraft. My understanding is this aircraft's only 6 years old. It is, yes, Boeing, but it's very different. It was the predecessor to the MAX. So they've come a long way, not only in the cockpit with CRM, but also on the actual operational integrity of the airline itself.
And then, of course, there's the just the path, the odyssey that Boeing's been on, getting clearance, regulatory clearance in China. I know we know very little, as Morgan pointed out, but at this point, what would it take, do you think, for China to view Boeing differently, given their needs for aviation in general?
I think the communication coming from my airline perspective, even on a day-to-day basis, before any type of accident such as has occurred this morning, there's an ongoing communication, and unless, and this is a stretch, unless there is something that has been undiscovered. The 800 has 5,000. I think they've delivered over 5,000 of these aircraft around the world. We understand the issues with MAX, 737 MAX, but with that said, the 737, 800, and Boeing in general have had an impeccable record. And I think with China, who, by the way, China Eastern has ordered the 737 MAX. So there's obviously a professional relationship, a corporate relationship, but an understanding that with all parties, safety and security comes first. And whether something comes out of this accident that causes, some reconsideration on China's part or their airline's part, it remains to be seen. But I doubt very much that's going to happen.
Jeff Potter, we appreciate your insights today. Thank you for joining us.
Thank you. Have a great day.
With shares of Boeing under pressure, as well as key suppliers like Spirit Aerosystems and also GE.
Meantime, after the break, we're going to check in with Art Cash and get his take on this market volatility, with stocks down by about 200 points on the Dow, S&P back to 44.45.
Welcome back to Squawk on the Street. I'm Christina Partsinevelos. Stocks are lower across the board, with the S&P coming off its best week since 2020. Tech and communication services are the biggest laggards right now. Meanwhile, energy is far and away the best performing sector in the group. Taking a closer look within that particular sector, some huge moves in Occidental Petroleum, Diamondback Energy, Marathon Oil, and Hess Corporation. Also, check out shares of the Energy and Exploration Production ETF, the XOP, up over 3% this morning and now up over 10% so far this month. From Times Square, I'm going to send it back to you guys downtown. Carl?
Christina, thanks very much. Meantime, joining us on the CNBC Newsline this morning, Art Cashin, UBS Director of Floor Operations, joins us this morning on the phone. Morning, Art. Good to talk to you. Art, I wonder what you think is driving the bus right now in terms of narratives, whether this is still about negotiations and peace talks and military action, or is it the Fed and the headlines coming out of the NABE conference, or is it something regarding expectations for this coming earnings season, or I guess all of the above? I guess we don't have Art at the moment. We'll try to work on that in a moment and get him. But Morgan, he's got to have some opinions given the volatility we've seen just this morning. Pretty wild swings. Dow's currently down about 176 as we do keep our eyes peeled for headlines out of the conference.
Yes, and we will work to get Art back as soon as possible. But in the meantime, after the break, don't miss my exclusive interview with the co-founder and chairman of Viasat, talking about space resiliency amid the geopolitical backdrop and everything that's playing out in Eastern Europe. We're back in a minute. Welcome back to Squawk on the Street. We're just keeping an eye on the volatility that's playing out in the energy markets as well. As you can see, it's another up day, to say the least, for WTI crude and for the world benchmark Brent, both up about 6% apiece, with WTI trading back around 110 per barrel. And Carl, I mean, it has been a ping pong in terms of the moves we have seen in crude, as well as refined products, as well as other types of commodities, industrial commodities in particular, in the last couple of weeks amid everything that's playing out with Russia, Ukraine. Of course, now you had this situation that in Saudi Arabia with critical energy and oil infrastructure as well, with Iran sort of in the backdrop, and key questions about what the supply-demand dynamics will look like. But the fact that we are seeing some of these oil prices move higher after that dramatic drop of the last 2 weeks, I think it is very telling and speaks to the broader inflation debate and what that means for the markets and what it means for the Fed.
Yeah, every little wrinkle regarding supply is going to be absorbed by the market. You had the Saudis say, look, we can't be responsible for any shortfall in supply as a result of that attack from the Houthi rebels. And then you had over the weekend, Morgan, Europe try to start to diversify their supply of natural gas from other players in the Middle East. But that only led to the Russian deputy prime minister trying to saber rattle today, saying that there's no way you're going to diversify. You still need our goods. And by the way, oil prices, in their words, could jump to 300 to 500 if Europe does ban Russian oil. So a lot of tape bombs trying to make their way across the tape.
For sure, and certainly puts that much more attention on President Biden's trip to Europe to meet with all of these different officials this week. We'll have to see how that plays out as well, Carl.
Still to come this morning on Tech Check, we're going to talk some Tesla. Jefferies cuts its price target on that name from $1,400 down to $1,250 on a big week where Giga Berlin's going to make some news. We'll take a closer look at that in the next hour. In the meantime, Dow's down 180, relatively moderate range. We're back in a moment.
Welcome back to Squawk on the Street. Today kicks off day one of Satellite 2022. This is a big annual space conference held in D.C. I spoke with the co-founder and chairman of Viasat, Mark Dankberg, to discuss his outlook for the satellite operator and the industry. But first, We started with a cyber attack that took Viasat's satellite internet service offline in Ukraine and in parts of Europe, just as Russia began invading Ukraine in late February. Now, service can and is being fully restored currently, Dankberg tells me, as I asked whether he can confirm officially whether Russia is, in fact, behind the cyber strike.
We did a very thorough investigation. We've been cooperating with the U.S. law enforcement and intelligence agencies. I think the things that we can tell you about is we can tell you what happened and what we did to restore service.
So we can't confirm yet that it's Russia. At least you can't confirm that it's Russia.
It come from the government, yes.
Understood. Understood. We did get a recent U.S. government advisory warning of possible threats to satellite communication networks, urging companies to bolster cybersecurity defenses. Your thoughts on that and how it's going towards fortifying Viasat in other locations?
Yeah, so the advisory really said that satellite operators should be very vigilant and should lower their threshold for incidents that they report to intelligence and law enforcement agencies. So we think that that's absolutely warranted.
How do you, I guess, bolster, fortify, secure those satellite operations? And does that change now in light of what we've seen in Eastern Europe?
So the way that we deal with that is we monitor all the traffic on the network for those that we actually operate ourselves. So we monitor all the traffic, and that involves billions and billions of alerts that occur every day. So what we do is we have an artificial intelligence system that sorts through those. It's like pattern recognition, and we can figure out which are the important ones.
And then humanitarian assistance programs, that's something you've been actively involved in Eastern Europe in the midst of all of this as well, and being able to connect people and refugees. Tell me a little bit about that.
So what we've done is working closely with the government in Slovakia is been able to set up satellite hotspots right on the border where they're being inundated with refugees, unfortunately, right now. And one of the very first things those refugees want to be able to do is contact their relatives, let them know that they're made it safely. And that's what we're able to do with our satellite networks there, right on the border. We can set them up wherever those refugees are coming through, where they're being housed, and we can serve many thousands or tens of thousands of people simultaneously.
This entire situation from a geopolitical standpoint shines a light on just how connected the world is right now and just how crucial the infrastructure that is in space is to that process.
Yes, it does. And it also really illustrates one of the themes that we've been saying, which is space is something that is important to dozens of, if not hundreds of countries around the world, let alone companies. And so one of the main themes that we've been working on and trying to build awareness around is, what are the limits to space? How is it that those limits should be allocated in a way that's inclusive of all countries that want to get the benefits of space, whether it's for national security, digital inclusion, humanitarian efforts, whatever those efforts are, they involve participation in space.
Now, I also asked about the competitive landscape for broadband satellite services amid a flurry of satellite mega constellation plans, including, of course, SpaceX's Starlink, for which, from a regulatory filing standpoint at least, the rivalry between Viasat and SpaceX has been, well, contentious.
I think that the real issue that we're trying to get focus on is measurement of the risks. And those risks have been well identified by the FCC, recently by NASA, and they include the risks of collision in space, which could make space inaccessible to all. It includes the impact on astronomy, the impact of re-entry of thousands or tens of thousands of space vehicles a year and burning up in the upper atmosphere. So what we really need to do now is not just acknowledge those risks, but measure them. And then once we understand what those measurements are, we can come up with allocations of those risks that will preserve access to space.
Consolidation is also expected to be in focus this week at this conference, and Viasat is certainly on the forefront of that. It's in the midst of a merger with Inmarsat for a $7 billion plus deal. The UK government, just this morning, it being announced, has struck a deal with the two operators around this prospective merger, and Dankberg telling me that it's on track to close, potentially. Still some more regulatory hurdles, but on track to close within the 9 to 18-month timeframe that was laid out back in November. Now, if you want to hear more on this, you'll be able to catch the entire interview on my podcast, Manifest Space. That episode is launching tomorrow, wherever you listen to your podcasts. Carl?
All right, fantastic, Morgan. Meantime, joining us on the CNBC Newsline, we do have Art Cashin, UBS Director of Floor Operations. Art, I'm glad we got you before the hour ran out of time. I guess my first question to you would be, do you give the bulls some credit for going out last week strong and holding on to these gains, or at least this range?
Oh, absolutely, Carl. Amazingly, we went from heavily oversold coming in on Monday to somewhat moderately overbought going out on Friday. So they had quite a good run. The breadth was okay. It just, in my gut, I'm not sure that we're ready to be where we are quite yet. We're facing the moving averages, so we're in for some testing still, I think.
Right. How much is riding on the line out of this NABE conference, and specifically whatever additional color the chair is willing to give today?
Well, I think we'd love to hear a little bit more, but I think it's going to remain geopolitical. And the concern is, what does that do to oil, and where do we go from there? So I think the bulls are going to have to try and maintain control. Next 2 days are going to be tough. It's an equinox, and equinoxes are when markets change direction.
When markets change direction, when you say an equinox, when markets change direction, Art, what do you mean by that? Explain that a little bit more for me.
W.D. Gann, famous technician, noted that the autumnal equinox is the biggest day of the year for the market changing direction. The vernal equinox is not quite as strong, but you got to keep an eye out.
Understood. So I guess what are some of the key data that we would be getting, or key technicals that we would be getting in coming days, coming weeks, that would really, truly begin to, I guess, solidify whether this is a bear market bounce or just the end of a correction?
Well, I think what you want to watch is some of the technical internals. We're at a key area right below the 100-day moving average and a few other things. If they can't push through that, then you expect it to pull back. Also, from the Ukrainian situation, ironically, you don't only need to hear what's happening on the war front. The question is, did they get the crops in? Will we get a winter wheat crop? That could be a worldwide shortage of wheat. And not only would that make food prices go up, but it could jeopardize governments, Egypt, possibly even China. While I don't think President Xi is in direct trouble, as Carl knows, over the last nearly 4,000 years, every time a Chinese government has fallen, it's fallen because of food shortages and food prices. So I don't think President Xi is sleeping too comfortably till he sees that we resolve what's going on in the Ukraine.
Art Cashin, it's always great to get your insights. Thank you for joining us today.
Thank you.
The Business Roundtable is out with its quarterly CEO Economic Outlook Survey, and our Eamon Javers has the results. Eamon.
Morgan, that's right. Business Roundtable says CEO optimism about the economy declined 9 points in the first quarter of 2022, but the group's first quarter CEO Economic Outlook Index remains well above its long-running average, despite the drop to a value of 115 this quarter. That, according to the Business Roundtable. Fueling the drop, they say, were uncertainty around Ukraine, high inflation, supply challenges, and global energy disruptions. The quarterly survey measures CEO plans for capital spending and employment, as well as expectations for sales over the next 6 months. Now, plans for hiring decreased 9 points to a value of 112. Plans for capital investment, those decreased 9 points to a value of 106. And expectations for sales, well, they decreased 10 points to a value of 125. So all of that, guys, paints a picture of global uncertainty with a wide variety of inputs. So it's clear that there's no single event that will be enough to dispel all of these worries. Still, though, the group is projecting 3.9% GDP growth for this year, which is unchanged from the previous quarter. So a glimmer of hope right there. Back over to you.
I guess we'll take the glimmers where we can get them, Eamon. But in terms of the decrease we saw in capital spending and capital investment, business spending, I mean, is that represent a shift from what we've seen more recently, or has that been on a downward trajectory already?
Yeah, well, remember that the previous quarter, we were at all-time highs in this particular survey. I mean, they were really crushing it. And this gets into that roaring 20s narrative that so many people have been talking about. You know, when are we going to finally emerge from the coronavirus story and into a roaring economy? Well, all these uncertainties around Ukraine, they say, have added to the uncertainty going in. So we're not clear when we're going to get there.
Eamon Javers, thank you. Just getting a quick take on the markets before we wrap up the show here. The S&P actually just turning positive, although barely, just above the flat line. 44.65 is the level there. The Dow continues to be under pressure, as does the NASDAQ and the small cap Russell 2000. That's going to do it for Squawk on the Street. Tech Check starts now.
Good Monday morning. Welcome to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Fort. Today, did last week's rally signal a bottom? Why one of Wall Street's top strategists says the selling is not over. But what about a new plan? We get a new buyout this morning following a cratering in software valuations. Does that signal a buy? And then Chanos revealing this new short position, why he says coin isn't in Coinbase's future. We're going to start with the rally, though, that we've seen for the NASDAQ, gaining more than 8% last week, best week since November 2020. So should investors be buying that dip? Was that it? Thoma Bravo sees some value in one software name, buying Anaplan for nearly $11 billion. No shortage of bearish arguments, though. A headline in the Journal this morning reads, sorry, investors, you can't buy the dip anymore, arguing the Fed is now too big a risk. Key questions for investors, where's the next Anaplan? Is it safe to buy some beaten down tech? And was last week's bounce real, John? Fascinating dynamic, especially as some of these software names are getting a second look.
True, Carl. Yeah, I still think it looks to me like it's risky to look for the next Anaplan, and here's why. Thoma Bravo is willing to pay around 11 times revenue for Anaplan. It's kind of a high-quality asset here. They think they can put it together with some other things and show some real growth down the line. Private equity up to this point has tended to pay around 8 times revenue, right? So this is an unusual situation where PE was willing to pay more. It's also rather expensive. So what about all the other expensive stuff out there that might not be as high quality and that PE might not be willing to pay 11 times revenue for? I think that's what you sort of have to consider as you look through, what are the chances that these things have bottomed because of PE? Yeah. I don't think that's why. I think you got to be prepared to hold on to something for a long time and really believe that it's high quality, even if you're buying here.
If you have that long time horizon, but we know that private equity is so flush with cash. They've raised so much in a low interest rate environment that perhaps we're seeing another chapter here, guys. They're looking for these beaten down software enterprise names. Yes, John, everything you said is fair warning, but it's a different proposition here as well, right? You look at Starboard and Box, right? Starboard tried to move Aaron Levy. They couldn't. He was able to create value on his own. But when you're getting into these software companies, you're dealing with a different kind of company, sometimes where the founder is still in place and has built a lot of goodwill with investors. So it will be interesting to see if more of this happens. And we actually have the perfect guest to talk about this. So we're going to dive into it. Joining us now for more on software valuations, GGV Capital Managing Partner Glenn Solomon. GGV has been making the argument already that there's a valuation floor in software, arguing if valuations fall too low, there would actually be buyouts exactly like we're seeing with Anaplan. Glenn, it's great to have you this morning. I guess the question, though, is if we see more, will private equity firms be successful? Is this an issue of companies, less not being well run and more, markets valuing them on a more normal historical basis? Is there room for them to create value?
First off, a lot of these companies are doing exceptionally well. Anaplan, no exception. The company's growing 30% plus year on year, very strong margins, so an attractive asset. And now you have Thoma Bravo coming in and paying, yes, 11 times forward for the asset, more like 14 times next 12 months, which is actually a huge premium to where the current cloud index is trading, more like 7 or 8 times. So nearly double what you're seeing the average SaaS multiple these days. So I actually think this is a harbinger of things to come. In fact, I've chatted with some of my friends in the M&A space who tell me that this is the first of many deals that are coming. There's a lot of others that are being discussed at the moment. And you have both private equity and strategics looking at these assets and licking their chops.
So if investors want to look for the next, say, Anaplan, another potential target, what should they be looking for? As John sort of laid out, there's a lot of different views towards valuations and where they should ultimately settle.
You know, I think first off, you look for growth. And you're going to see growth across many, many different areas of software right now, whether it be security, cloud infrastructure, SMB tech. There's just growth almost wherever you look. So that's the first thing. Second thing I'd say is margin structure. And a lot of these companies trade at very high margins. That attracts PE. And the third thing, and public investors have caught on to this, looking at retention rates. So gross retention and net dollar retention are huge and important with respect to the lifetime value of software. And a lot of these companies are showing very high margin and also excellent retention rates, with net dollar retention rates in the 115, 120, even 130 range. And that just means that dollars gained today are going to be worth more in the future. And I think that's why private equity and strategics are excited about this asset class.
Glenn, I wonder, is any part of their calculus the idea that there can be better cost control, better cost discipline? And if so, how are they going to do that in ways that the company couldn't do on its own?
Yeah, I think for the Thoma Bravos and Vista equity partners of the world, there is part of the story is cost containment and also consolidation. Oftentimes they'll buy assets and then, as John mentioned earlier, they'll continue to add other assets and grow a bigger company that way. But really, the name of the game these days is not so much about cutting costs. It's about not investing as aggressively in the next leg of growth. So I don't think you're going to see massive layoffs at these businesses. In fact, in software, one of the challenges is right now, there's just a labor shortage. And no matter where you go around the world, and these companies are all sourcing labor outside the US, it's just every market is getting more and more expensive to hire people and retain them. And with stock prices down, equity as a component of people's compensation is going lower. So I actually think you're going to see expenses continue to stay steady or even rise at the average software company because of that. But it doesn't really change the fundamental picture in my mind. Margins are super high, retention rates are high, and growth is high. That ultimately leads to great long-term value.
Yeah, Glenn, I want to go back, though, to the buyer beware portion of this, because you mentioned, I think the cloud index is trading around 7 or 8 times. That's about what PE, on average has been paying. So there's no room for a premium there right now unless some of those fall further. And the higher quality ones that PE is going to want to buy out arguably are not going to fall as quickly. So isn't there some danger that things do need to go lower before that valuation floor, right, that private equity would put in really kicks in across the board?
Well, now you have a data point in Anaplan that kind of flies in the face of that argument. And while Anaplan is a terrific company, there are many more like it, John. So yes, I would agree that historically PE firms have been anchored in that range that you mentioned, and maybe that's about where the median software stock is trading today. But that means that they're, half or above, and there's a lot more quality out there in the form of higher growth, great margins, great retention. And so, and many of these companies have really, really big markets they're going after as well. And I think the PE firms, and importantly, the strategics, recognize that. And so, while PE firms just buying for price are going to stick, I'm sure, to lower multiples, as I said, what I'm hearing from friends in the M&A space, there's more deals coming, and I'm sure those deals are not below the median price. So I think we'll see more above median, the current median, suggesting that people see long-term value. The buyers see long-term value, both in PE and in the strategic category.
Yeah, Glenn, if we continue to see it, it'll make for a fascinating next few months to see who does get bought up. Glenn Solomon, thank you so much. We'll talk to you again soon.
Thanks for having me.
Let's turn now to Coinbase. Short seller Jim Chanos unveiling a new bet against the crypto exchange, calling the platform a bubble stock that's being sold on a story during an interview on Closing Bell Overtime on Friday. Take a listen.
We think that as competition increases in crypto, and this is not a call on crypto or Bitcoin prices or anything like that, but we think as competition increases amongst the exchanges, you're going to see fee compression. And as it is, Coinbase will probably not be profitable this year with a $40 billion market cap.
Chanos also saying Coinbase is over-earning compared to its competition, shares down 30% for the year. And on the heels of those comments, Bank of America initiating coverage on crypto bank Silvergate Capital this morning with a buy rating, a $200 target, calling the stock an alternative way to get exposure to digital assets, saying it's well positioned for the expanded use of stable coins. So, of course, with all that crypto stuff, Dee, I'll turn to you first. Chanos makes a pretty decent argument that $40 billion is quite a market cap for this story. But if you believe that Coinbase is more than just a transaction play, that it's kind of the Google of crypto and digital commerce in the future, he could get burned.
That's right. If you believe that they can build an NFT platform, if you believe they're going to have success with DAO tools, maybe. But I think that what Chanos pointed to is super important here. It actually goes back to, I recall our interview a few weeks ago with Binance CEO CZ. He talked about those transaction fees. Yes, they're going to come down. He also talked about what he called a hidden fee, and that's the spread that many of these platforms make when they're buying and selling Bitcoin. You buy, a fraction of a Bitcoin. You don't really know exactly what price you're getting it at or selling it at. It's up to the platform. So that is going to narrow, Carl, as the market becomes more efficient. And I think that's what Chanos was talking about, is that the crypto market, as it's maturing, is actually becoming more efficient, and there's less room for the Coinbases of the world to make that kind of spread.
Yeah, you got better price discovery on one hand, and obviously the platforms will argue fee diversification on the other hand. We're going to watch that closely, but fascinating comments from Chanos on Friday. Meantime, moments ago, the SEC released some new proposed rules on climate risk disclosures. Our Diana Olick has that. Hi, Diana.
Hi, Carl, and they are meeting as we speak, getting ready for a vote. But in a statement, SEC Chairman Gary Gensler said this would provide investors with consistent, comparable, and decision-useful information for making their investment decisions and would provide consistent and clear reporting obligations for issuers. Now, companies would have to disclose their climate-related risks and how those risks would impact the business strategy and outlook. That includes weather events, of course, and their governance of climate-related risks and risk management processes. They'd have to disclose their own direct and indirect greenhouse gas emissions. Those are known as scopes 1 and 2. Some companies would have to disclose scope 3, which are emissions from supply chain and climate and clients, only if they are part of a broader goal like being net zero by 2050. And all of that is not including offsets. They'd also have to disclose their internal carbon price if they use one, and information about how that price is set. Also information about climate-related targets and goals and transition plans, if any. Now, there would be phase-in periods starting in fiscal year 2024. As of now, just 43% of the nation's largest public companies disclose Scope 1 and 2 emissions data. So this would be a pretty big deal. Back to you guys.
Yeah, it would. Diana, thanks so much for bringing that to us. And later this hour, Verizon CEO Hans Vestberg is with us. Tech Check is just getting started.
Disney employees planning a walkout tomorrow over the company's response to Florida's so-called Don't Say Gay bill. Disney meeting with staff today as pressure builds on CEO Bob Chapek. Our Julia Borston has all the latest. Hi, Julia.
Hi, Carl. Well, ahead of that walkout scheduled for tomorrow, today at 1:30 p.m. Eastern, 10:30 a.m. Pacific, the company is hosting a virtual event to address that Don't Say Gay bill and how Disney has handled it. Now, this is part of Disney's regular Reimagine Tomorrow event series that addresses issues of inclusion and representation. Now, this invite, which we obtained from a source at Disney, saying that the conversation will address how does the Don't Say Gay bill and other pending legislation impact LGBTQ plus kids and families, and what will it take to rebuild trust with our employees and LGBTQ plus communities. Now, the event was moved up from tomorrow, so, quote, as many employees as possible can participate. That's referencing the protest walkout that is scheduled for tomorrow, starting in the morning. And this all comes after CEO Bob Chapek faced criticism and concern from senior leaders across the company's studios around its handling of the bill. And a range of those company's leaders have hosted town halls and meetings to hear their employees' frustrations. There was also a group of Disney Imagineers that asked the company to reverse its plans to move their team to Florida. Now, amid that conflict, my colleague Alex Sherman reports on CNBC.com about the serious rift between Chapek and his predecessor, Bob Iger. So we'll learn more on what's next for Disney coming up from this meeting that is scheduled to start in just a couple hours. Guys?
Yeah, Julia, thanks. And we got to recommend, of course, that Alex Sherman piece. I wanted to ask you, this controversy over Chapek's handling of that Florida bill up against how he handled Scarlett Johansson and, you know, that blow up that certainly didn't make Disney look too good. It's like he's got some issues both on the high profile actor front and now on the rank and file front. When's the last time we saw a Disney CEO facing this level of employee or worker criticism?
Well, look, I have never seen this amount of employee criticism just in terms of the amount of incoming phone calls and texts I've been getting from people at the company that are expressing their concern to me as sources at the company. But what I would say is the Scarlett Johansson issue was a very unusual one. And that Scarlett Johansson issue really spoke to the transition that the company was making from being about a theatrical release company to one that was really prioritizing Disney Plus and the other streaming platforms. At issue, of course, was how it handled that and whether it could have done more to address the concerns and the payment that was going to go to its biggest stars. We did see a somewhat similar issue when HBO Max was getting the first release movies from Warner Brothers. Now, what was interesting there is there was a blow up. Warner Brothers and Warner Media ended up paying out the stars of those movies that were going to be going straight to HBO Max at the same time they were in theaters. That did not escalate to a lawsuit. So this is different. What happened with Scarlett Johansson was different in that it escalated to the lawsuit. So I think that the conflict, especially when it came to that Scarlett Johansson issue, was similar to what other studios faced. But the fact that it went that far and it did become a legal issue does speak to the fact that Chapek does not necessarily have the same types of relationships with talent as maybe Bob Iger did. That issue may have been resolved with Scarlett Johansson, but what's happening right now is very different. It is really a cultural issue and one that many employees of the company seem to be very concerned about.
Indeed, sometimes leaders can emphasize the strategic goals, but perhaps not see the people-driven consequences of doing that. Julia, thank you. Now let's turn to inflation. Our next guest says this and supply shortages might be weighing on the sector now, but he expects a rebound in the second half of the year, the sector being semiconductors. We've got NVIDIA's annual meeting tomorrow where we'll get more details from them. And joining us now, Baird senior analyst Tristan Guerra. Tristan, good to have you. So you've got a buy rating on NVIDIA, but also on Intel. And an outperform, I should say. And also, I believe, a hold on AMD. That's kind of unusual. Explain.
Yeah, well, first, we're constructive on the cycle. You know, you've mentioned our views about the second half, and we do expect a reacceleration in trends. But even so far this year, we're seeing, very good order trends ahead of typical seasonality. Intel, the outperform rating is really based on the belief of a longer term turnaround story. It's a big company, so it's not going to happen overnight. We think the gap in performance between their chips and that of the competition is narrowing. They've actually more or less closed the gap in PCs. They have still a lot of work to do to catch up with AMD in data center. But it's also a value name, and given the highly volatile environment, we think that this is a name that is going to hold better than average on a relative basis. And we think they have finally the right management team in place with obviously an exceptional CEO.
Well, how should investors balance some of the criticism that Intel has faced over its foundry strategy against the demand that we're seeing for not only semiconductors in general, but regional locations of fabs, given geopolitical tensions? Does that kind of affirm Intel's strategy, and how much doubt do you have about their ability to execute?
Well, you hit on a on a very good point, which I think is absolutely not in Intel's valuation right now, and which is obviously about the geopolitics. And I think, being 100% reliant on Taiwan and the TSMC supply chain 5 years ago was maybe a light concern in the back of the mind of people. I think now, given the geopolitical event, it's becoming much more of an urgency to have at least a plan to diversify manufacturing. And Intel really is going to be the only foundry based in the US that's going to be able to provide leading node technology to companies. And I think the big difference relative to Intel's initial push a few years ago is that now they have a whole team in place. They've actually acquired a smaller foundry company that's going to give them a lot of know-how. And also they're developing a product with customers as opposed to just going to companies and say, hey, we can build a product for you. So I think it's this joint effort that's going to make really a big difference in terms of the company succeeding in that strategy and fill the fat.
I mean, yeah, Tristan Gelsinger has laid out some very bold ambitions, but they still have to execute on that. You sound more optimistic, but why not look at, say, Global Foundries that already is in the foundry business and could maybe expand it?
Yeah, well, we haven't outperformed on Global Foundries, and I think notably the past few days, stock action really reflect the consciousness that investors are, looking now at how geopolitical matter and how US-based production is really going to be an asset. So Global Foundries is really focusing on the 12 nanometer and above type of geometry node, which, by the way, is about 2/3 of the entire production of semiconductor. So Intel is really complementary, targeting leading nodes for companies that need, 10, 7 nanometer and 5 nanometer over time. And again, it's not going to be a overnight turnaround. But we do believe in Intel's capabilities. And I think it's also a matter of survival for Intel, because I think that the model of just selling their own chips for their own end market isn't going to be enough to subsidize the very heavy manufacturing investments that are required as we continue to move into new geometry node. And it's this diversification in terms of customers that's going to benefit Intel over time, in our view.
Tristan, thank you. That's a great setup for the challenges for the industry in general ahead. Tristan Guerra from Baird. After the break, headwinds for the ride-sharing industry, Uber and Lyft falling this morning. Stay with us.
Welcome back to Tech Check. I'm Carl Quintanilla with John Ford, Deirdre Bosa, and Julia Borston. NASDAQ's turning positive this morning, was on pace for its first down day after 4 gains. We'll see if it can go for 5 here. In just a moment, Verizon's Hans Vestberg is with us, the company expanding its 5G service. But first, a news update with Rahel Solomon. Hey, Rahel.
Hi, Carl. Good morning. Here's what's happening at this hour in southern China. Hundreds of rescuers have been responding to the crash of a China Eastern Airlines flight. The plane was a Boeing 737-800. 132 people were aboard, including 9 crew members. No word yet on fatalities or injuries. Flight data indicates that the jet went into a deep dive and then quickly crashed into a mountain. NASA satellite data shows a massive fire at the crash scene. It's Warren Buffett's biggest deal since 2016. Berkshire Hathaway has agreed to pay $11.6 billion in cash for Allegheny. The New York-based insurance company and its units will operate independently after the deal closes. Berkshire already has several insurance subsidiaries. And Kohl's says today that it has received multiple acquisition offers, but the department store chain says that the preliminary proposals are non-binding and don't have committed financing. CNBC has been told that Hudson's Bay, the Canadian retailer, is one of the potential bidders. Carl, I'll send it back to you.
All right, Rahel, thanks so much. Rahel Solomon. As we mentioned, NASDAQ's gone positive, up big last week, but can investors trust this bounce? For that, we're going to turn to Mike Santoli. Mike, as we see close to 44.75 here and VIX at 23.
Yeah, so building a little bit, Carl, on last week's rally, when it comes to the NASDAQ 100, pretty dramatic, I would say, interruption of the downtrend without fully reversing it. I think that's why we are at a decision point here. It's not as in good a shape as the S&P in the sense of how much of the correction losses have been regained. It's more like 35-40% of the peak to trough decline has been recaptured. Also, you can't see it here, but the 200-day average literally goes right there. We closed on it basically on Friday. So that's a natural point to pause, and it's another test for the upside as we did see, of course, downside leadership from the big mega cap tech groups. Take a look at some of the more speculative areas of the markets, the ones that peaked almost a year ago, if not more in some cases. They have also had very violent bounces. A lot of talk about how last week was really dramatic in terms of the most depressed areas coming back. Well, that puts it in context. Last week's rally, you got a lot of these stocks up 20-30% in IPOs, cloud, online retail, all this stuff. But you see that it's really a challenge to try and reverse that. So I do think that, arguably, if you're bullish on this move and you feel as if the market has told you it's put in a low for now, this is a kind of area with a lot of beta that still could go up a fair bit without even getting out of technically, a bear market. So I think that's where a lot of the work is being done as people debate the fate of this bounce.
All right. Mike, looking in the rearview mirror just to last week, what happens to the concerns last week about high yield? Does that just dissipate with better equity action?
Well, it actually firmed up, so I think that it sort of came off of the front burner in terms of things to be super concerned about. It's not necessarily recouped all of those losses in high yield, but it definitely did, I think, sort of improve enough that you saw a loosening of financial conditions in general, with stocks up, spreads tightening, VIX down. So, this could be a respite. It could just be the market kind of catching its breath here. But it seems as if we didn't get anything disorderly to the downside. And I think that's, somewhat encouraging, even though you did have a couple of high yield offerings pulled because they didn't like market conditions, Affirm and others. So whether that's sort of a tell that the market was, showing some discipline, or it means it's going to be less generous from here on out, we don't know.
Yeah, so Mike, last week when we saw this massive rally, it was in a lot of that unprofitable tech, even the meme stock names. And, some say that that's hardly the foundation for a solid market. But I think I heard you speaking earlier today about seeing some of those higher quality names come back today.
Right. So, Dee, I agree that you don't only want to see the lower quality, really depressed stocks be the only thing that's showing some relief. Arguably, there's room to have things like, the Apples and the big software, the big profitable software names. Adobe was one that was mentioned, that maybe they've just had enough of a valuation adjustment, and that's all you needed for them. You didn't really need them to prove their business model. You just had to decide how much the market was willing to pay for that stream of earnings.
Mike Santoli, thank you. Up next, Verizon CEO Hans Vestberg is with us and breaking some news. Tech Check is back in just a moment. Welcome back. Let's get over to our Julia Borston, who has some news this morning. Julia, over to you.
Thanks, Deirdre. That's right. We're going to be joined now by Verizon CEO Hans Vestberg and Live Nation CEO Michael Rapino as they announce a 5G technology partnership. And included in the partnership, which is pretty wide-ranging, Verizon will be outfitting venues across the U.S. with 5G ultra-wideband, so concert-goers can stream, share photos and videos, and download content at much faster speeds than 4G. And there is a new First Access program that will make millions of tickets to Live Nation tours available to Verizon customers via the My Verizon app, also giving access to select streaming concerts. Joining us now to discuss that and more are Michael Rapino, CEO of Live Nation, and Hans Vestberg, CEO of Verizon. Thank you both so much for joining us this morning and breaking this news on Tech Check. Michael, let's start with you. What does this partnership really mean for Live Nation's bottom line?
Well, first of all, thanks for joining, Hans, and appreciate us having us on. Hans and I have been talking for over a year now about the ways we can use his great new technology, 5G, to finally empower all of our venues and shows. As you know, when you go to a concert, it's 50-50, whether you can find a reception, whether you can post a picture, whether you can phone your friends. So the idea now that all of our venues will be lit up with this very efficient 5G, it's just going to make it so much better for the fan, whether they just want to post a picture, TikTok, or we can now start figuring out ways we can engage with that customer on site, from upgrades to special merchandise to special access.
Very interesting. Now, Hans, give us your perspective. In addition to just having this be part of the broader rollout of 5G, what does this mean in terms of your relationship with Verizon customers? Why is it important to give them early access to either ticket sales or streaming? And do you think that'll help pull over customers from rival mobile carriers?
First of all, thank you, Julia, for hosting us here. Michael and I have talked for a long time, and this is actually an extension of our partnership. And clearly, what we see in these type of venues, the importance of connectivity in order to be part of the immersion experiences. And our strategy has been all the time to be on those places with a iconic sort of music or live sports. And Live Nation is, of course, the iconic brand here that we're working with in all the concerts and theaters they have across the country, to see that they have a really good technology as a platform. And from that platform, we will then start together, innovate new fan experiences, new ways to actually consume this fantastic music or whatever it is in these concert places. So that's one piece of it. The other piece, of course, the trend that we see happening in the market, that's, of course, going direct to the consumer, either us to the First Access, where we will offer millions of tickets to the more than 100 million consumers we have as a First Access, which is a great opportunity. We have already seen that because we already launched the first batch of it, and enormous demand from our customers. And then finally, of course, working with Michael and his team when it comes to their direct-to-consumer, Weeps, their streaming service, which you know we have worked with many others like Disney+, Discovery+, using our platforms and then innovate together with a partner like Live Nation. That's what we're doing here today. So it's just a great way to see that fans, our customers, and the people experiencing this getting an even better experience.
Michael, great to have you. Good morning. It's John. So I've got mixed feelings about smartphones at concerts. I mean, yes, they're great and everything, but have you quantified the financial value of streaming video and digital images on social media as marketing for live events? And how does 5G perhaps change the calculus if you have? Does it make live events easier to market, even if people maybe in the moment are paying less attention to what's in front of their face?
Yeah, it's a great question. You know, we kind of look at our fan as the promoter. You know, the great part about the concert business is it's a Kodak moment. Everyone has to post that moment when they're there. It's a special moment in their history. So you are right. If you're on the first Harry Styles concert in New York and 20,000 people are posting and reposting, and I've still got 70, 80 shows to sell throughout the world, that momentum every night of Instagram, social, TikTok, all the ways those fans are helped spreading the word is incredible, valuable marketing to us. We've been talking about this for years on how the customer really takes the show to the consumer for us. They are our best word of mouth advertising, and that has provided us billions of impressions around our shows and our experiences, our festivals. This just highlights it and unlocks it to a full level now.
Hey, Michael, it's Deirdre. In that vein, I wonder, though, who owns the customer? Earlier this year, you said that live streaming is a complement and promotion to the core concert. I think that's what you're saying now. But I wonder, is big tech looking at it the other way around? And could that potentially be a threat to your business? I mean, on a virtual platform, artists are able to reach millions of more viewers. They're able to interact in a different way. So how urgent is it for you to sort of build up these tech and virtual tools to own the customer?
Yeah, I want to define, though, the physical event is the magic, right? The 2 hours that you go live down to MSG to watch that show, that's the non-duplicatable part. So that's the part we've seen over, obviously, through COVID and now roaring back. That's the part you can't get online. You can't get through your TikTok video. You got to be live to make it happen. So that's our magic sauce, the 2 hours. Now, any ways that we can take that 2 hours and help market it, enhance it, complement it, we think that's great for our business and our fans and for the artist. So we think these extensions, marketing, adding value to the show are great extensions. The 2 hours, though, still is the money shot that has to happen live to get the goosebumps.
Now, when you talk about extensions, I think it's notable that in this press release that just went out, you also talk about augmented reality features and also NFTs. NFTs, Hans, that you are going to give the opportunity for Verizon customers to acquire. Tell us how this is going to work or how this could fit into a broader strategy with NFTs.
No, the broader strategy is clear. First of all, I just want to echo what Michael is saying. Remember that the uplink on 5G, when you send up data, when you send to TikTok, etc., the limitation is basically on any technology except 5G. That's why we saw at the Super Bowl that people can send up everything if they are on 5G, and that's what we're going to do in the venues as well. And we need to understand that this youth, this fan base, they want to do different things at the same time, using the phones, looking the visuals, but nothing will replace a real concert or a real live sports event. That is really the cream of the premium when it comes to being live. But you can replicate it and be ambassadors for it, and that's what we'll create. On top of that, then of course you can start creating immersive experiences, which we did together with Michael and his team during the halftime show at Super Bowl, where you basically have 8K cameras behind the whole event in the halftime at Super Bowl, and you can access that. You can be wherever around these players or these rappers, and that's what you can do. And then you can create NTFs on that. You can do a lot of things. So this platform that we are putting in, that is really where you start doing innovation for the fans experience, and there are multiple things you can do, and that's also when NTFs comes in the whole picture for us. So I think we have built a Verizon Intelligent Edge network and our Ultra network for Metaverse, even though we didn't know a Metaverse was actually existing when we started with the network.
Yeah, certainly an advantage to have that kind of broadband. I want to take a step back from the news of the day and just look at what's going on more broadly in the economy right now. Obviously, there's inflation, there's economic uncertainty, certainly which has a bigger impact in terms of Live Nation and what's going on in Europe with the Russian invasion of Ukraine. And I'm wondering if both of you, and I'm going to start with you, Michael, can give us a sense of what these different factors are doing to your business outlook. Michael, I know when in February you gave a very bullish outlook for 2022. It was before the invasion of Ukraine and also before some of these inflation indicators spiked. What are you seeing right now? Are you any less optimistic than you were a month ago?
Well, first of all, thank you. And obviously what's happening in Russia, Ukraine is horrible, and we're doing everything we can to support and see how this plays out. We are, unfortunately, we don't have a lot of shows in that area, so that hasn't really affected our business. Europe seems to be business as usual right now for the summer. So we haven't seen any disruption in our core business around the world in terms of touring. We don't see the inflation affecting us yet. I think we've talked about in February, we had such a 24-month shutdown that the pent-up demand is so big right now for the customers this summer. We're still tracking 30% plus up year over year. We're seeing consumers buying tickets on sale this weekend. We had sold out festivals this weekend. So I do believe that the pent-up demand over the last 2 years is going to power through any short-term inflation issues. Tickets seem to be flying out of the door, both from the front seat to the back. So we're looking still for a record 22 across the globe.
And Hans, I would pose a similar question to you. What's your sense of the impact of inflation on consumer spending and the kind of activity you're seeing among your Verizon customers?
First of all, I can only agree with Michael. It's horrible what we're seeing right now in Ukraine and all of that. And we decided to waive any calls and text to Ukraine for all our customers in order to see that they can communicate. And of course, we have a consumer-based business only in the US. And if you look at that, there's so far no impact from what's happening in Europe on that consumer base. Of course, we have the inflation, but one thing that has happened in the last 2 years is that the mobility, broadband, and cloud services is essential infrastructure, essential services for each and everyone in these countries. So of course, when we now, for example, launched our fixed wireless access as a broadband solution, we have seen a great demand for that. Our mobility service continue to be very strong. So I think that this is essential today to operate your business in this hybrid world, because that's where we're going to live, where people want to work from home sometimes or being on the road and seeing that technology works. So actually we see a good demand for our business, that pooled with, of course, all the new offerings. And recently this morning, I have to say that we also launched that we are pulling in more spectrum earlier. We are actually clearing the spectrum 1 year ahead, more spectrum, so that we're going to launch some 30 more markets this year, which is already very vast on our 5G ultra wideband network. So now we continue to pull through. We're going to follow what's going to happen, of course.
Well, thank you so much for the business updates from you both, and also for breaking the news of your partnership here on Tech. Hans Vestberg, Michael Rapino, thank you both so much for joining us. And John, I'm going to send it back over to you.
Julia, thanks. Now, as you head to break, check out Tesla. Jeffrey is slashing its price target from $1,400 to $1,250. That's still more than 25% upside from here. Concerned about valuations taking a hit from the current macro environment and geopolitical tensions. We're back in a moment.
Time now for a gut check on the ride-sharing companies. Uber and Lyft, RBC cutting price targets and saying driver supply has worsened for both companies. Take a look at Uber. RBC worried about equalizing market share and decreasing margin upside potential. They are maintaining their outperform rating, but the price target falls from 65 to 50. That's just a few bucks above the IPO price. As for Lyft, still rated outperform, but a much shallower cut from $53 to $50, again below the IPO price. Concerns over rising driver incentive expenses fueling this call. Shares are down sharply to start the morning, more than 4%. We will be right back.
Welcome back. Amazon notching yet another tactical victory on the legal and regulatory front. On Friday, won a dismissal of an antitrust lawsuit from the Washington, D.C. Attorney General. The suit said Amazon made products more expensive for consumers by demanding that sellers offer their lowest prices on Amazon. The AG's office considering an appeal. This comes on the heels of Amazon's MGM acquisition being approved, sort of by default, that deal closing last week. Overseas, a different story. Europe's Digital Markets Act is expected to be finalized as soon as this week, and that law would give regulators broad investigative and punitive powers, according to the Financial Times. Big tech firms, including Amazon, already preparing for the worst, including the creation of a new compliance unit. Dee?
Yeah, John, that headline up on the screen right now says it all. Europe has proven to be the regulators with teeth when it comes to big tech. We're going to head to a break, but don't forget to follow and subscribe to our podcast to listen anytime, anywhere, wherever you download podcasts. Tech Check is back in just a moment.
That's our one more thing today. The messaging app Telegram has been banned in Brazil. The country's Supreme Court ordered Apple and Google to block the app over accusation of misinformation and not complying with court orders. The CEO says it hasn't been complying because Brazil's Supreme Court has been sending those orders to the wrong corporate email address. Telegram says it's been inundated with takedown requests in the last few weeks as it became one of the primary ways people within Ukraine communicated, including President Zelensky. We're not perfect, John, but a lot of times we take for granted the efficiency of rule of law in this country, that's for sure.
That is for sure. And it looks like the ban was lifted after that email misunderstanding got cleared up, according to this report in the New York Times. We talk about all these highfalutin things like finance and money moving without friction.
Yeah.
Messages still need to move without
I just want to know,
friction.
Carl, were there receipts? I need to see the evidence that this was sent to the wrong email address. You can doctor these things these days.
Yep, that's difficult to verify a lot of stuff that's online. Guys, interesting week. Powell has been moved to 12:30. We're going to have our eyes peeled for comments, whether or not he takes some questions and adds additional color to his comments from last week. And of course, Nike tonight as earnings season continues to trickle along. For the time being, Dow's down 166. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Bear market bounce or a rally to rely on? It really is the most important question for your money right now. We debate that answer with the Investment Committee. And joining me for the hour today, Shannon Saccocia, Steve Weiss, Joe Terranova, John Najarian, the co-founder of MarketRebellion.com. Let's take a look at the markets. 12 noon in the East. Dow is down. A lot of that has to do with Boeing. You see the S&P is higher, as is the NASDAQ. And there is the yield on the 10-year note, 223. So rates are moving higher today. Oil's up. As Carl said, a bunch of Fed speakers today, including the chair himself. The Atlanta Fed president already speaking today. 6 rate hikes is what he sees. That, of course, is in the market. That's what the market expects, Shannon. So answer the big question. Is this a reliable rally or simply a bear market bounce?
Well, I don't know that we can rely on it just yet. I do think that over the next couple of weeks, Scott, we are going to see some rotation back into equities and particularly into U.S. equities. Just think about where we started the year. If you had a traditional 70-30 or 60-40 portfolio, you're definitely off that mark for your equity weightings now. Many people came into this year bullish about international and emerging market equities, and although they'd had a nice rally last week and recovered some ground, there is a little bit of skittishness in terms of what the potential spillover from the situation in Ukraine could be on Europe in particular. Think about supply chain constraints. And so I think over the next 2 weeks, I do think we start to see a little bit of excitement about U.S. stocks again that could go down into small cap stocks as well. That might not just be limited to large caps. But I think in terms of sustainability, I think we want to make sure that there isn't additional spillover from a geopolitical perspective. I think 5 rate hikes sounds a lot better to the market than 7 rate hikes. But I also think that you're seeing in the curve, in the bond market, you're seeing some concerns about recession. You're seeing the flattening of the curve. You're seeing concerns about growth. If we're back to, say, 3% growth from a GDP perspective by the end of the year, that's actually not that bad compared to where we were pre-pandemic. And I think people are getting overly concerned about growth in the market, but I think this next 2 weeks probably looks a little bit better. We might see some skittishness as it relates to the geopolitical situation as we go into the summer. Most importantly, CPI, PPI. We saw PPI get a little bit better last week. I think that's what we need to see is continued improvement, that the trend in inflation is coming down, energy prices fall below $100 a barrel on WTI. Then I think you get that inflection point, Scott, for the markets in the second half of the year.
Doc, there's the interest rate complex today, 202 on the 2-year. Only 21 bips behind the 10-year at this point. What are the options traders betting on, Doc? What are you seeing in terms of being able to answer the question of whether the rally is reliable or if it's simply a bear market bounce that feels great but is soon to evaporate?
Well, Friday, Scott, you and I talked about the LQD. That's, I think we talked about it. That was the high yield, the corporate high yields, and they were buying downside puts in there at the 118 strike with that at about 121.5. We've dropped back down into the 120 level for that LQD. And so what is that telling us? That's telling us that people are anticipating higher rates for everybody, corporates as well as Joes and Janes. Obviously, mortgage rates had a pretty big jump last week, and maybe that's an understatement, pretty big jump. And that may start to erode some of the gains that we've seen in housing as they become less affordable to those that are seeking an 80-20 traditional kind of mortgage, 20% down. And I think overall, though, Scott, Shannon's right. The market is sanguine. The market is feeling, just sort of even-handed right now. An awful lot of our equities, I'd point to, that are owned by overseas players. The United States is lucky that we have so many investors from overseas, both institutional and public. I mean, I believe that the last count I saw, which unfortunately was 2019 to 2020, Scott, showed that almost 40% of our equities are owned by overseas entities. The reason that's good is that these people are not looking to put that money back into Europe, and certainly not looking for some of the war-torn areas of the world to invest in. They're instead hunkering down in our equities, and I think that continues to sort of be that floor, if you will. It's not the same as a Fed put, but I don't think those folks that are in there for anything but the long term at this point. I think Europe has proved to be sort of what we've said all along. You don't have the liquidity when you want it or need it in Europe, but you do have it almost 24/7 in the United States.
All right, so Joe Terranova, Tom Lee today says bad news is priced in. Oppenheimer's Ari Wald says swinging away from pessimism. He sees near-term upside 4,550 to 4,600 on the S&P. I mean, what a difference a week makes. The kind of conversation that we had a week ago today was like, how low are we going? And now we're asking questions as to whether you can rely on this big move that we've had in the market. Lori Calvasina at RBC says, well, stocks aren't exactly cheap quite yet. However, the contraction in the S&P and the forward PE has been significant. Can you believe it?
So I think where we are right now, if you could give me a couple of closes above 44.71-ish, which is the 200-day moving average, that's going to get you, from a technical perspective, probably another 75 handles higher in the S&P. I think that's the immediate direction. The question then becomes, what are the stocks that I want to put inside my vehicle that's going to carry me towards that level in the S&P? And I think that's where, Scott, you go back to fundamentals. Ask yourself the question, have the fundamentals, has the risk profile for a lot of the hyper-growth, non-profitable technology and consumer discretionary names improved just because the market has bounced? Without question, the answer to that is no. So there you have your bear market bounce. What you want to be doing is focusing on companies where the fundamentals, you had a technical deterioration, but the fundamentals weren't that bad. Were the fundamentals that bad for energy and agriculture and some of the mega cap equities, or in financials, some of the insurance companies or the asset managers, or in healthcare, some of the medical devices? No, they were not. And those are the places that I think at this stage of a technical bounce, you want to be focused on. There's just too much risk to incur trying to stay with a lot of these stocks that have bounced and really have extreme valuations. Because guess what? Rates are going to keep moving higher. Inflation's not going away.
Now, Weiss, Krinsky had been asking the question, when we were trying to figure out the answer to the question of whether this is legit, whether it's just a bear market bounce. And he had been pointing out almost every day last week that you really never had that big flush that he was looking for, that you've experienced in prior correction cycles, to be able to really definitively, as much as you can ever do that, declare that the bottom is in. So where does that leave us as we enter a new week, Steve, after the kind of comeback we had from Monday to Friday of a week ago?
Look, I still think a tone of caution is warranted here. It's kind of arrogant, as I see it, for all these bulls to come out and say, oh, all the negatives are known, all the negatives are known. It's like if you're bearish or if you're cautious, you don't have the capacity to think of what the positives are. Eugene Fama, who has the efficient market hypothesis, which I'm not sure I agree with, says everything's known all the time in the market. So then the question is, and this I agree with, what are the issues going forward? And those are the issues that are keeping me from putting more money into the market. And particularly China, if you read over the weekend, they're still dead set on going after Taiwan. I don't know if it'll be next week, next month, or in 2 months. But that's not Russia. That is a huge global economy that impacts the U.S. I don't believe you're getting paid for that black swan event by investing in the market.
Well, so what are you going to do? You're going to sit on your sit on your hands? You're going to sit on the sidelines until you get more clarity on that issue? What if it doesn't come?
Well, if it doesn't come, then first of all, it's going to be an overhang. I'm not sure it doesn't come. But if you want to ring a bell, like Krinsky wants a bell to be rung, essentially, and say, okay, we've had the big flush, now all is safe, the market doesn't ring bells. I'd love for it to. But if stocks continue to get cheap, like Volkswagen, add to it at 4 to 5 times earnings. I don't care what happens. That is a great buy. FedEx, 10 times, that's a great buy. So there are places to put money to work. But the way I look at it, that's not the only negative. The other negative is stocks go up in a rising rate environment. We've seen that.
Yeah.
History shows that can happen. But they don't go up when earnings are coming down. And in my belief, with what we're seeing with inflation and the input costs, that earnings are going to be coming down because margins are going to be getting hit. So that's why I'm cautious.
Okay, you know what? Let's do this then.
That's where the puck's going.
Let's do this. Let's leave it on that note because it's a principal point that our halftime headliner today, Brian Belsky of BMO, he's the chief investment strategist there, is making to counter that view. Brian, you know, he says, Steve does, earnings are coming down. Earnings are coming down. That's one of the principal reasons to be negative on the market. Earnings come down. The multiple needs to come down further. And I looked at your notes today, and you make the argument that it's exactly the opposite.
Good afternoon. Steve also made the argument that it's arrogant to be bullish. I think you have to have faith to be bullish. It's arrogant to be constantly bearish and constantly fear-filled and constantly rhetoric-filled and constantly macro-driven. The stock market is a market of stocks. You can't name 2 or 3 stocks because earnings are going down there and apply it to the 500 stocks in the S&P 500. In fact, if you actually do the work and do the math over the first almost 90 days of 2022, earnings projections for the S&P 500 on a bottoms-up basis, the number is increasing. Nobody believes it because nobody's done the work, Scott. They're applying it to a couple of stocks that
You're the only one
that's publishing on it. I'm the only one that's published on it, Scott, because people don't want to be controversial and dig into the numbers. You've got analysts and strategists lowering their forecasts, and I just think it's too early. And we will adjust our forecast if we see something fundamentally changing
When? After
for the
it already
second half of
turns
the year.
lower?
No, Scott. No, you don't downgrade your forecast after the market goes down. You downgrade your forecast after a rally. That's number one. Number two is something that no one's talking about, is that Powell came out last week and said, hey, excluding the war, which I know is a reality, excluding the war, the Fed's forecast and the Fed belief was that inflation was going to peak sometime in the late first quarter. No one's talking about that. On a month-over-month basis, the numbers are already starting to see that, even with this spike in oil. And oh, by the way, oil is all over the place. It actually has more of a downward bend to it, Scott. So I just think that there's people making these macro arguments without actually doing the work. And that's why you have to be an investor in this. And that's why you will miss out on weeks like last week if you are fear-driven and rhetoric-driven and not doing the work.
Let me ask you this. Your S&P target's 5,300. Your earnings are 245. That gives me a 21.5 times PE on the market. You don't think that's a little bit aggressive in the kind of environment we're in?
I don't, because here's why. You're going to pay for stability. For the 75th consecutive year, it feels like, coming into 2022, everybody and their mother, brother, sister, cousin, uncle was bullish on emerging markets in Europe again. And I think that money's coming back and going to pay for stability in real growth here in North America. There's an old adage, when growth is scarce, growth outperforms. And I think there's going to be scarce growth in emerging markets and obviously scarce growth in Europe. And I think the money's coming back to North America, both Canada and the United States.
Okay. Weiss wants to get in on this conversation. Weiss, what do you got for Belsky?
Well, first of all, he was listening to a different Steve, because I said none of what he said I said. I didn't say to be, you're arrogant if you're bullish. I said you're arrogant if you don't think that somebody else can see the other side. And publishing a document has never determined whether you're a great investor or not. So I do the work. I talk to CEOs all day long, every single day, and they are concerned about inputs. We've heard it from many CEOs. So the fact you're coming off a good quarter with good guidance from companies doesn't mean that extends as inflation inputs stay higher, and that's what they're doing. That's number one. Number two, it'd be very difficult for the market PE to expand, as Brian's looking at. Forget about the ridiculous target of 5,300 or whatever it is this year. For the market, for PE multiples to expand in a rising rate environment, in a hyperinflation environment that we see now. The Fed has one goal. That goal is to slow down the economy. That is directly at odds with margins picking up. So I just don't see it happening. And I'm not always negative. I'm not always pessimistic. I'm realistic, and I focus on risk management, which is critical to staying alive in this business for over 30 years.
Belsky.
My retort is I've been in the business 32 years. I run $7 billion with a B dollars. The majority of our portfolios are outperforming this year, Steve, so I put my money where my mouth is. And I actually do think it's ridiculous to be this negative right now, and it's ridiculous to say that we're in a hyperinflation side. I think inflation is yesterday's story. It's not going to be tomorrow's story. And I think too many people, companies alike, are doing the supply chain inflation blame game, and they're going to continue to underpromise and overdeliver on their earnings, period.
I mean, 7.5% inflation or whatever it is not exactly light inflation. I mean, how else would you describe the environment that we're in? You've already made the case that you think inflation has either peaked or in the first quarter. So what do we got? 2 more weeks, and then we're going to have inflation start going down?
It's not hyperinflation, Scott, though, and we're going back to work. We're in the transition to normalcy.
Well, relative to what it was, it is. I mean, it's not inflation.
Well,
I mean,
of course
I don't know. It's
the
highest in 40 years. What is it then?
Well, it's not hyperinflation. It's not hyperinflation. And the structural issues can be unwound a lot faster, Scott, than when we had the oil embargo, Nixon freezing wages in the 1970s and paying off the Vietnam War in the 1970s. Again, that's when we had the hyperinflation, or even in the 40s post the World War II. So again, these are once-in-a-lifetime situations, especially given what we've gone through in the pandemic. Unfortunately, we have this terrible situation in Europe, which again could go away in a day. So that's why you have to be invested, Scott, and stop trying to time the market and try to figure out when all of this is peaking.
John Najarian has something for you, Doc.
Yeah, well, I think this plays to both Krinsky and to what Brian Belsky are saying as far as could we have already seen the bottom. On the 8th, Scott, we talked about that huge flush which occurred in the market when we traded down to whatever, 414 in the SPY, and or the spike in volume because it was one of the heaviest option volume days in weeks. Now, last Friday, we actually did see a peak that was just over that on the rally side, and I believe some of that's probably short covering. But as far as that, that flush at the bottom on March 8th, we saw one of the largest volume days of the year occur in options. So to both Krinsky and Belsky's point, that could be, they don't ring a bell at the bottom, but they certainly did really flush an awful lot of accounts down at that level. Again, about 414 in the SPY. So I think, Brian, that kind of speaks to your point that if that's the worst they could do, then perhaps we do see a pretty significant rally from here. I know over at Guggenheim, Scott Miner just said he sees 20% from here right at this level right now. He said that today. So I wouldn't be surprised to see some rallies, and then it'll just depend on news flow, Scott.
Belsky?
Scotty?
I mean, so you make the case it's reliable then. You think this is a real, reliable rally that has legs and that can last, and it's not a bear market bounce because you don't ascribe to the fact that we're even in a bear market, it sounds like.
I do. So I go back, and from my training from William O'Neill, who I learned the business 32 years ago, who was a wonderful technician. Technicians want to see this beautiful washout. Life isn't like that. The stock market's not going to like that. You don't get exactly what you want. If you take a look at what got hurt, the market has been very discriminating versus high multiple tech. They did its job. You had the NASDAQ down over 20%. You've got the majority, almost 80% of companies in the S&P down more than 10%, more than 50% of the companies down more than 20%. So the market's done its job. And now it's all about buying the right stocks, being in high quality, owning both growth and value, and again, buying the best franchises and brands in the world, which are right here in the United States.
But owning both growth and value, can you really own growth in the rising rate environment that we expect? And by the way, as we're having this conversation, and I cite him all the time, Jonathan Krinsky, who I mentioned earlier, just literally publishes a note into my inbox as you guys were speaking. While we're fully open to some continued strength, he says, into the spring, consistent with seasonality, we're not yet ready to definitively say the final lows have been made. Even if the bottom is in, there is likely to be a period of digestion, which means patience will be paramount. Talks about rates moving higher, commodities moving higher, value outperforming growth. So why can both perform well in the kind of environment that he just lays out and one that seems to be the base case?
Well, I think there's different types of growth, Scott, right? There's dividend growth, there's growth at a reasonable price, there's the consistent growth. That's not the high-octane growth stocks that really rallied in 2020 and 2021. I think that's the case to be made. The other thing that bothers me about those comments from Krinsky, and I know he's a wonderful technician, is, and one of my fears in the market, if you want to hear me say something negative, I think the market is completely dismissing what's happening in Europe. And we could have a very bad event, and the market could get hit very hard in a day or two. Again, there's lots of volatility in this, Scott, and the only way to combat that, I think, is to be more of a high-growth investor in both value and growth, but really tilt toward those companies that have very strong operating performance, consistent earnings growth, and oh, by the way, if they pay a dividend, even better.
Joe Terranova, you have something for Belsky?
I do, Brian, and I agree with you in terms of the way you're formulating the portfolio. But in years prior, when growth is scarce and when investors want to allocate towards growth, it's been concentration towards a lot of these astronomical valuation tech companies and consumer discretionary companies where investors have been rewarded. Why would that be different as we move forward, if you're correct, where you're going to see growth being so scarce?
Well, I'm using it as a broader term, Joe, because I believe that growth is going to be scarce everywhere else in the world, but growth is going to be consistent and stable here in the United States. So I think the type of areas that investors are going to go to are going to be some of the big tech stocks, Joe, that aren't necessarily those high-octane multiple names. I call them the consumer staples, kind of secular growers. But the U.S. stock market as an asset is going to be growing more consistently than the rest of the world. And same, too, again, for Canada with respect to the great financials up there and some great tech stocks. I think that the North American market is going to be a home for equity assets for the next several years.
Brian, we're going to leave it there. That was a good spirited conversation. I appreciate your time.
Thanks so much.
All right, we'll see you again soon. That's Brian Belsky from BMO joining us now. How about this? I want you guys' take on Buffett, okay? Berkshire buying Allegheny for $11.5 billion. We've talked a few times over the last week of Berkshire shares hitting a new high repeatedly lately, closing above $500,000 a share. I'm wondering what you think, Shannon, this says, if anything, about kind of where we are and how much valuations have come down. Not that Allegheny shares have had a massive pullback from their highs, but they were down. And this is a guy, Buffett, who's come out repeatedly and said, I can't find anything to buy because everything's too expensive. Now he pounces as valuations, at least in some respects, have come down. That stock was off of its highs, too, and now he finally sees something to buy. And it's also interesting to look at Berkshire's correlation to the NASDAQ, sort of when growth is doing well, Berkshire doesn't necessarily, or at least in the past, historically speaking, it hasn't done all that well, and vice versa, because he hasn't traditionally had a whole, disposition towards growth. Now, Apple obviously changes that part of the Berkshire equation. But nonetheless, Berkshire and Buffett pounce, finally. What does it say about valuations in general?
Well, Joe made a great point earlier on in the show, Scott, that there are clearly opportunities here, and I think we are going to start to see additional M&A activity. I think M&A and buybacks are two, potential catalysts for the U.S. stock market this year that are really not being all that widely discussed. I think that from a valuation perspective, there are certainly more attractive valuations, particularly for public companies to want to get involved. We're really moving away from a market that has been completely dominated by private equity and VC investors over the last few years. years, and moving into opportunities for Buffett, for example, to be able to pick up a company that fits very nicely within his portfolio. I do find it interesting the divergence, just given the Apple position between Berkshire Hathaway and the NASDAQ, for instance. But I think what we are going to see is we're going to see opportunities for companies to be able to do tuck-in acquisitions. And we're going to see less backlash because of the valuations that are being paid. So I still continue to think about this year being a great year for M&A, both at the large cap end as well as for small caps, but also those buybacks. That starts to accrete that value. So as Jim says all the time, we may not have multiple expansion this year, but I do think that there's going to be some opportunities for that earnings line to grow in ways that we're not really considering against the backdrop that we're looking at.
See, I'm taking a look, Joe, for example, at Blackstone, okay? Blackstone was at 150. It's at 123 today. I bring it up because you just bought it. And I want to know why you bought it now.
Absolutely. So first of all, private equity, alternative asset managers, it's certainly a component of the financial services industry that has experienced significant declines. I chose Blackstone relative to KKR or Evercore because they've been, first of all, more resilient in that environment. And second of all, they have an emphasis on commercial real estate, which again has been remarkably resilient. They're very tactical. They're going after apartment complexes. They're going after logistics, an environment where the value really is in the storage of goods in this inflationary monetary climate. And then they're looking at life sciences and healthcare type of REITs. So their focus on real estate is one of the reasons why I think they stand out above their peers. And as you mentioned, the ability to buy this stock down 6% on the year, for me, that offers a tremendous opportunity. I love the flexibility that they're going to be having to kind of generate a return in what's going to be a return environment that clearly, given the first 3 months, is signaling it's going to be challenged.
Okay. Shannon made a new move, too, which I'm going to get to in a second. But then I look over and I see that Jim Lebenthal has just tweeted at Steve Weiss. And it's not pretty. And I don't know if Weiss has seen this yet. And we had a big Friday night fight in overtime this past Friday. But I think we might have to get Jim Lebenthal on the phone because he says Weiss is missing the boat on this rally. Let's see, guys, if we can do that. He's taking a good shot at you, Weiss. Meantime, the Fed chair, Jay
First
Powell.
of all, I don't know how he says I'm missing it.
Hang on. Well, maybe we'll find out. We can debate it. Fed Chair Powell is getting ready to speak literally in 3 minutes. We're going to get his highlights. Steve Leisman's going to join us with the latest. If there's Q&A, Leisman's going to monitor that too and let us know about it. But it's a big day for Fed Speak, led by the head honcho. We're back in 2 minutes. All right, welcome back. I want to show you what stocks are doing. We're just before 12:30 on the East Coast, and there's the Dow Jones Industrial Average, led lower largely, as I said at the outset, by Boeing shares, which are down significantly today. The S&P has been hanging on to positive territory for a while now, up nearly 9 points. Rates are moving higher today, so the Nasdaq's been sort of up and down all around, and it's negative by a few points here. There is the 10-year note, 225. You've had the 10-year yield on the rise. You've had the 2-year note on the rise. Oil has been up today, and all of that's a considerable story. Fed speak right now. Jay Powell about to make those remarks. Our Steve Leisman has the headline. Steve?
Hey, Scott, the Fed Chair, Jay Powell, will say to the NABE conference that the Federal Reserve has an obvious need to move expeditiously. And the Fed can, if needed, move to more restrictive levels on rates if required to restore price stability. To that end, the Fed chair specifically says if it needs to move by more than 25 basis points at an upcoming meeting, quote, we will do so. If the Fed needs to hike rates above neutral to control inflation, it will do so. He also sees a rising risk that the long-term inflation expectations can move higher if the Fed does not get inflation under control. He says the Ukraine war is likely to spill over to the U.S. economy, restraining overseas growth as well as restricting supply chains. He says there's more COVID-related supply chain problems coming from China and the disruptions there related to COVID from China. He sees inflation coming down, though, on the good side here, 2% over the next 3 years. History, he says, does provide some grounds for optimism that there could be a soft landing. Scott?
Okay, you know what I get from this? So we talked about this the other day. Waller floats the balloon that 50 basis points are probably coming, and it may happen at more than one meeting if necessary. And now Jay Powell himself, the man with the mic, drops it on the market yet again. And it feels like they're conditioning us, Steve, for the fact that it's going to happen. It's just a matter of when, not if.
I don't know that I'd quite go that far, Scott, but certainly they are preparing the ground for the possibility that it could happen. And if it does, you should not be surprised. I'm not sure reading this text and parsing those words, Scott, that I feel like they've decided they need to do it. But I would say you and I are just disagreeing by matter of degree. That is saying if they've decided to do it, I don't think they've decided to do it. I think they want the market and they want that flexibility to be able to do that eventually.
For sure. Of course, they haven't decided to do anything.
Yeah.
Although Powell let us know they were really going 25 before they decided to go 25. And that's sort of all I'm sort of channeling here is that they are making it painfully clear to the market that aggressive policy is necessary. And they're at least floating the idea in ways that they really haven't before, that if we drop 50 on you, don't be surprised.
I agree with that. What I think is interesting here, Scott, is that, remember, we had a whole press conference with the Fed chair last week, and the idea that he feels the need to come back and be even more hawkish than he was last week is interesting to me. It's as if he sort of said, wait a second, maybe I didn't quite make myself clear last week. And so there's two important aspects to this. And I would say it's the fact that they could do 25s, they could do 50s and 25s, but he's emphasized here that the Fed could go above neutral. So those two ideas of if we need to go above neutral to slow the economy, in other words, higher than the 2.25 they judge to be neutral, we will do so if needed. So there's a certain sense of resolve that he's trying to communicate here. We will do what we need to do to bring down inflation, and don't be surprised if we do it.
I know you got to get firmly in the room, Steve, and if you'll just bear with me for one more question. You use the words more hawkish. Is that your read versus what he was a week ago?
It is. It is. I think he's making 2 points very clearly here. The idea, I mean, look, Powell chooses his words very carefully. Staff goes over it. They think about how this will be. They think about how I'm going to read it. They think about how you're going to read it. They think about how the market's going to read it. If he says specifically, if we need to go more than 25, and I quote here, we will do so, that's important. And when he says here, if we need to go above neutral, we will do so, he means for us to understand very clearly they will do so.
I mean, I'm looking at the yield on the 10-year go to 226. We don't show it on the screen, but if we could, let's throw, I said the 10-year, let's throw up the 2-year, which is now at 205. So you've got both, Steve, the 2 and the 10 at the highs of the session. As that spread sort of tightens a little bit further, the curve flattens.
it's an interesting development. I mean, and you can look at all kinds of different spreads. The OIS spread, which takes out some of the term premium in there, and they're all flattening. And there's all this. I don't quite understand all of it, but I think there's this belief that there may not be a soft landing. And the other thing that Powell does in this speech here is he goes out of his way to give a little history and says it is not true that the Fed can't pull off a soft landing. There have been examples of it, he says, 3 of them he points out, and he says it's entirely possible the Fed could pull it off. I don't know how firm he is. He says there's some grounds for optimism for a soft landing, but it's hard to see that right now, Scott, in the 210 spread flattening the way it's been.
Steve, you go do what you got to do. Nice golf voice, by the way.
Sure. Thanks,
if there is Q&A, you'll let us know as well. That's Steve Leisman down at the NABE conference down in Washington, D.C., where it's already proven, at least in these early moments, to be a bit market moving. You see stocks selling off and rates moving higher on those comments from the Fed chair. And you had the comments earlier today from Raphael Bostic as well, the president of the Atlanta Fed. So all of this is in the context of where we are at this very moment, 12:35 or so, and you do have a little bit of a different market picture than where we began some 35 minutes ago. I told you that Jim Lebenthal had, I guess you call it, taking a shot at Steve Weiss on Twitter. Really, this debate has been developing pretty substantially between the two of them as to where we are in the market. Jim Lebenthal got the name back Mr. All In because he's been much more bullish. He's on the phone. Are you there?
I'm with you, Scotty. How are you?
I'm good, thanks. And before I get to your tweet, I want your reaction to what Steve said, because you've been taking, I think it's fair to say, the under on what the Fed is going to do, not to mention the fact that you've suggested, well, the market knows all of this already. I mean, I don't know if the market necessarily knows that the Fed could go 50 basis points, and they may do it at more than one meeting. And what Governor Waller suggested last week by throwing this on the table in the first place has now been backed up by the Fed chair himself. And I wonder if that changes your view on where the market can go as a result of all of that.
So it's going to change my view on what the Fed's going to do, but not where the market's going to do. And actually, because of what you said, I'm focusing on you saying, hey, this is softening up the beachhead for what's to come. I think that's exactly right. So the market will adjust to it. It's off whatever it is, 0.3 on the S&P 500 right now. That's not throwing me. The market will adjust to that. What the market is also adjusting to are the positive economic forces right in front of us. People traveling, factories being built, jobs plentiful. It's just really hard for me to see a recession, which is what is necessary for me to get negative at these levels.
Unless the market is, we're all trying to figure out exactly what the message of the bond market is, and maybe that is the message that it's trying to send, that it's worried about the fact of going into a recession because of aggressive Fed activity, the likes of which Jay Powell just laid out. I'm looking at my computer here because this is your tweet. You're missing the move, Steve. I told you for 2 weeks ago into the Fed meeting last week. I did all I could to get you to move into the light. You remain in the dark. Quoting Mike Wilson, who's been negative, obviously, is not a good look. So, Steve, I want your reaction to that, and I want it on the level, too. I don't want this to devolve into something unseemly, but what's your reaction?
So here's a few things. First of all, the same people are bullish now have been bullish for 6 months. Market's gone nowhere in a year, except it's gone down. The average stock has gotten crushed. It's down between a crash, 50%, the average NASDAQ stock, and between a bear market, 20%, or a correction. So that's been the right way. Mike Wilson has actually been dead on because he's focused at the stocks underneath the indices rather than top-line indexes. So if you're an index investor, then frankly, most people should be, then you're doing okay, minimal losses. But if you pick stocks, you've lost a lot. So look, here's how I look at it. I'm just not getting paid for the risk. So for all the talk that you don't know the negatives, that you know all the negatives, you also know all the positives. So what can change? We saw one data point that changed today is a more aggressive Fed. This is the most hawkish I've seen any Fed that I can recall, except for in the 70s, where you had just ridiculous inflation, which, by the way, wasn't driven by supply chain issues, which have not really abated that much. So that's my concern. And frankly, I haven't missed the move in the market because it goes to more than stocks. It goes to what the beta is of those stocks and the individual stocks you own. So on some days last week, and it's only been a week, and we will see more rallies during this stage, but the market's not going to get to new highs, not going to get very far. So what I mean by the beta and the stocks that I own, it's about stock picking. Look at the news that came out from XPO. Look at FedEx, which I bought at 200. That's moved. So it depends on where you go. I'm not against putting money to work in the market. I'm against putting wholesale money to work in the market because I don't believe that we've necessarily hit the lows. And so if the market goes up another 5 or 10%, great. If China does invade Taiwan, it goes down 30 or 35%. I don't think that's a pie in the sky, thing that's going to happen. I think it's very realistic that it happens. So again, I'd rather miss a little of the upside, which I have not missed, than miss the downside.
Jim, give me the last word, then I'm going to move.
Yeah, the stock market, the S&P 500 is up 16% over the last year, trailing 12 months. So Steve said it's down. That's just not right. As far as Mike Wilson, even at the lows of last month when the market was down 13% peak to trough, the S&P 500 was still up 13% over the prior year, a prior year in which Mike Wilson had been calling for a bear market the whole time. If you're following Mike Wilson, you're not making money. And I've tried to work on Steve over the last 3 weeks, but I just, you know what, he's so convinced he's right, but he's not making money. I don't know what to do with him.
But I mean, look, Steve's not following Mike Wilson. That's a little intellectually dishonest, right? Mike Wilson, to your point, has made the calls that he's made, but Steve Weiss is not following Mike Wilson. He's simply citing him, and maybe he agrees with him now, Jim.
Okay, you see a distinction where I don't, but I think the overall point here is that the tone of the market has changed, and it's clearly focused on the positives right now. The fact that it's brushing off right now with the Fed, what Powell just announced, is an indication. You have to respect the market. How many times have people said that to me? The market is changing its attitude right now.
All right. Mike Wilson's with us tomorrow, by the way.
Can we just put it in perspective? Just one thing, Scott. Just to put it in perspective.
Go ahead.
Jim will only go generally to a max of 10% cash. Okay, so now he's fully invested. Okay, that's not a big delta. I don't have to be anywhere near the market. So my mindset, and Jim's been in business for a long time, his mindset over that period of time is 10% cash. That's the biggest risk level that I can take. I'm not like that, number one. And when I referred to last year, Jim's right, over a year ago. But if you look from mid-year last year, the market's really done nothing. So you go to June and July, the market's down.
All right, we're making that the last word. Round two's over. Guys, thanks. Jim, thank you. We'll see you back on the show. Steve, you're still here. Coming up, the ETFs to watch today, the top ones you need to know about. Plus, renowned short seller Jim Chanos revealing a new bet against Coinbase. He did it on Friday in OT. We're going to debate that new short with Bryn Talkington, who's long. Next.
And welcome to the ETF Edge portion of Halftime Report. I'm Bob Pisani. The ESG market is in its infancy, but it's growing fast. And there's controversy over exactly what constitutes environmental, social, and government's ESG principles. Joining us now, right here, Doug Peterson. He's the president and CEO of S&P Global. It's one of the world's largest providers of indexes, including the Dow Jones Index, including ESG indexes. Doug, you have just released a statement on what you think the essential principles of ESG should be. Everyone's worried about the environment, but no one can agree on what these terms are, ESG actually mean. What are you proposing in this statement?
What we're proposing is ESG needs to become more standardized. As an example, E, S, and G are factors which not a lot of people have defined very specifically. If you think about going to a restaurant, do you know what organic means? We don't now, but many years ago, people talked about what would be healthy food. Organic was never defined, now it is. In E, S, and G, it's time to be more transparent, to have more standardization.
Well, it's one of the big indexes in the world. You've got the powers to push some standardization through. I want to ask you about it. News of the moment here. SEC Chair Gary Gensler has released his long-awaited proposed rules on climate change. They just voted 3-1 in favor of the proposed rules. It would make disclosures mandatory on climate change, and he hopes it would make them more uniform. So is this a step in the right direction? Is this what you want to see more? For example, what is S&P Global's position on this?
We welcome that this debate has started to be open with the business community. There's groups around the world. There's been an alphabet soup for many years of people trying to come up with standardization. There's one in particular, the ISSB, the International Sustainability Standards Board, which is trying to have a convergence of all of this. So we welcome this debate, this dialogue. We hope that it leads to standardization so that we avoid some sort of a fragmentation in the markets on this kind of data.
Okay, thank you very much, Doug. Now, we're going to have much more on ESG and where the rules are going in 2022. It's coming up on ETF Edge at 1 p.m. Eastern Time. Doug will be joined by Todd Rosenbluth. He's the head of research at ETF Trends, etfedge.cnbc.com, and at 2:15 Eastern Time, SEC Chair Gary Gensler will join us to talk about his new climate change proposed rules. The SEC wants to know a lot more about what corporations are doing about climate change and everything else. That's coming up on Power Lunch. Halftime, back right after this.
We think that as competition increases in crypto, and this is not a call on crypto or Bitcoin prices or anything like that, but we think as competition increases amongst the exchanges, you're going to see fee compression. And as it is, Coinbase will probably not be profitable this year with a $40 billion market cap.
That was famed short seller Jim Chanos with me on Overtime on Friday, revealing his new short, which, as you heard him say, is Coinbase. Our Bryn Talkington owns it, and she joins us now. It's good to see you. Thank you for coming on. So what's your reaction to the short thesis that he has? I mean, it is a stock that's come down an awful lot, and it's at 109.5 times forward earnings.
I think his thesis that he shared with you on Friday that, over time margins will come down because fees compression from trading will come down. I don't think that's a secret, and I think you would need more to short the stock. And so the way I look at Coinbase is I think that those that shorted Tesla 5 years ago that just thought that Tesla should be compared to a GM or Ford really missed the broad, market reception to Tesla. I think Coinbase is similar because it's not just going to be a trading and custodial platform. If so, I think that you could make the case that Jim is saying. So I disagree with that. The only thing that is going on with the company is trading.
But I mean, Tesla really was the only game in town for the most part for an awfully long while, led, of course, by Elon Musk, which counts for a good portion of, I think, the valuation. I think you could certainly make that case. Isn't Coinbase a little bit different than that?
Well, I think so. Of course it is. And I was just making the analogy that if you shorted Tesla back then, that wasn't a great trade, and I don't think this will be a great trade either. But let's talk about why. So Brian Armstrong is an incredible visionary. And I think that when you look at, he used Charles Schwab as the example, which I thought was interesting. Buying Coinbase today is like buying Schwab 30 years ago when Charles Schwab just really disrupted the business. And if you look what Charles Schwab, the company and the man had done over the last 30 years, this is another bite at that apple to get a visionary CEO that is creating a platform that once again is a global platform. So Scott, Coinbase already has 89 million verified users. Last quarter, I think they had about 11.4 million per month. And here's what they're doing outside of exchanges that I think people are missing. First of all, what they're doing in the NFT marketplace. And they're going to be rolling out their own NFT marketplace. They're already an investor in OpenSea, which was recently valued, I think, around $13 billion. And what you have to understand with NFTs, that's really where the consumer and the investor are coming together. In addition, and this is so interesting, I used to live in Mexico, and they just recently announced you can send money to a user in Mexico. You can go to any of 37,000 convenience stores, and that end user in Mexico can convert that into a fiat currency. So, that's taking on Western Union. There's so many different verticals that are happening that I think shorting that today is just short-sighted when you're only looking at the trading aspect.
I can't even imagine what Chanos thinks about the NFT market in and of itself. Bryn, thank you. I appreciate it.
Maybe he's not.
One person's long, one person short. And that, my friends, is what makes a market. Bryn, thank you. The investment committee is making more moves. I mentioned that. Shannon, you bought Masco. That's a fresh buy. Then I'm going to talk about something you added to, but why Masco is a fresh new buy for you.
Yeah, a lot of people may not be familiar with this stock, but think Behr Paint and Delta Faucets. We believe that the repair market's going to continue not nearly as sensitive to interest rates as you see the home builders being, and so we love the housing adjacent trade, and this is a great additional way to play it.
Bought more Trex.
Yeah, so, we've owned this stock for some time. It's down about 40%. You're always asking us, Scott, when do these stocks in our portfolio get attractive? This one is attractive. It's about 45% of the composite decking. And again, still that housing adjacency. We expect repair to continue.
All right, thank you. Dr. J, unusual activity. What do you see?
Let's hit it fast and furious, as they say, Scott. Take a look at AMD. Weekly calls being bought at the 120 strike. With the stock at about 116.5, they bought 17,000 of those. That's AMD. Second one, Scott, Camco, CCJ, uranium play. This is absolutely blowing up to the upside. It was below 20 in February. Now it's pushing to 30. I think it keeps going. They're buying 25,000 April 35 calls. Lastly, Nike into earnings, Scott. They were buying 135s last week. They're buying 135s and 140s now. I'm buying upside calls in Nike, NKE.
And Kramer says hard to bet against Nike, but you do have some major headwinds, China, supply chain, et cetera. By the way, we will have those earnings the moment they break on Overtime a little bit later on, just 4 o'clock or so. Final trades right here next. Four o'clock Eastern, big hour today. Nike earnings, as I mentioned. We also have Corvex Management's Keith Meister on with us today. There he is. Skybridge Capital's Anthony Scaramucci. There he is. And tomorrow, there he is. Carl Icahn, the legendary investor, will be with us in Overtime as well. Been a while. We're looking forward to that, too. 4 o'clock Eastern. I will see you then. Shannon, final trade. What do you have?
The third leg of my home improvement stool, Home Depot, great big box retail, and tied to a very good theme that we think will continue.
Okay. Dr. J.
Shell, S-H-E-L, Scott, back into this one, only on the calls, not the stock. 55 strike in April.
All right, little short-term action there. Steve Weiss.
FedEx, it's been bouncing off the lows after the earnings. I think it keeps going. I added on the flush after they reported.
Okay. And Joe Terranova.
United Health Group trades to an all-time high earlier today. I'm long. I'm staying long. Stock is reasonably valued. It should go to 550 minimum.
Biggest story today, Joe, no doubt the move in yields. Is that what we're thinking? 2 years higher, 207. Yep. The 10 years at 227. Those are highs of the day. The Dow's at the lows of the day, down 300 points on the back of Powell.
Without question, yields are the story. Yields are going to be the story until you get about 100 basis points higher, and we see whether there's going to be negative impact on the consumer and corporate behavior.
Yeah, well, we're going to see. There is your real-time look at what stocks are doing right now. I'll see you in Overtime in just a little bit. The exchange begins right now.
Thank you, Scott. Hi, everybody. I'm Kelly Evans. Ahead on the exchange, stocks are dropping to session lows as the Fed chair suggests he's open to half-point rate hikes if and when inflation warrants it. The Dow's down 321 points. Now, this all comes after the best week for markets since late 2020. Before you get too worried, one key strategist says the Fed has so far played its cards perfectly here. Has he changed his mind? We'll ask in just a moment. Plus, Warren Buffett makes a deal, buying another insurance conglomerate for about $11 billion. Berkshire shares hitting all-time highs as Buffett has been reascending the world's wealthiest list. Is the Buffett way back? And a division at Disney. A rift growing between CEO Bob Chapek and his predecessor, Bob Iger. They rarely talk. We'll tell you how it started and where things might go from here. But first, follow me over for a check on these markets where you can see the declines accelerating. Fed Chair Powell's comments crossed about 12:30 Eastern time, so just about half an hour ago. The Dow's now down. Pretty much everything, the Dow and the NASDAQ are down 1%, so a 334-point drop for the Dow, down 148 for the NASDAQ, which is actually back towards the session lows we saw this morning. It briefly went positive. The S&P down 24 points, or about 0.5%. Let's get a quick check on oil, which actually continued to accelerate to the upside after those hawkish remarks as well, so didn't do a lot to take the wind out of the sails here, although maybe some moderation in the last few moments. So we crossed above 111 a barrel today. WTI right now 109.60, up about 5%. There were attacks on Saudi oil infrastructure, reports that European leaders may now consider a ban on Russian oil and gas. Stay tuned there. And let's show yields on the rise big time. This is the story of the day right now. The 10-year yield at 2.28%. I forget I can actually draw on this here. So we've seen this acceleration going back at first to the Fed's meeting last week. Then yields started to come back down a little bit. And now we're getting another leg higher to almost 2.3%. So it's hurting some of the long duration plays in the market, if you want to call it that. It's also having some interesting dynamics across the yield curve we'll get to in a moment. This morning, the Fed's Raphael Bostic had actually been a little bit less hawkish than his colleagues in a speech. But that quickly fades into memory as Fed Chair Powell just said he would be open to half-point hikes. Let's get more from Rick Santelli out at the CME. Rick?
Yeah, it is a strange day, and maybe a good chunk of it actually started in Europe. If you look at German PPI, this is going back to 1977 record keeping. Third month over 20, a record 25.9% on its latest PPI read, and that really does underscore what's going on. And most of that was energy. If you strip out energy, the number's less than half, only up 12.4, only up 12.4%. And consider this, right now 10-year note yields popped about 5 basis points on the Powell comments to 228. Well, we have 7s at 232. We have 5s at 230. We have 3s at 230. You see what I'm talking about. We not only have a traffic jam, a bunch of those cars are actually higher yielding than 10s, which shows the distortions in the yield curve. Much of this started, as I said. Now look at the intraday 10. You can see coming into our time zone when the futures open at 8:20. That's that pop up that we had when yields started to move. But the rest of these charts start the session before the Fed's first rate hike on 3/16. So you can see, look at 10 years. Yes, they've moved rather aggressively, but if you look at where the spread was 10s to 2s on the day the Fed hiked, it's moved about 10 basis points flatter, which means even though 10-year yields have moved up, 2-year note yields have outpaced them by 10 basis points since the 15th close. And if you look at what's going on with respect to boons, boons have really padded. They're up in the high mid-40s now. They were at 18 when the Fed tightened. And finally, the dollar index. The last close above 99 even was the day before the Fed tightened, because the dollar has built so much of the proverbial rate increase cycle in that a lot of that was priced in. Ultimately, what we want to continue to pay attention to today is there isn't a trader around who isn't stuck on these pops in treasuries. As yields continue to drop, the longs continue to capitulate, and it really has turned into a bit of a selling spiral. Kelly, back to you.
Rick, in his press conference last week, Chair Powell made it clear then that he would be open to half-point hikes if needed. What's the difference between the market's reaction then, which largely took it in stride, and to today?
You know, there really isn't a lot of difference. The markets are just more nervous, and all the other data points that continue to fuel the notion that the Fed is immensely behind the curve continue to pop up, like today's PPI in Germany.
All right, Rick, thank you very much. Rick Santelli, the Dow down 360 points. Joining me now is David Zervos. He's the chief market strategist at Jefferies. Dave, let's just start with your reaction to the comments from the Fed chair. What stands out to you about his speech today?
I think you're right, Kelly. There's not too much different than what he said at the press conference last week. He was open to 50s. They gave us very hawkish forward guidance, about 40 bips more than what the market was thinking for the cumulative time to the end of 2023. I think they brought forward the balance sheet contraction in many people's minds to being live and ready to go at the next meeting. We'll learn more about that at the minutes. They left only a 25 basis point instead of a 50 basis point move. And I think that's just to kind of test the market out, see how they take the hawkishness. And the reality is, I think Jay probably sat back and said, you know what, this market took that pretty well. I'm going to keep going. I got a strong housing market. I got 1.7 job openings for every one person that's looking for a job. I've got to get this thing moving because we have a 7.9 headline CPI and we got to do something about it. So I think he's emboldened a little bit, and that's what the speech today was, a sort of reiteration of all that.
So not to sort of make you predict the tick by tick here, but do you think that investors will ultimately be able to kind of stomach this the same way that we saw the markets fluctuate last week a little bit, but then kind of really pick up steam into the end of the week? Would you expect the same dynamic to play out again here?
So, on the S&P or the equity side, we've had a heck of a run back up from the lows, whether that's just, squaring up of positions after all the quarterly witching hour stuff or the options that expired. I don't know. It's harder for me to get into those minutia, but I think the bigger picture is that the upside in stocks for this year, Kelly, is just not that high. The Fed's going to be more hawkish as we go up. They're going to feel more emboldened to get rid of that inflation story. And the downside is more risky because the Fed put, just as we've talked about a number of times, just doesn't really kick in until a lot later because of the inflation pressures that they have to continue to fight. So the risk reward is just not in your favor. And I think, as we said it last time, the Fed's just not as much of a friend as it's been in the past, depending on how the shocks all work through the system. So I think it's a very tricky time to be all in risk assets. That said, I think the growth story, the outlook for the economy is actually pretty reasonable. And I think we can withstand it, especially in the housing market where everything is booming.
Yeah, it's sort of like the scenario you were describing in the past could almost be Goldilocks, because it would mean either risk assets perform or the Fed steps in with QE. But this time it's almost the opposite, where it's like things aren't bad enough that the Fed's going to be more accommodative, but they're not good enough that we're going to see this kind of strong rally on its own. So let me ask you about bonds. How much more do you think the 10-year could back up before you and others, I know you're not going to buy treasuries per se, but across the curve, before you get really interested in buying the bond market at these levels?
So Kelly, I think, Rick was pointing this out in his analysis to you earlier. And I think it's really important for listeners to think about this. We're one rate hike in, and the 3s 10s curve is already inverted. 2s 10s, I think, is hitting a new low below 20. I fully expect this curve to be inverted 2s 10s and lower within the next rate hike or the one after. And I think that's going to cause the Fed a little bit of a problem, a little bit of consternation. And they're going to start to look to the balance sheet and say, well, if you guys are really going to keep these 10-year note yields this low as we're taking rates and rate expectations up in the front end, we're going to be a little bit more aggressive with the balance sheet. I think that's for the later half of the year, but I think we're going to get a more healthy combination of both balance sheet contraction and rate rises in the front end. And the more this curve inverts, the more I think they're going to be focusing in on that balance sheet. And that's going to be the interesting debate as we go into the end of the year.
And maybe Bostic was hinting at that a little bit this morning, because even in being slightly more dovish than his colleagues, he said, he thought it was worth looking at the balance sheet and moving there. Last week, we spoke with Stephen Rasciuto of Mizuho, and he was concerned as a market practitioner about the Fed both raising rates and being aggressive on the balance sheet at the same time. He was sort of saying each one carries its own risks. When you do them at the same time, you multiply those risks, and really wacky things can happen. Again, as somebody who sort of follows the market movements here very closely, do you think that he has a point or do you expect the Fed to be moving aggressively on both?
Well, let me put it this way, and I don't think Steve's far off the mark in that. But let me try to be a little bit more specific. If you look at what we did in response to COVID, we cut rates 175 basis points, which by and large just isn't that much, Kelly. It's a very small rate cut in the grand scheme of looking at rate cuts over recessions in the post-war period. We did, however, increase the balance sheet by $5 trillion, from $3.8 trillion to $8.8 trillion in a very short period of time, 2 years. If monetary policy was responsible for the inflation that we're getting today, and we might think it's all supply disruptions, maybe it's demand, maybe it's monetary, maybe it's fiscal, but let's just say that we think there's some piece of it that is related to somewhat overzealousness on the monetary policy side. It's not going to be the rate hikes or the removal of that 175 cut that's really the help here. It's going to be that $5 trillion that probably caused us the problems. So I think, maybe Raphael, I've been in London seeing clients all day today, so I didn't read Raphael's speech today yet. But my guess is what you're alluding to is that there is going to be more focus on the balance sheet, that was the primary tool that we used during COVID to get us across the Rubicon and get all these jobs back. Oh yeah, we've gained back almost 8 million jobs in the last 12 to 13 months. From doing what we did, being a little extra easy during 2021, and we've gained back, I think, 14 or 13 million jobs from the worst of the situation. So I think you have to look at the balance sheet. You would be, almost remiss if you said, "Oh, let's just leave the balance sheet alone." This is a gigantic balance sheet move, and I think it's going to warrant some extra care and extra concern, and probably is while they don't want to make it the primary tool, I understand that. I think they're going to have to make it a little bit more important of a tool than they made it last time, and that is what they've been saying.
Final question, just to go back to it. Where is the level that you think bonds need to go then? If in a way you're implying we haven't hit anywhere near where they should be. I mean, if they've told us they're going to take the Fed funds rate to 2.8% by the end of next year, the 10-year is still only at 2.3, not even.
Kelly, I think the path is we actually get a pretty serious inversion toward the end of the year, that the 10-year note yield doesn't go up nearly as much as the Fed wants it to. And that forces them to think about that plan B that I think Jim Bullard referred to. And that'll get you that next leg up in the 10-year yield, at least initially, maybe taking us north of 250 into 275 or as high as 3. I don't see a big storyline beyond that. I think at the end of the day, you're going to find that this tightening that they engage in, while it's going to have to be here for a while, and they're going to have to push inflation down for even longer because they have average inflation targeting, so they got to make up for past inflation mistakes too. I think you're going to be able to get the direction of the inflation rate going in the right way, in the right magnitude, without having to go up to these 4 or 5% levels, especially if you lean on the balance sheet, especially if you start to take that down much faster. You can avoid having to take the rates up much higher. And I think the Fed will do that. Next time we can talk a little bit about why if you want, but I think a lot of it has to do with interest on reserves and how they pay that out and who they pay that out to.
Fair, excellent point. And we should, Dave, I just want to read you this headline. Powell just said, while they have not decided what the next rate move will be, quote unquote, nothing would prevent a 50 basis point rate hike in May.
I think he's emboldened after the last meeting. The market took it pretty well. So why not try to hit this thing off and get this 7.9 number that's really a blemish on their report card, get it off the report card faster. Show that they're ready to take it seriously. And I did say that it was his move toward a Volcker-esque moment or his Volcker-esque nod. I think Jay is going to be, as we heard him in his testimony or his when he was in front of Congress for his hearings to be renominated, he really deified Volcker. He really iconified Volcker. And I think we should not expect him to be a 1970s or late 1960s style Fed chair at all.
Well, it's been great to have you here for these headlines and analysis. David Zervos, thanks for your time.
Always a pleasure, Kelly. Take care.
He is the chief market strategist at Jefferies. Now, you might think the market's taking another leg lower after those latest remarks, but we're still hanging on with a Dow decline of about 350 points. Day is young, though. We'll see what else what the market makes of these comments from the Fed chair. We'll bring you the Q&A as well when we get that in a couple of minutes' time. Meanwhile, shares of Berkshire Hathaway are hitting an all-time high after the company announced its biggest deal since 2016. Is the Berkshire way back? We'll speak to a longtime Buffett watcher next. Plus, crude just posted its first back-to-back weekly losses of the year. It's back on the upswing today, though. We'll look at why and speak with Matt Gallagher, who's on the board of Pioneer and Chesapeake, about this volatility in prices. And as we head to break, here's a final quick look at the red across the screen there. Losses in stocks, losses in bonds. The NASDAQ, the worst performer, down 1.2%. We're back in a moment.
This is The Exchange on CNBC.
Welcome back to The Exchange. Berkshire Hathaway striking its biggest deal in 6 years, agreeing to buy insurance company Allegheny for nearly $12 billion. Now, the move comes just a few days after Berkshire A shares hit an all-time high and crossed the $500,000 mark. The B shares also trading at an all-time high. Berkshire's been outperforming the broad markets and that shiny new toy on the block, the ARK ETF. So is the Berkshire way back? With me now is Bob Miles. He's a longtime shareholder and author of The Warren Buffett CEO. So I guess I know your answer, Bob. You probably think he never went anywhere.
He didn't. He says principles are, well, thanks for inviting me on your show, Kelly. He says principles are principles because they don't change. If they change, they're not principles. So he never went anywhere. I think the market is paying attention to him now, mainly because of the share price. Not so much this acquisition of Allegheny.
Yeah, so the real sort of the shift to watch that's been really fascinating is, once again, to look over the last couple of years at all the stocks that were outperforming during the pandemic and now how quickly they've come back down to earth. And what is it that you think for Berkshire is working? Is it just value in materials and solid business? You know, everything seems to be going right for them right now.
Yeah, you know, Warren says we invest in insulation, paint, bricks, you know, try to control your excitement. So value never went away, but I think what the market's now realizing is that value is a component of growth. And I think now there's a shift towards value and a lot of attention on Berkshire because of the $500 million mark of their share price. That's unprecedented in the capital market history. And we'll probably see the $1 million mark in another 7, 8 years if it continues to grow at 10% a year. So
wow,
that's the attention it's getting. And plus, I think the gamification made the stock market somewhat of a gambling vehicle for a lot of young people. I was just at the University of Florida lecturing this last week, and they talked about crypto. And they're worried about crypto in that one person's tweet can change the price instantly. And I sense that there's a drift, particularly of young investors, away from the gamification of the stock market and away from crypto and more towards, hopefully, what Warren says are the good investments, which are productive assets.
Sure. Now, what do you make of the Allegheny deal, which it's kind of more of the same? It's actually pretty small in the grand scheme of things. And during the pandemic, with these huge stock moves where they could have been more opportunistic, we didn't see Berkshire jump in and buy an airline, for instance, or anything like that. So before, Munger and Buffett leave the company, is there something you'd like to see them do? Have you been frustrated at all in their kind of lack of action here lately?
No, I'm a patient long-term shareholder, which is exactly the type of shareholder that Warren and Charlie want to attract. I think the SPACs had a lot to do with the lack of opportunity. His largest purchase to date has been his own stock, some over $50 billion in the last 2 years, more than Apple, his second largest investment. And Allegheny is top 10. So it's a big deal, but I think they're just patient, and he can sit there and just wait for the market to come to him. And I think the SPACs, the gamification has, and a lot of investment towards innovative stocks have are really outside their scope of interest. So
for sure.
I've just been patiently waiting as a shareholder and very pleased as a long-term shareholder to see the stock up 17 times since I've owned it. So, if it continues to just do 1 or 2% better than the S&P 500, I'm a happy shareholder.
Amazing. Bob, it's been great to have you on today with some insight. We appreciate it.
Thank you for inviting me.
Bob Miles. Coming up, the RK FinTech Innovation ETF. Well, it's doing okay the past week. It's coming off its best week ever with Affirm, Block, and Robinhood all outperforming. Is this a false start or a breakout for real? Plus, Disney shares are only up 3% since Bob Chapek became CEO in February of 2020. They've underperformed the Dow by a wide margin. We'll take a look at his relationship with his predecessor, Bob Iger, and what their falling out means for the future of Disney. The Exchange is back after this. Welcome back. We're at session lows. The Dow down just under 400 points right now. The Nasdaq down 190. We were in the red this morning. Then the S&P, or I'm sorry, the Nasdaq went into the green. Now, in the past hour, after we heard from Fed Chair Powell, markets are decidedly selling off. We should get his Q&A portion, some updates soon. We'll of course bring that to you. But again, he is not at all ruling out a half-point rate hike at the next meeting or in the future. Energy is outperforming every sector today, and the only one in positive territory for this year. It's up 37% and almost 3% today as WTI jumps again. Within energy, the biggest gainers are Occidental, Marathon, Hess, and Diamondback. WTI nearing 111 a barrel a little bit earlier. The Crane shares China Internet ETF, the KWEB, lower today after surging 29% last week for its best week ever, coming off a long stretch of losses. JD.com, Pinduoduo, Baba, and Bilibili all among big laggards. In a mixed bag for the chip stocks, AMD among the leaders. Both Bank of America and BMO saying NVIDIA is a buy ahead of its analyst day tomorrow, and you can see much of the rest of the space is in the red. Let's get to Rahel Solomon for a CNBC News update. Rahel?
Hi, Kelly. Here's what's happening at this hour. Hopes are fading that there will be any survivors from a passenger plane crash in southern China. Initial reports say that the first rescuers to reach the scene found only debris and fire. A Boeing 737-800 jet suddenly dived into a mountain. 132 people were on board. Russia's military says that a Kyiv shopping center that it leveled was storing Ukrainian rockets. The New York Times reports, though, that there was no visible evidence of military vehicles or hardware at the site. It also says that the scope of the devastation is greater than anything seen before in the capital. City officials say that at least 8 people were killed. And a large yacht associated with Russian oligarch Roman Abramovich has docked in Turkey. Shipping data indicates that it's been avoiding European Union water in recent days. Abramovich, the owner of the Chelsea UK soccer team, is subject to EU sanctions that could lead to the seizure of the 46-foot yacht. And tonight on the news, supplies of Russian and Ukrainian wheat have been disrupted by the war. A look at how that's affecting American farmers and consumers. Kelly, I'll send it back to you.
All right, Rahel, thank you very much. Up next, if you think inflation is bad here, consider yourself lucky you're not in Germany, where they saw a huge surge in costs as they deal with the energy fallout of the Ukraine war. We'll talk to the former CEO of Parsley Energy, Matt Gallagher, about how much worse things could get here, or if the worst is behind us. We're back in a moment. Welcome back, everybody. Just want to show you the 10-year yield, which a moment ago crossed above 2.3%. That's its highest level since May 2019. So a 3-year high and a very significant move going back to last week. This one triggered by comments from Fed Chair Powell. We'll have more on that in just a moment. Meantime, oil prices are also jumping again after 2 back-to-back weekly declines. All this as Russia's invasion of Ukraine has disrupted energy markets around the world. It's been much worse in Europe so far, in fact, because their natural gas prices have spiked way more than ours. Take a look at their Dutch natural gas futures. That's kind of the benchmark. They're up more than 1,000% in the past 2 years. Again, more than 1,000%. Europe received 45% of its natural gas from Russia last year. Germany reportedly looking to Qatar now for more supplies given the conflict. As a result of this price spike, inflation in Europe and Germany is soaring. German producer prices spiked 25% year on year this morning. That compares with negative 2% just a year ago. So again, a tremendous amount of this upward move is driven by the increase in their energy prices. Here at home, U.S. nat gas prices are up only 200% in the same time frame. That has helped blunt the impact on inflation, relatively speaking. Here's our move in context. Doesn't look so bad, but our oil prices have jumped more, up nearly 5-fold for West Texas versus a little more than 4-fold for Brent over the past 2 years. So how much worse could things get on the energy front? Or is the worst over? Joining us now is Matt Gallagher. He's the founder and CEO of Green Lake Energy Ventures. He's also on the board of Pioneer and Chesapeake and was formerly CEO of Parsley Energy. Matt, it's great to see you. And obviously, we're relieved that the U.S. industry has been more contained on the natural gas side. But how much worse could prices get, do you think?
Well, hello, Kelly. It's great to be with you again. It's been a couple of years. Lots has changed. But first of all, I want to reassure everyone the U.S. shale industry does have the resources to decouple from the Russian energy weapon. Both on the crude side, we peaked imports at about 600,000 barrels a day from Russia here in the U.S., but also on the natural gas and the LNG front, both for our domestic citizens, but also for our allies. I mean, just by 2030, we could increase 4-fold the LNG production. And we could decouple, we could supply Germany with everything they need in Europe to help blunt this impact. And this would be ratable over time. And on the crude side, in just the next 12 of crude imports from Russia, just due to our natural growth.
Well, what you're saying about Europe is especially important because prices are linked. Theirs have been worse. But if they are going to move to ban Russian oil and gas, what do you think that would do to prices even for U.S. consumers?
There's a short-term spillover, that's for certain. So we need to make sure we have a concentrated and stable regulatory environment, and we need to commit on a global scale. It's going to be over $100 billion of investment from the industry. This is not asking for any external support, but we just need stable regulatory conditions, and we need to get moving on this fairly rapidly. We've seen very quick announcements on LNG deals from Germany. We've seen permits go through here in the U.S., which is a great sign. So I think the gears are in motion, and we need to continue on that front. I'm also proud to be part of the answer on the crude front. We have one rig running at Green Lake Energy, but we're not alone. There's 55 other independent producers here in the U.S. that run only one rig. So we're chipping away, growing production as we can.
Matt, we have to cut it short because of more breaking news out of the Fed. We apologize for that. We'll bring you back soon. Hope to continue the discussion, if that's all right. Thank you so much for joining us.
Great.
Matt Gallagher. We want to cut back to Steve Leisman, who is at the NABE session where Fed Chair Powell just finished his question and answer session and has been making more headlines. Steve, what can you tell us?
The Fed Chair, Kelly, said that nothing would stop the Fed from raising by 50 basis points in May if it indeed decided that it needed to do so. He's not saying for sure that that's what the Fed will do, but he's saying nothing will stop it. And he made clear the Fed would go to 50 basis point rate hikes if it needed to, as well as go above neutral. Here's what he said earlier in his speech.
If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
Not surprisingly, the probability of a 50 basis point rate hike as measured by Refinitiv surging to 65%. It was around 50% last Friday, and it is up quite a bit today. It seems to be becoming the odds-on bet, at least for the moment, of the market. And that was not all that the Fed chair said that was hawkish. He went on to say that there's a rising risk that long-term expectations, inflation expectations, could move higher. That's a key for the Federal Reserve to watch. If that gets unhinged, the Fed would certainly be concerned about that. He sees the Ukraine war potentially leading to more inflation, and also pointed to more COVID-related supply disruptions from China. So, Kelly, the only good thing the Fed chair said was that he didn't see a high chance of recession, and he thinks it's possible to get down to 2% inflation over 3 years. But mostly, he gave what I would call a consolidated hawkish speech today, which taking some of the highlights of his hawkishness last week and sort of putting them in bolder relief today, I'd say.
You know, Dave Zervos suggested this, but do you think this is a Volcker-esque moment for Powell here, given the clarity, the candid nature of his remarks, the way in which he was really hawkish last week. He basically said what he's saying today. He's emphasizing it, re-emphasizing it, even joking about how they're going to go ahead and raise half a point next month. I mean, how significant are these comments?
I think Volcker-esque is good. I think it's not exactly like Volcker in the sense that whatever Powell's doing, I believe he's doing it from a lower level, at least at the moment. Doesn't have quite as much work to do as Volcker, but he's laying down a marker. He began with that language last Wednesday. You'll remember Kelly saying he looked at a committee that was ready to essentially fight for inflation. And now he's saying, you know, remember we had Waller on Friday, and Chris Waller, the Fed governor, was pretty clear about wanting to do more earlier. And it sounds to me like Powell is kind of siding with the hawkish wing of the party there and saying, look, we may have to go 50s, we have to do them quick. Remember, they're looking down the barrel, I think, at a really lousy March inflation report that's going to come out 8.5%, 9%. Who knows what happens with the COVID-related China supply disruptions, as well as the knock-on effects from the Ukraine war.
You know, since you're at this gathering of business economists, Steve, how do you think this is going down with the crowd? Is this exactly what they want to hear from the Fed chair, or are they a little nervous?
I think they've been looking at their watch and saying, how about it, Jay? It's time. There was a survey, actually. I love being able to put data to my feelings about things. There was a survey that they released over the weekend, Kelly, that said that 77% believe that the Fed policy is too stimulative. So this group in general, and Kelly, you know these folks maybe as well as I do. Maybe I've been around a little bit longer, but you know who I'm talking about. These are folks that in general tend to side with the Fed. When the Fed has a policy, they're inclined to think that the Fed policy is the right policy. Well, the last survey, 50% thought the Fed was too stimulative. It's now up to 77%.
Wow.
When you lose this crowd, you're decidedly behind the curve, I would suggest.
I wonder if the theme of the conference, you know, I think it's sustainable and inclusive growth, and if maybe inflation, I guess I'm saying even for those planning this event, this feels like it has taken them by surprise. You know, it's taken the Fed by surprise. They've been way behind the curve. It's, you know what I mean?
Kelly, that's a great point, and I'll tell you what I think is really interesting, because we had a discussion at lunch with a couple of former Fed staffers who I've known for a lot of years, which is, when would you have made the pivot? Where did policy go wrong? Why did it go wrong? Should the Fed had responded to the Trump era and the early Biden fiscal stimulus? Should it have responded in the middle of the COVID crisis or the COVID wave of the summer of 21? When should Powell have pivoted, and by how much? Did he do too much too early? There was a lot of agreement in our little lunchtime discussion that the Fed was fighting the last war when it came to not doing enough early enough and having no fiscal help. Well, this time it did a whole lot real early and had a ton of fiscal help. And should policy have calibrated to that? I think we're just beginning to do the history. But what's clear, Kelly, is that the pivot has happened. The Fed is focused on fighting inflation. And the question becomes, for the market, calibrating what that response looks like. And it is really a moving target, with the Fed chair honing, I would say today, a hawkish response by the Federal Reserve.
No, and I love you bringing kind of the buzz to us as well. That's the best of being able to go and be part of these gatherings. Steve, thanks so much.
In person.
Exactly.
Imagine that.
Exactly. We never take it for granted anymore. Steve, thank you. We'll check in soon.
Right.
Steve Leisman at the NABE conference. Let's just quickly check on the markets, because even though they initially hit session lows with the Dow down almost 400 points on those Powell headlines, we've since come back quite a ways on that. The Dow is down 328, just shy of 1%. Coming up, the fintech names have gotten beaten up so far this year, and Jim Chanos sees further pain ahead for Coinbase. But one analyst says Coin's unique model and crypto diversification makes it a solid long-term play. Her thoughts next on The Exchange. Welcome back. After a weak start to the year, the fintech stock saw a pretty nice rally last week. Square was up 42%, Affirm was up 64%, PayPal up 20%, and Coinbase up about 16%. But famed short seller Jim Chanos doesn't think those moves will last, particularly for Coinbase. This is what he told Scott Wapner on Closing Bell Overtime.
We're looking for companies where the profit forecasts are continuing to decline as the valuations stay up in the stratosphere. There are plenty of companies that are in the new economy that have real growth and real cash flows with real earnings. But there's a lot that are just being sold on stories. And we would argue that Coinbase is one that's being sold on a story.
Is he right? Or what would the bulls say about Coinbase? Joining us now is Lisa Ellis, partner at MoffettNathanson. It's great to see you again, Lisa. And let's just start right in on Coinbase, where the proponents would say, just wait till they launch the NFT platform. They have a lot of big things coming. What are your reasons for liking the stock here?
Yeah, Coinbase is a diversified platform play in the crypto economy. So basically, if you're a believer that crypto technology will develop in a number of different areas, of course, in brokerage and exchange, but also as a method of payment, as a store of value, in NFTs, et cetera. If you believe in any one or more of these, Coinbase is positioning itself as that sort of platform play that creates the on-ramps and on-ramps into the crypto economy as the major Western regulated version of that. And in our view, that is an extremely unique, one-of-a-kind asset where you can get in on the ground floor. It's volatile, it's unpredictable in the near term, but if you're taking a multi-year view, in our view, this is one of the most attractive entry points to a very unique story over a multi-year time frame.
Is your price target still 600?
It is, yes. And I would say right now it only gets more attractive in the sense that Coinbase, their 2021 performance was astonishingly strong. They're generating I think interestingly, for a company of this maturity level, over $1 billion in GAAP net income in 2021, and they're now trading at price to sales multiple of less than 5 times. By comparison, even a high flyer like Shopify, somebody like that that's pulled back quite a bit, is still at 10 times, like double the valuation. And many other companies are much higher. So we just view the current level very attractive, and that $600 price target actually, its 1-year price target is only about 11 times price to sales on a 1-year basis. In our view, very much in line with many of those other comps.
So why do you think it is, given that Bitcoin has actually held up relatively well? You know, people were certainly braced for worse. We're still around 40,000, I think, at last check. Why is it that Coinbase stock has been so much harder hit than the crypto price itself?
Yeah, look, there's no question. There's a few different dynamics going on that we'll just have to work through over time. One, there's the regulatory uncertainty. So far, the Fed is generally coming out, reasonably positive, right? Looking for an overarching regulatory framework, pretty supportive of stablecoins, for example. But there's big uncertainty still about how crypto tokens are going to be treated as securities, right, as commodities, et cetera. That's a big regulatory uncertainty that just makes some investors uncomfortable investing in Coinbase ahead of the clarity around those types of decisions. There's also other factors like the fact that Coinbase is a one-of-a-kind asset. Actually, it would help Coinbase if other players in this space, like an FTX, like a Kraken, for example, went public, and there was more disclosures and a broader investor community kind of understanding and educating themselves on the space, because Coinbase still suffers just from a basic lack of investor education and comfort in investing in this stock relative to other options they have in tech.
Fascinating. Again, that would be more than a triple from here. Lisa, thanks for joining us to talk about the other side of it. We appreciate it. Lisa Ellis with MoffettNathanson. We've got a news alert on Apple. It is a busy hour. Steve Kovac here with the story. Steve?
Hey, Kelly. Some Apple services are down this afternoon. This includes stuff like the App Store, the iTunes Store, streaming on Apple TV+. Right now, Apple's status page is saying most or all users are experiencing these problems, but I will say these things are typically a blip and they come back relatively quickly. But it's something worth keeping an eye on, because if this does become a widespread outage like we've seen with other services, it's something to watch.
Sure, and Apple shares are back in negative territory as the market has moved lower this afternoon. Steve, thank you.
You got it.
Our Steve Kovac. Up next, shares of Disney have dropped more than 27% over the past year as they work to find their footing in a post-COVID world. And there's a lot at stake personally for CEO Bob Chapek. We'll tell you why next.
Yes, I would agree. Bucks a gallon than sit on some of those lines, considering those drivers are going to wait for hours. Europe is ahead of us, and Europe's moving faster. And I think they have a big energy security problem to solve. And one of the ways they can do that is by more aggressively moving on the support of electric vehicles. The best way to do that is to handle range anxiety and address charging infrastructure so it's an easier choice for consumers to say, you know what, gas prices are high, I like the performance of an EV, I like the technology, I want to buy one. And I think the same thing plays obviously very well here in this country. And EVs are inevitable. So I think the charging companies are a pretty interesting investment.
Let me turn back to the current state of affairs. How much do people who have electric vehicles, or how often do they charge using one of these public chargers as opposed to using their own home power or the 220 power that they can get?
So it kind of segregates between Tesla drivers and others here in North America and also in Europe as well. So Tesla drivers typically charge about 15% of their electrons on the public network. They'll charge, probably another 10 or 15% at work and the balance at home. The 10 or 15% at work also holds for non-Tesla, but there is no supercharger network. So third parties contribute around 5% of the DC fast charging, and then the balance obviously at home. So home charging is most economic. The others really has convenience as a factor, so you pay for convenience. But there is development and the expectation of fleet's going to really require a lot of fast charging, and that's one way you can get a chunky amount of vehicles on the road fast is by facilitating fleet adoption.
But you're going to have, but fleet, you're talking about rental cars, truck companies, and so forth, right?
Today, the bigger fleets that are adopting tend to be sort of, you're right, rental cars, really taxi fleets, urban transport.
Yeah, I got it.
Those are the fleets that are moving the fastest right now. Like Revel is a very well-known name in New York City, right? And there's plenty of other companies like this that are seeing really good success. People want to pay for their service, and they need charging.
Yep. All right, Craig, thank you very much. Appreciate it.
And as interest grows, that problem, that congestion problem, only going to get worse. Coming up, the next step, or maybe the nexy step, a company looking to make the process of construction more environmentally clean. Don't go anywhere. Real estate is one of the worst carbon offenders, and concrete is a big part of that, emitting 2 billion tons of carbon annually. It's why when one company came up with a solution, it actually couldn't meet demand fast enough. Diana Olick joins us with her continuing series on climate startups. Diana?
Well, Kelly, in barely 3 years, Canada-based Nexi has grown to a $2 billion company and is expanding rapidly in the U.S., all because of a new wall system that the company claims is not only climate safe, but climate resilient.
Nexi is a more sustainable, more economical, revolutionary building system that pre-manufactures building, delivers to job site, assembles usually 75% faster than traditional construction.
Nexi makes Nexite panels, a proprietary material on the outside with a steel core, very strong, but no concrete. The walls are produced in a factory and shipped to construction sites, reducing labor and materials. And Nexi claims to produce near zero waste. Construction waste makes up about 40% of what goes into landfills. The walls are also recyclable.
However, the first thing that you would do is reassemble. You would move the building, reuse rather than recycle. We've already had some buildings that we've been able to do that.
While Nexi is climate friendly, it's also climate resilient. Sidwell says tests showed the panels to be resistant against both fire and water. They also insulate, saving on energy costs. Nexi walls are already holding up several Starbucks, Popeyes, Marriott's, and other commercial buildings, and can be used in residential homes.
I can honestly say that the demand is really insatiable for the product. Unfortunately, right now, I would say 99% of the leads that we receive, we can't supply.
Sidwell himself was the first investor in the company, but now backers include Honeywell and Trane, Lotus Capital, and BD Capital. Total funding so far, $180 million. Now, Nexi just opened a new plant in western Pennsylvania and is building another using its own materials outside of Pittsburgh that, strangely enough, is in partnership with actor Michael Keaton. Back to you guys.
Nothing surprises me anymore, Diana, but what about competition?
There's absolutely competition, whether it's in the clean cement area or in 3D printing for this kind of thing. There is just so much demand that you're going to see a lot of startups in this space, Kelly.
All right. Diana Olick, thanks.
All right, finding a Goldilocks recovery after a crash. 2008 was too slow of a comeback. Everybody criticized it. But 2020 may have returned to normal too quickly. Axios' Neil Irwin will join us next to explain.
Welcome back to Power Lunch. What's the right speed for an economic recovery? After the '08 financial crisis, it took 8 years for the unemployment rate to get back to where it was pre-crisis. It took GDP 4 years to rebound. But 2 years after the pandemic, our unemployment rate is essentially back to where it was before. GDP recovered in a year. The huge difference is the amount of money pumped into the economy to aid the recovery. Joining us now is Neil Irwin. He's the chief economic correspondent at Axios. And Neil, I was going to wait to bring up MMT, modern monetary theory, but basically last decade, last expansion, there was a sense that you could do almost anything and it wouldn't move the needle. Well, now we know there's a number at which it moves the needle and maybe moves it too much.
Yeah, I think if you had asked me a year ago, what would have happened if we had done in 2009 some $3 trillion stimulus, some massive influx of dollars into the economy, I would have assumed that would have all gone into higher growth. It would have, been to Barack Obama's political benefit, things like that. What we're seeing now, a lot of money gets spent. If that all goes into inflation rather than real growth, it's not good for people's sentiment about the economy, and it's not creating a better standard of living. It just flows into shortages, inflation, all the stuff we're dealing with right now.
So, Neil, the irony is that the sort of concern that the economy can actually run too hot comes at the very time that the Fed had decided maybe it was okay to run too hot, depending on, overshooting to make up for previous undershooting of the inflation goal. Now you have to wonder about that new Fed goal itself.
Yeah, I think that's right. They set up this new flexible average inflation targeting framework in 2020. In some ways, that might have been fighting the last war. In some ways, they were dealing with an issue of prolonged below-target inflation. That's certainly not the problem we have now. And there are some reasons to think, and Chair Powell alluded to that earlier today, there are some reasons to think that may shift in some long-lasting ways that we have to monitor really carefully.
When you talk about the speed of the recovery, the circumstances between 2008-9 and 2020 were very different, and the accompanying pain was very different. We did not have the supply chain or the supply shortages back then that we've had this time, and yet we just threw money into the thing. It's a different set of circumstances, but I don't dispute the idea that maybe we've come back too fast from what was really a full dead stop of the U.S. and global economy there in 2020.
Yeah, I agree with that. Look, totally, the pandemic is a completely unique experience. There are a lot of things about this last year that are really unusual in any kind of economic experience that any of us have lived through. I will say, though, 10 years ago, 12 years ago, there were a different set of issues and a different set of problems. There was a structural reallocation away from housing, away from durable goods, so kind of the inverse of what we had in 2021. So, yes, if they had done a bigger stimulus in 2009, I do think there would have been higher real growth and a better labor market. That said, we don't know quite how far they could have turned that dial, policymakers writ large, without really running some of the same types of frictions that we're experiencing right now.
Yeah, and again, you're saying, Neil, with all of this, obviously the Fed has a green light to keep hiking, and look what we just heard from Chair Powell where you are.
Yeah, I think that's right. If you look at any kind of market indicator, this is not a situation like late 2018 when you remember they announced a rate rise and forecasted more rate increases, and the markets just freaked out. You had bond yields fell, you had equities fell. You have a lot of sentiment also among economists, among kind of people in this room. This is the National Association of Business Economics, where the feeling is they're behind the curve, they have room to tighten. Let's go for it.
Yeah, Neil, thanks for giving us some time today. It's good to see you.
Thanks, Kelly.
Neil Irwin of Axios.
Already up next, with Russia banning wheat exports, is the U.S. at risk for a major shortage of wheat? And what could this mean for agriculture and grocery stocks? There you see some of them up today.
Wheat prices have soared since Russia invaded Ukraine. They're up 40% in a month, and that's off the highs. Seema Modi is looking at the potential impact prices could have. Seema?
Kelly, whether it's the price of pasta, pizza, biscuits, Americans should expect to pay up as the cost of wheat continues to rise. The cost of a loaf, 6 cents compared to the same time a year ago. Eggs up 40 cents. Remember, chicken do feed on wheat. Now, all of this is putting pressure on grocers and major consumer brands, specifically General Mills, Kellogg, that produce wheat specialized products like cereal, which, by the way, is up 15% over the past 12 months. Now, higher wheat prices should be better news for top producing states like Kansas, Montana, Washington, but farmers tell us that they're not incentivized to plant more crop. Here's why.
The issue we're having right now is that input costs are going up even more than the price of wheat.
Now, in 2 weeks, the spring wheat planting season will begin. If farmers do not plant additional crop, experts tell us we could start to lean on strategic reserves. The problem there is that wheat production in the U.S. is down 35% since the peak hit back in 2008. One viable option is to import more from countries like India, but then there's transportation, freight costs. So this could potentially set into motion, guys, a food shortage here in the U.S. Back to you.
All right, thank you very much, Seema. And you got a lot of carbs in that basket, Seema. That's a lot there. A lot of expense.
Yeah, and gluten-free, right? Just in case prices get high.
Thanks, Seema. And thanks for watching Power Line.
And closing bell begins right now. Dow down 362. We'll see you tomorrow.
Stocks are firmly in the red after a midday tumble. The most important hour of trading starts now. Welcome to Closing Bell, everyone. I'm Sarah Eisen. Here's where we stand in the market at this hour. Lower across the board. We are off session lows. The Dow is down a little more than 400 points earlier this afternoon. It's down 1%. It is the first decline for the Dow in 6 days. The S&P and the Nasdaq also given up some of last week's strong gains. Technology, as you can see, is underperforming there with the Nasdaq down more than 1%. What's working today? Energy. Oil is popping. It's the same fears that's been dominating lately. Ukraine and, of course, the Fed. Here are my top takeaways on some of the biggest stories today. Deal making is alive and well. Berkshire buying Allegheny for $11.6 billion. Private equity firm Thoma Bravo buys Anaplan, a business software company, for almost $11 billion in a leveraged buyout. Kohl says today it's getting multiple offers. All of this is a reminder that with all the doom and gloom lately in the markets, there's a lot of cash on the sidelines. The financing market still appears strong enough, and valuations have adjusted. Buyers want in. The environment is still ripe. Canadian Pacific rail workers, the latest to strike, as unions have been empowered lately to demand more amid this surge in job openings and demand. Canadian Pacific Railroad is also a major transporter of fertilizer and agriculture to and from the U.S. and Canada. So if this drags on, it's more supply chain backups and more shortages, on top of the already extreme price spikes we've seen for these commodities amid shortages from Russia. And speaking of worsening commodity inflation, estimates are changing for consumer companies that are exposed to these crazy price spikes for energy, grains, and vegetable oil from the Russian war. JP Morgan today saying Treehouse Foods, Utz Brands, and B&G Foods have the highest degree of earnings risk. Also, they cite Campbell Soup, Conagra, and Kellogg, saying they're facing headwinds. Analysts at JP Morgan say Hershey and Coca-Cola are best positioned because of limited exposure to the commodities that have jumped. Let's get to our top story. The markets and the Fed. Stocks hitting session lows after Fed Chair Jay Powell said the central bank is open to hiking by more than 25 basis points at a time, if appropriate, to combat inflation. Joining us for our top panel, Paul McCulley, former PIMCO chief economist, and Liz Ann Saunders, chief investment strategist at Charles Schwab. It's good to have you both here. Paul, do you think Chair Powell is prepping the market for a 50 basis point hike, a double, which might come as a surprise?
Yes, I think he is. Essentially today, he sang the same hymn he did last week, but he said it with more feeling. He really was singing today that the Fed's mission is to deal with inflation, and he's going to do whatever it takes, and he's not worried about really buckling the economy short term. So he sent a message, get ready.
So, Liz Ann, is the market going to be okay with it or not? Last week it seemed okay with that message. Today, not so much.
Well, and also last week the market had already heard and I think had digested the notion that every meeting was likely to be live. and that didn't have a huge negative impact on the market. Now that we have a sense that not only every meeting is live, but the possibility of 50, maybe you could point to that, and Powell's more hawkish comments as a reason for the weakness today. But we're just in a volatile period of time, and there are going to be days where it's easy to point to something that might explain either a up move or a down move. Other days, it might not. But I think the only reason why a 50 would really surprise markets is if we were in an environment of growth really, really slowing and the Fed having to push into higher recession risk with a 50 versus if growth kind of hangs in there. I think the stomach for the market in terms of digesting 50 would be a little more palatable.
Well, I think that's the other huge question for the market right now, Paul, which is, can this Fed achieve a soft landing? Powell says it's happened before in the past. What do you think? If they're being this aggressive on inflation, can the recovery stay intact?
I think there's a sporting chance, yes, that he can get a soft landing. And he pointed out that there have been 3 in the post-World War II period, not just one, which most of us remember. So it's doable. It's not a done deal, but it's doable. And I think he's leaning pretty hard on the fact that the labor market right now is stronger than horseradish. It really, really is. So he thinks that he can lean on the interest-sensitive portions of the economy. He can lean on Wall Street and not have a big risk on the job front. So I think it's doable, not a done deal, but doable. And in the months immediately ahead, he simply wants to get the hell away from zero.
I like that stronger than I like horseradish, especially strong. Lizanne, so what do you do? What do you do with tech stocks? Because they're vulnerable again here, and I see Etsy is one of the bottom performers on the S&P. These are the e-commerce names that rebounded so sharply last week off of sort of depressed levels. Are they still as risky? Now we have seen valuations already contract and sort of catch up with what the Fed is doing.
Well, there's no real they there. I think we have to get out of the habit as investors of looking at a sector like tech through a monolithic lens. There's a whole host of names in there that have a wide variety in terms of fundamentals on the earnings and profit margin side, and in particular on the valuation side. And in fact, since the Fed in last November moved toward normalizing monetary policy, it's more higher quality, more value-oriented factors that have been performing best, even within a sector like tech. So you can put on kind of a lowercase v value cap when looking at stocks and not limit yourself to only the sectors that happen to live in the value indexes. So I think within tech, you want to look for reasonable valuation. You still get, hopefully, a growth kicker, but that high quality wrapper around it. Again, I wouldn't limit a look for value to only the sectors that live in the value indexes.
So you're talking about the mega caps, essentially, which Apple is outperforming today. Tesla's a little higher. AMD, NVIDIA, ahead of an investor day. Is that what you're suggesting, Lizanne?
No, I'm suggesting quality at the factor level. Even the big 5 or the big 7, whatever category of the largest names, you can't look at those monolithically at all. You've seen huge divergences across even the big 5, certainly down into the big 10, based on differences in fundamentals. So when I say high quality, I'm not talking about some predetermined basket of names based on cap, but the actual fundamentals of strong balance sheets, strong free cash flow yield, rising earnings revisions, lower volatility. Those are the collective group of factors that I would focus on as an investor versus sort of these predetermined groups of stocks.
NASDAQ's down 1%. Lizanne Saunders, thank you very much. Paul McCulley, good to have you here as well on All the Fed Speak. After the break, we will talk to American Airlines CEO Doug Parker about how much these rising oil and jet fuel costs are overshadowing what is a booming travel recovery for the airlines. You're watching Closing Bell on CNBC. Dow's down about 350. airlines have given up earlier gains, now lower for the session along with the broader market. And as oil shoots higher, those rising jet fuel costs are a major expense for the airlines. I spoke to American Airlines CEO Doug Parker. He's been the CEO almost a decade and today accepted Yale's Legend and Leadership Award ahead of his retirement next week. I asked him about what demand is looking like right now for spring break and into summer.
Demand is robust. Certainly demand, domestic travel for leisure passengers is as high as it's ever been. Where there's no constraints, as there are in the United States, and as there aren't for leisure passengers, demand is as strong as it's ever been. Business is just starting to come back stronger, but it's coming back as people return to offices, so we know that'll rebound. And then lastly, international travel still has some real constraints, but those will fall over time. We saw just last week, the UK eliminated all restrictions on travel due to COVID, so hopefully other countries will follow suit, including the United States. The reality is there's huge pent-up demand for travel in all sectors, and where there aren't constraints like the domestic U.S., that demand is really, really strong.
There's clearly pent-up demand, Doug. So how durable of a recovery do you see here?
It feels really strong. Again, it's the consumer seems extremely strong. As I just noted, I mean, demand for leisure travel in the U.S. is as high as it's ever been, and business travel is coming back quickly, particularly smaller businesses, those that don't really have the large headquarters and haven't yet and have been back to business for a while. Their demand's quite strong, so it feels resilient. It feels as though as constraints go away, demand is there, and it feels like it's going to be there for a while.
Oil prices, though, have shot up. Jet fuel prices, I know you're experiencing it, 13-year highs. How much does that overshadow the financial recovery that you're experiencing?
Well, it hurts, of course, and it's unfortunate. As I'm moving on and leaving the airline to Robert Isom, my successor, I was really hopeful everything was just going to be going up, up, up. So things like oil prices, though, are a big factor. It's the second largest expense for airlines. So, but again, it'll stay there, and we'll respond accordingly over time with being able to recover it through less capacity and higher prices over time. Or it'll return to a different level where we're also respond accordingly. But oil prices have always been an issue for airlines over time. Wherever the level ends up, we are able to figure out a way to be profitable at those levels. Right now, we can't respond this quickly, so it's going to have an impact on earnings going forward in the near term.
You mentioned the fare and capacity issue. It already feels like fares have gone up. It feels like we're paying more per ticket prices. What should we expect on that front as you do adjust to these higher oil prices?
Yeah, there's a combination of high demand. There's actually some restricted supply right now. None of us, I think, are flying as many airplanes as we'd like. Combination of delivery shortfalls and shortage of pilots at the regional airlines has not as much supply. So high demand, low supply, and high cost of production due to oil prices. All those things combine to where fares will still be, will still be good, but they're going to be higher than they certainly were during the pandemic, when fares were exceptionally low. There's still good values out there, but yeah, they're definitely. I'd be buying my tickets now if I was looking to buy for the summer.
Because
the pressure seems to be upward, not downward.
How much more can we expect?
I don't know, Sarah. Again, it's all based upon competitive issues and supply and demand. And again, right now, I think we're at competitive levels that are good for consumers, and I don't know for certain actually that they will go up. But what I do know is all those factors: supply, demand, cost of production, are all leaning toward higher prices.
What about the number one expense that you have, which is labor? Because that's also been a bit tricky. Yeah. I know you were able to keep people on the payroll thanks to the stimulus and the bailouts from Washington, but what are you experiencing now when it comes to keeping people and hiring people in this tight labor market?
Yeah, well, at American Airlines, we have no trouble whatsoever attracting people. We pay well, and it's a great place to work. So we don't have any issue at American Airlines per se. Again, some of the smaller regional airlines are having trouble recruiting pilots at this time, just because there aren't enough people with enough hours to fly. But that'll correct itself over time. And we did see at points in time at some of our suppliers and vendors, fuel trucks and catering trucks, et cetera, not having drivers. But that is all dissipated as well. So we're not seeing any sort of issue really anymore as it relates to labor. And we're going to hire some 20,000 people at American Airlines in this year, and we're going to have a lot more applicants than we have people to hire.
As demand returns, we've also seen deals come back. Spirit and Frontier are hoping to merge. First of all, do you think that deal is going to get done in this antitrust environment?
Yeah, I'm not quite certain. I don't think that's a transaction that the antitrust department should be concerned about, given the size of the two carriers and not a significant amount of overlap. But I haven't done the work to tell you for certain whether or not they're going to need to do something to get it approved. But certainly doesn't seem to be the size of a transaction that anyone should be worried about for competitive reasons.
And you've been through so many deals in your career, American West, and finally, ultimately, what resulted in American Airlines. Do you see more consolidation? How do you see the industry evolving over the next 5 to 10 years?
Well, I think right now we have an incredibly competitive structure that also allows, the consumer the proper amount of utility. We have 3 large hub and spoke carriers that can pretty much take you anywhere. American being one of those, and then a number of other airlines who fly in either different systems like Southwest or in smaller or in smaller parts, smaller footprint like JetBlue or Alaska. You put it all together, it feels like I think the kind of the right competitive structure for our business. It took us a while to get there. I don't suspect you'll see a lot more consolidation from this point, but again, there may be, but nothing big that I think's on the horizon.
Doug Barker, CEO of American Airlines, and in all his time at the airline, he went through 9/11, some really difficult periods. He said COVID was the hardest for his airline and for the entire industry, and that $50 billion worth of stimulus, he said, saved them. The entire airline industry would have shut down without it. Let's check in here on the markets. We are seeing the first decline for the Dow in 6 days. The S&P gives back a little bit, 0.4 after its best week last week since 2020. Down 0.4%, as I mentioned. Most sectors are lower right now. What's holding up? Energy, materials, and utilities. What's getting hit the hardest? Technology, consumer discretionary, communication services. The banks are down, though yields are pretty much higher across the board. Coming up, Warren Buffett's powerhouse conglomerate is outpacing the market in a big way lately, and higher today on the back of a multi-billion-dollar deal. Mike Santoli will be here with the dashboard on Berkshire next. Warren Buffett's Berkshire Hathaway announcing its largest deal since 2016 earlier this morning, buying insurance company Allegheny for $11.6 billion. Mike Santoli taking a closer look at Berkshire for the dashboard, which has been doing very well lately.
Yeah, Berkshire's on a roll. I mean, Warren Buffett over the decades has kind of come in and out of favor, and right now, investors love every piece of what now makes up Berkshire Hathaway. Now, Allegheny's interesting because it's kind of a baby Berkshire at the core of an insurance company, but also a conglomerate with other businesses. Here is a way to kind of pull apart Berkshire in terms of comparable. So Apple, of course, Berkshire owns 5.5% of Apple. That has outperformed the rest of tech. You have United Pacific, of course, that's railroads. Burlington Northern, Santa Fe is at the core of Berkshire as well. All doing well. Chubb, property and casualty insurance business, that's the Geico General Re business within Berkshire. So it's all working together. Value, quality,
commodities,
cash flow, exactly. Energy infrastructure is in there as well, and pricing power with the rail. So not to say it's going to last forever, but it has actually gotten Berkshire back up to a premium versus where it's traded for the last decade or so.
And the signal from the deal today, I mean, they have what, a more than $100 billion pile of cash still. And they've complained, Buffett and Munger, that there hasn't been anywhere to put it. Now
maybe there are more opportunities. Yes, exactly. First of all, this company very much in tune with what Berkshire does. I think they would have been a buy almost no matter when they were willing to sell. But Berkshire's $750 billion in market cap now, so this isn't big. There's a lot more they could do. Of course, also the Occidental stake was just a couple of weeks ago.
I read somewhere, I think on Twitter, that someone said, treasuries aren't working right now. Berkshire is like a safe haven.
It absolutely is acting that way.
Warren Buffett instead of sovereign debt.
No doubt about it.
Berkshire isn't the only company making news in the deal world today. Thank you, Mike, by the way. Private equity firm Thoma Bravo is buying software company Anaplan for nearly $11 billion. That stock's soaring on the news. We will discuss the deal with the man behind it when Closing Bell returns. Private equity firm Thoma Bravo striking a deal today to buy business software company Anaplan for $10.7 billion. Joining us now is Thoma Bravo's managing partner who led the deal, Holden Spate. Holden, thanks for joining us. It's funny, just a few days ago, we found out that this company was the subject of activist pressure. Keith Meister is going to be on with Scott on Overtime next hour. But between that and, of course, the public valuation coming down for all of these software names, talk about how this deal got done and whether management was more open to it because of some of those issues.
Well, thank you, Sarah. First of all, I'm delighted to be on here today to discuss Anaplan, which is, in our minds, one of the most unique enterprise software companies that we cover. And so we have approached this company in this market well before any activist disclosure, because this company really, from our standpoint, checks all the boxes. It's got very high revenue quality, very great customer base. It's in a large and dynamic market. It's growing really fast. And as you said, one of the nice things, or one of the things that is a trend in our market, is over the last 5 or 6 months, particularly for really high quality public software companies that have nice revenue growth but very little profit, we've seen those companies have their valuations decrease pretty significantly. And for us, that's a big opportunity, because at Thoma Bravo, we have a very unique operating approach where we work in collaboration with management to turn to turn revenue multiples into cash flow multiples over our investment horizon. So when all those things came together, we approached the company, but it was, again, well before any activist disclosure.
But it sounds like you may have more up your sleeve, given where valuations are in tech right now, and software in particular.
We think this is a great time. I mean, these are some of the best companies, like I said, that cover their high growth, they have very high revenue quality. And you're right, we are very busy at the moment.
What about the general market environment? And clearly, it's a ripe time for LBOs. We're seeing potential Nielsen deal in the works. There was the Citrix deal. What about the junk bond market and just how generous financing conditions are right now? Because they've certainly tightened as the Fed has started raising rates.
They have. Now, what we're doing a lot of in our world is we're buying these really high growth, market leading companies at scale. And we are, I think, probably the market leader in doing that. And those companies that are very high growth, we have a really nice set of private capital sources that we can leverage as well, who recognize that the company's recurring revenue that we're borrowing against is a really attractive asset. And so we're in this deal, as an example, that's kind of what we did. Now it's primarily equity, but we're making our returns on growth on the top line and growth and profitability, not necessarily on financial engineering. So we think that will continue as well.
What is the goal here? Are you trying to go up against with this company and some of the others that you're building in your portfolio and SAP? That's the competitor we hear about most when it comes to Anaplan. A Salesforce, perhaps, an Oracle. They all compete, and they're all bigger.
You're right. It's situation specific. We've been doing this for about 20 years, buying these companies, running them independently, competing against large guys. There's always been a place for best of breed software. That's still true today. The fundamentals of these companies are amazing. And in many cases, and it's true in this case as well, we're buying the market leader. Some of those names you mentioned are in the market, but Anaplan is gaining market share. They have been for a very long time. It's cloud native. A lot of the companies you mentioned started with an on-premise solution. And so Anaplan, like many of our companies, are taking market share.
What about the notion in the public market that a lot of these companies had a lot of demand pull forward during the COVID pandemic, that you saw that with the stock price? Anaplan got as high as in the 80s, and that it's going to be tough comparisons and a lot of give back in the coming years, especially as we get back to normal and see a changing consumer environment.
Yeah. They saw some of that, of course, in a way, that pullback, and then there was kind of a reversion, and that's really what created this opportunity, to be honest. And so we think we're on the other side of that. I mean, the growth in their last quarter in new bookings year over year was 60%, which for a company that's over 600 million in revenue is very unusual. So we think that's created a great opportunity for us.
Holden, thank you for joining us to talk about the deal today. We appreciate it.
Thank you for your time.
See you for the next one, I guess.
Well. All right, talk to you soon.
Holden Spate of Thoma Bravo. Is this crypto's coming of age moment on Wall Street? It's the buzz today, and we've got the details next. Dow's coming off the lows, down 273. We'll be right back. What is Wall Street buzzing about today? A crypto first. Goldman Sachs just became the first major U.S. bank to make an over-the-counter Bitcoin options trade. That basically means a direct customized trade, either for the bank or on behalf of clients. It was executed by Michael Novogratz's Galaxy Digital and does mark a major milestone in the development of crypto markets for institutional investors. As CNBC.com's Hugh Sun reports, it's different than the exchange products because Goldman takes on a bigger risk here, acting as a principal in the transaction. It shows perhaps a growing trust on the part of Goldman Sachs in the asset after Wall Street has shunned crypto for years, finally. Or perhaps they're just trying to meet growing customer demand for Bitcoin derivatives. Either way, it speaks to a new maturity and potential systemic reach here for crypto. Coming up, oil's jumping more than 7% right now. We'll tell you why straight ahead. That story and more when we take you inside the market zone. "20 minutes left in the trading day. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here as always to break down these crucial moments of the trading day. Plus, Goldman Sachs head of energy research Damian Corbelin on where oil prices are heading next. Big pop today. Ally chief market and money strategist Lindsay Bell here on the outlook for earnings season. Welcome, everybody. Stocks are under pressure, erasing earlier morning gains after Fed Chair Jay Powell suggested a more aggressive interest rate hike path might be necessary to curb inflation. Mike, this is the Dow's first down day in 6 days. So we're coming off of a big win streak. Treasuries are worth paying attention to today because we're seeing new 2019 highest since 2019 for both the 2-year and the 10-year yield. What does it all tell you about whether last week's move is sustainable? We're seeing a pullback here, but it's not sharp and it's not ugly like we've seen in recent weeks.
Yeah, it absolutely got the bond market's attention, repricing the outlook for how soon and how high rates might go. The May meeting, which is the next one, is looking like it might be a half-point increase based on the current odds. Now, what's interesting to me, though, is the damage is being felt in things like consumer cyclicals. You look at home builders, or you want to look at, even the auto stocks today. That's the area that are getting a little bit punished. But in general, the market, to me, after going up 250-plus points on the S&P last week, is basically giving up just, 16 of those. So it seems to me relatively resilient. I think this is going to be the mode, though, where whatever the market gives, the Fed might take as permission to get a little more aggressive.
Well, no doubt Boeing is one of the biggest drags on the Dow today, taking about 50 points off the Dow after a China Eastern Airlines Boeing 737 crashed in the mountains in southern China after a sudden sharp descent. 132 people were on the plane. The cause of the crash still under investigation. Let's bring in our Phil LeBeau, Phil, with the move for Boeing and just what we know so far.
Well, Sarah, I think the most interesting thing that people are focused on right now is what would cause a plane flying at 30,000 feet to just drop out of the sky? Because when you look at the descent, this was in less than 2 minutes when it went from 29,100 feet down to the ground. And so it brings up the question. There was not a catastrophic event that was reported in the air. Was it cockpit confusion? Was it deliberate on the part of the pilots? So many questions here that need to be answered, and we really won't have more details until they recover the flight data recorder as well as the cockpit voice recorder.
Keep us posted. Phil LeBeau. Phil, thank you. For now, Boeing is one of the big losers. Oil making another big move higher today. It's up more than 7%. This comes as European nations are once again considering an import ban on Russian oil and following an attack this weekend on Saudi oil facilities. Joining us now is Goldman Sachs head of energy research, Damian Corvalin. And Damian, I guess if you thought that the energy volatility was coming down and that we've seen the high in prices because they did decline sharply last week, that's absolutely wrong. Now what do we expect?
Yeah, so we think from here the move is still higher. We have a significant supply shock on a market that was already historically tight. And the only buffer you have today really is demand reduction, right? We don't have any inventory buffer. OPEC has very limited ability to ramp up and no desire to do so. And so really it has to come out of demand. And that takes another meaningful leg higher. Our forecast is 135 for the second half of this year. Now, a lot of uncertainty, you point out to the price volatility, so you should expect that. But again, we're losing a lot of barrels right now.
What about the prospect of Europe joining America's Russia oil embargo? First of all, is that even possible? And second, is that in the market? What would that mean in terms of how much fewer barrels of oil come out of Russia?
So it would be a significant shock for Europe and for Russia. And that's why Europe has been reluctant so far, and particularly countries like Germany, who are very dependent on Russian oil. So you've seen the countries that have implemented it least exposed, right? The UK, the US. Based on recent statement, we would still think Europe waits to implement that because it is a significant shortfall for them. But it clearly tells you which way those sanctions are going, right? The escalating sanctions are the deterrent for other buyers. And that's why Russian exports are falling right now. Under sanctions, you can export energy. But because buyers are reluctant to do so, this is having a material impact already.
And what about Saudi, which I mentioned, we saw the attack on the Aramco facility. There's also some articles today discussing the relationship between Biden and the Saudis and how we've lost them a bit. What is the status of that relationship and whether they can step in, Saudi Arabia can step in here and help the U.S. and Europe, the West, meet the demand that's being lost from Russia?
Yeah, a few points there. So first of all, OPEC decisions have to be unanimous, right? So within the group, you have Russia, you have Iran, Venezuela, who all see some leverage from higher oil prices. So that makes a decision difficult. Until the last few days, Second, it wasn't obvious that Russian exports were falling, right? We're still loading barrels contracted before sanctions. I think finally now we're starting to see some evidence of that. Third, in this current geopolitical environment, it may take more to see the group respond. Think as well from a perspective. They're sending a lot of barrels to China. Russia wants to send barrels there, so that's also complicating. So in the end, there is a little bit of capacity left. Probably takes sustained high prices to bring it on, but doesn't really solve anything, right? We're looking at second lowest spare capacity, and if that comes online, there is absolutely nothing left, right? We have zero inventory buffer. We'll have zero spare capacity in a world where high food and fuel prices typically drive social unrest and disruption. So those barrels coming online maybe help prevent rationing, but they don't really help solve the critical tightness of the oil market, which takes me back to the core of our bullish view, which is there's only one solver here, which is reducing demand through higher prices.
Mike, Goldman, Damien says $135 price for oil. Can the U.S. economy handle that? The oil names are all working today, but as you mentioned, the consumer names are getting hit.
135, if that's the high, if the forward curve is still not showing that that's going to be the price for the foreseeable future, yeah, it can handle it. Obviously, it would be a restraint on growth to some degree. I'd like to remind everybody, we were up at 100 in the early part of the 2010s for a while, and a much slower growing economy that was even slightly more energy intensive. So I think it can handle it if that's really the only thing that it's contending with. Clearly, it won't be the only thing with rates going up too. Also, in a couple of months, we're going to be lapping, $75 oil from a year earlier. So it does have, if we stabilize in this range, it's going to have a diminishing year-over-year effect, but still not going to be a help to the economic view.
Damien, thank you for joining us. Oh, did you have one final point?
Yeah, I think Mike makes a good point, which is the consumer is much better off than he was in even summer 2008. So to get significant demand destruction, more than the 1 million barrels per day we expect, you'd need a significant leg higher in prices. And I think that's the core of the price risk, right? 135 is our base case, but if those losses of exports from Russia are 2 million barrels per day, then the price upside is significantly higher. So I think that's the key risk as well to the forecast.
Damien Corvalin, appreciate you joining us from Goldman Sachs. Thank you. Stocks remaining under pressure here following comments from Fed Chair Jay Powell earlier this afternoon. Now the next big catalyst could be earnings season as we approach the end of the quarter. Joining us now, Ally Invest Chief Market and Money Strategist Lindsay Bell, also a CNBC contributor. Lindsay, keep reading commentary that earnings expectations have not come down enough to reflect the current environment, which is slower economic growth and dealing with these commodity price spikes like oil, like wheat. What do you think has happened to earnings expectations? Are they matched? Are they mismatched?
Yeah, I mean, they've been quite resilient despite all the uncertainties that the market faces, that corporations face right now. We're looking for 2022 earnings growth of 7.5%. That's right in line with the long-term average of about 8% per quarter. So it's not really a dire situation, and it comes on the back of what was one of the most strong years from an earnings growth perspective out of very many in 2021. So the comps are a little more difficult. We're still going to get solid growth, and I think where we've been seeing shifting in numbers is really within different sectors. So of course you're seeing sectors like energy and materials. Those numbers are moving higher along with commodity prices, but then you see consumer discretionary and communication services moving lower along with consumer sentiment. So I think there's some moving parts here. Time will tell. It's going to be a really interesting earnings season because corporate America really has been able to weather a lot of the uncertainty that started in the fourth quarter of last year, including inflation and uncertainty about the Fed and the direction and the path forward there. They weathered that really well in the fourth quarter as the market started turning down, and I expect they're actually going to be able to do the same this quarter.
Which sector has the most downside risk? You said energy, obviously the biggest upside. Which one biggest downside risk given everything that's happening right now?
Yeah, the biggest downside risk, I think, is, most people would probably initially gravitate to the consumer discretionary sector, but it's one of 3 sectors that is expected to show a decline. It's expected to show a decline of 10% in the first quarter. And I actually think that might be a sector where there's opportunity. What we've actually seen is the majority of that pullback in growth is coming from the consumer services sector. And so the consumer, I think, in general remains very, very healthy, just like Mike and your last guest talked about. They have excess savings to the tune of $2 trillion. They have much lower debt levels than they did coming into the pandemic here. They've really right-sized their balance sheets, and they've shown the ability to absorb higher prices thus far. The job market remains very, very attractive to them, anyone that's looking for a job. So I think the consumer remains very strong. We've seen consumer services, while some of those companies have done really well, like restaurants and hotels, those numbers remain very depressed from an earnings perspective, and I think that's where you might be able to see actually some upside surprise. I also would look at the tech sector too. While numbers have been pretty steady there so far, just like last quarter, the expectations coming in are very low. I think this is a sector that a lot of people aren't expecting too much from, even despite the move back in the stock prices here. So I think that might be an area where you see better growth, because growth there has been really good over the last several quarters, but it hasn't really outperformed the S&P 500 in the last couple of quarters. And I think that there's a bigger opportunity coming down the road. Yeah.
Tech and consumer discretionary. Mike, remind us where we are on overall market valuations, given where earnings are expected to come in now.
We bounced at the lows of last week. It was a little bit over 18 times forward earnings, and those earnings, as Lindsay said, have been basically steady for this year. So we're up, probably in the 19-ish range again. So it's down from, over 21 to start the year. Nobody's version of cheap, but it really does depend, I think, on whether we have a bad guidance cycle after first quarter earnings. If that shows you some vulnerability, it's worth keeping in mind. Earnings and sales for companies are measured in nominal dollars. We're all worried about inflation here. Inflation, it shares the nominal, spending power of the economy. The nominal amount being, of output is growing. So that's not to mean it saves multiples. It doesn't mean earnings can hold up perfectly, but that is a little bit of a tailwind in terms of companies making numbers.
Lindsay Bell. Lindsay, thank you for the update. Appreciate it from Ally. Of course. One good test of consumer will be Nike, because it reports today after the close. Analysts are expecting 71 cents for earnings, $10.59 billion in revenues for the quarter. Nike stock taking a dip today. It's actually now down 20% on the year, Mike, and well off of its highs from last fall. If you think about everything that's been worrying the market lately, a lot of global growth concerns, war in Russia and Ukraine, the spillover effect on Europe, what's happening with China and the shutdowns there in that market, coming off of already a little bit of weaker demand because of some of the nationalism around Chinese brands. That's all being reflected in the Nike share price, as well as supply concerns. So I just wonder how much of the bad news is priced in here to Nike, because all the analysts still love this name and their strategy.
Well, I think the other thing that's part of the context is that it really did. The stock got up to a real hefty premium to the overall market, to its own history. There was this real love for the global brands who could well navigate the supply chain issues. And, it's still now at, 35 times earnings. It's like 40 times free cash flow on a forward basis. So it's still on the richer side, even if it's down, discounted in price. So that, to me, has been one of the undertows for performance here, even if the absolute numbers that they're going to deliver are really not falling off that much at all.
NASDAQ is pulling back. As you can see, it is the big underperformer. Tech near the bottom of the pack as growth stocks saw massive rallies last week. Let's bring in Bespoke Investment Group co-founder Paul Hickey. And Paul, I was going to ask you just how strong this final hour of trading has been, but we break the streak today. First down day for the Dow in 6, but it has been a better tone, and we are off the lows. So what have you noticed?
I mean, we're up in the last hour right now here. We're up, I'll get to it in a second, but the rally last week, as you were, you've been discussing, has been almost a dash for trash, and you have it there in the headline. And what we've seen is that the lowest quality stocks have seen the biggest rallies off the lows. And, there's not that much you can read into it. As you've discussed a lot, that can be a dead cat rally or the beginning of a meaningful bounce. But what we have seen is in this last hour strength, 4 days last week in a row, we were up 33 basis points or more in the last hour of trading. And based on where we are right now, it'll come down to the close. But today could be the 5th straight day where you've seen 33 basis points or more in the last hour of trading. That may not sound like a lot, but the 4 days is already the longest streak since November 2008. and 5 days would be the longest streak since July 2002. So, I mean, you don't see this kind of last hour strength all that often and on a consistent basis. And November 2008, what you have to remember is it wasn't a low for the market as far as the indices were concerned, but it was an internal low for the market, meaning like the indices made lower lows in March, but the average stocks made their lows in November 2008. You saw a similar situation in 2002, in July 2002. The majority of stocks made their lows in July 2002, but the indices bottomed in October 2002. So that's an encouraging sign here. Go ahead.
No, I was just going to ask you how you read it, basically, what you take away from it, and especially that pattern you noticed about what you're calling the dash for trash. So the companies that had the highest PE multiples, right, that don't necessarily have earnings, and the not quality stuff. Does that mean they're looking for a bottom?
Well, so again, it's a characteristic you see at every rally off a low, whether it's sustainable or not. Take a stock like Square. It's had a rally of 30% off a low this year, 60%, and 50% off a low at 3 different times this year. It's still down 15% year to date. So these types of rallies, you tend to see them, they don't have a whole lot of meaning by themselves, but when you couple them with some other factors like this environment, who wants to hold stocks overnight when you see the types of headlines, you have a headline risk in Russia, Ukraine, but people are still buying stocks going into the close over the last week here. So I think that's something to be cognizant of. And right now, yeah, we're up to almost 50 basis points in the last hour of trading right now as we head into the close. So I think that's a positive signal here. Everyone freaked out about what Powell said earlier today. But if you really look at what he was saying, it's not much different than what he was saying last week. We were a little confused why the market was so positive last week on these headlines. We were equally confused today why the market was so negative on these headlines when there really wasn't that much difference in on either day. Like what's changed in the last 4 days?
Well, one thing that's happening is that yields are sort of shooting higher here. The 10-year's past 230 right now, and we're looking at fresh highs going back to 2019. How do you think stocks have been able to absorb these higher yields?
So with all these things, like oil, so the first time oil went above 100 in early March, the market freaked out and we sold off. This time we go back above 100 and the market was able to stick with it. We're seeing similar thing in Treasury yields. The first time is shock and investors get worried, and then they get used to it and it goes up and the market's able to live with it. So I don't think it's we're still at 220 on the 10-year, and it's still not that historically an extreme by any stretch of the imagination.
Paul Hickey, always good to get the perspective from Bespoke. Thank you very much. You just heard the 2-minute warning, 2 minutes left, a little less than that in the trading day. Mike, what do you see in the internals?
They're weak, as you might expect, given the fact that the indexes have been down all day, but really kind of on a mixed level. About 40% of all volume on the New York Stock Exchange to the upside, so 40-60, not really a washout there. Take a look at new lows and new highs on the New York Stock Exchange, new 52-week highs and lows. This is rare. It has not been the case in a while that you've seen, double the number of new highs versus new lows. Kind of just shows you the correction's been going on for a while, probably, but that's definitely in the positive column, but you have to see that build. The volatility index has been soft. It's now down below 24. It's holding that big rise and fall, the spike on the chart, which generally means we're on firmer footing. And once it gets well below 30, it shows you that the market has kind of come to some kind of terms with the macro for now.
Definitely feels calmer today than the usual sell-offs we've had in the previous weeks. Mike, thank you. As we head into the close, less than a minute to go. What's working? Anything commodity related, especially energy with a big jump in oil prices again. Steel stocks are doing well as well. We are off the session lows. The S&P right now is actually trying to go positive, so we're really having a nice rally here into the close. Looks like we might even end positive. The Dow Jones 200, the Nasdaq underperforming, but only down a fourth of 1%. It was down about 1% earlier in the session. Consumer discretionary, the worst performer on the market. That does it for me here on Closing Bell. Have a good evening. I'll send it into overtime with Scott Wapner.
Sarah, thanks and welcome to Overtime. I'm Scott Watton. You just heard the bells. We here are just getting started. In just a few minutes, we'll be joined by star investor Keith Meister to get his thoughts on where we are in the markets. Nike earnings breaking any minute now. We'll have the very latest and, of course, the instant stock move in Overtime. We begin with our talk of the tape. The big leap in interest rates today. And Snipe. Ed Yardeni, the president of Yardeni Research. It's great to see everybody. Ed, I'm beginning with you. That is the big question. Did Powell kill the rally just as it's getting started? Did you see what's happening in interest rates today? The 10-year at 2.30, that's up 7%. The 2-year at 2.12, up 8%. Spread is getting tight.
Yeah, absolutely. And that's where those rates should have been about 6 months ago. Took them a while to get here, but it makes sense that with inflation at 7.9%, we'd have the bond yield over 2%. Makes sense that the 2-year would be over 2%. What's really odd, though, is the spread between the 10 and the 2, kind of borderline turning negative. I mean, we're awfully close to turning negative, and I think that's got a lot of people spooked about a potential recession. So there's a lot going on here, a lot of messages from the financial markets for sure.
Yeah, so we came in with this newfound momentum. Did Powell just kill it?
I don't think so. As a matter of fact, I'm pretty encouraged that the market came back pretty nicely in the last hour of trading. I don't think he killed it. I think the market is looking for opportunities, and the opportunities continue to be in areas like energy, commodities. I think the market will also find more opportunities in financials as interest rates go up. And technology looks awfully cheap to me. There's a lot of cheap technology stocks. So I think there's opportunities. I think this correction we've had since January 3rd has brought buyers in. I would call them dip buyers. I call them correction buyers.
We'll see if they'll become sell the rip sellers. You have this interesting idea today that while the Fed put may be dead, the CFO put, in your words, is alive and well. Explain.
Right. Well, I think it's pretty important I think we all recognize that the Fed put is gone. We're not going to, even if we had a real big tantrum in the stock market, the Fed's just got too big a problem with inflation to cave in. So I think the Fed's going to have to continue to raise rates no matter what. It's not going to give us easy credit conditions to keep the market going higher. As long as the market goes up or down, but does so with a certain amount of stability without any really kind of crazy breakdown, I think the Fed's going to continue to raise rates. So, on the other hand, we have the CFO put. Corporations are just flush with cash. They've raised over $2 trillion in the bond market over the past 2 years. They've refinanced a lot of their debts at record low interest rates. They've paid off loans, and the cash flow is record amount. So what are they doing with all this money? Well, they're buying back shares. They're issuing dividends. And M&A activity was at a record high last year. I think it remains very strong this year. And I think all those areas will continue to prop up the market.
Hey, as we learned today, obviously, with M&A, is the Fed going 50 basis points at the next meeting? You look at the percentages shot up from a day ago, from 43.9 to 61.9 today. What a jump. Yeah,
well, I guess when Powell more or less said the same thing at his press conference last week, the markets really figured a quarter point a meeting for a while. But then he wanted to make sure everybody understood that he is concerned about inflation. The title of his speech today was about restoring price stability. So that's become the number one priority now of the two mandates that he has, given that the labor market's so tight. So I think it's reasonable to expect 50 basis points. And if that's the case, then again, I think the market's held up pretty well today.
That's for sure. We saw how it ended. Thank you so much, Ed Yardeni, in Overtime. We'll see you again soon. Let's bring in Cameron and Jason. They, of course, are still with us here in OT. Cameron, same question to you. Is this a rally you can rely on, or does it feel too much like a bear market bounce?
So I think we can certainly see rallies off of oversold conditions, just like we've seen over the past few days. The question is, where do we go from there? Do we return to that kind of unflinching up into the right bull market that we saw last year? Or do we get caught in this sideways chop? And we think it's more likely that we're in that sideways chop for the remainder of this year, or at least until the Fed is still staying away from being accommodative. So that means that, yes, we can see this rally, but we don't really think that we're out of the woods on market volatility or that we're going to see really strong upside returns from here. So we do think it's stuck in that sideways chop because of the Fed.
How do you see it, Jason? The same way or differently?
Yeah, I agree with a lot of that commentary. I mean, obviously the Fed is trying to put a lid on inflation. I mean, we had a CPI of 7.9%, which we all know, a PCE of 6.1%. You know, I think the Fed will remain data dependent. I wasn't terribly shocked by the commentary or moved by the commentary earlier today. You know, I mean, at one point we were talking about 50 basis points before the crisis in Ukraine started. So I think the Fed will be data dependent from here going forward. And I do think we will likely be in a range for the foreseeable future. And we'll see how earnings kind of start in the next few weeks.
But Jason, you like technology here, which is interesting given this move in rates. And the path of rates looks to be higher. If today is any indication, and it could be rather swift as well.
Yeah, for sure. I like established tech, you know, obviously companies that are putting off, you know, a lot of free cash flow that are not as tied to the credit markets to continue to scale and grow their businesses. I think those companies will do well. And then I like defensive areas of the marketplace like healthcare, which I think will benefit from preventative care and elective surgeries coming back online. I think those are some of the sectors that could fare well in this environment going forward.
Cameron, this is the great debate, right? Technology is coming off an incredible week. It manages to get off the lows today, but can it really go higher if rates continue to move the same way?
Well, and it's not just about rates. It's about real rates moving higher. And Powell was very clear that he wants to see real rates move higher. And the challenge for tech and growth stocks overall is that tech valuations and growth and real rates move in the opposite direction. So as we saw real rates move deeply negative over the past few years, growth valuations surged to 36 times earnings. Now, as we've seen real rates move higher, those growth valuations have fallen to 25 times earnings. Now, we still think that there could be further downside in growth valuations as those real rates move higher if the Fed is capable of doing that. But the challenge we have is that that will continue to weigh on their performance despite all of those good fundamentals on the earnings standpoint.
All right, guys, we'll see you again soon in Overtime. Cameron and Jason, I appreciate your time. To our Twitter question of Overtime right now, is the Fed going to raise 50 basis points or 25 at the next meeting? That is the topic of the day, given what Jay Powell had to say today. Head over to @CNBC Overtime with your answer. We're going to reveal the winner before the end of the show. I'm curious to see how this ends up today. Now let's bring in Corvex Management's Keith Meister on the markets and where he is placing his bets. It's good to see you. Welcome back.
Hi, Scott. Great to be with you. Congrats on the new show.
Thank you so much. I'll ask you the answer to our Twitter poll first and foremost. They go in 50 or 25 at the next meeting?
I don't know if they're going 50 or 25, but they're going a lot this year, and they're going to end up way higher. If the Fed has to choose between having credibility as in terms of a central bank fighting against inflation or potentially causing recession, I think they'll choose credibility over potentially moving a little too quickly.
So what does that mean for where we are right now in the markets? Last we spoke in October, it sure felt and looked a lot different than it does today, Keith.
Yeah, I think it's a tricky period with a really wide range of possible outcomes. You know, as you said, the Fed pivoted towards the end of last year in the fourth quarter from, you know, acknowledging inflation as transitory to acknowledging inflation being higher than where they would like it to be and being persistent. And the 13 years of QE has now pivoted to QT. I think last week the government finally stopped buying bonds. So we go from a period of time where, as investors, the Fed has had our back and it's been a tailwind to where it's become a headwind. So I think things are harder. At the exact time it's become a headwind, lots of people have argued for the Fed to move sooner such that they wouldn't have to be moving and playing catch up at the same time as we have a geopolitical crisis going on in Europe with a war none of us could have imagined, an energy crisis, a shortage of commodities. So if we had to design an awful backdrop of a wall of worries, it would be the scenario we face today. With that said, balance sheets are strong, The consumer is healthy. American businesses are fantastic. If you're going to allocate capital, I think you want to allocate capital in the U.S. So I think it's a tricky market with a wide range of outcomes. It's not going to be as easy going forward as it's been for the last few years, but there's probably still opportunities to allocate capital and idiosyncratic opportunities and make good risk-adjusted returns.
Well, we're going to get to inside your portfolio in just a bit, but in this new world which you describe, valuations have obviously been adjusting to it. Have they adjusted enough? And that really is the trillion-dollar question as to whether this correction has gone far enough. Have valuations reset enough to reflect the new world you described?
Yeah, look, I think it's the market's made up of lots of individual stocks, and while the indices may only be down 10 to 15% year to date, most tech stocks, as an example, are down over 50% since November. So my answer is, while at 4550, the index feels like it's going to have a hard time breaking out to the upside, I'm certain there's lots of individual companies whose prospects have been over-penalized by the market that may not be directly affected by what's going on in Europe, or may not have commodity headwinds and may have bright futures. So, today we were investors in company Anaplan, which was a financial planning software business, which the space had been hit mid-cap SaaS by the market over the last 6 months as interest rates and real rate concerns have increased. Yet a smart, well-informed private market buyer looking to make a 20+% return was able to buy the business at a 45% premium to where it had been trading over the last 5 days. So clearly there's a real money buyer there who thinks they can create value. So, it's not just so simple as the market being one. I think the overall market will have a hard time breaking out to the upside and could see downside pressure. But I do believe there's idiosyncratic opportunities. And we need to pivot as investors.
Yep. Yeah, forgive me. I was going to ask you, had you been pushing Anaplan to sell itself? Thoma Bravo was on in the last hour. Holden Spate from the firm was on and suggested that they approached the company well before an activist had arrived on the scene. Is that your version of the events as well?
I'm certain that's right. If we're looking in the public markets and seeing an opportunity, I'm sure Thoma Bravo's doing the exact same thing. We have a different way of expressing it. We invest in liquid markets. Anaplan, great company, great product, had a bad quarter in the third quarter of last year. Market overreacts, stock gets hit. We buy lots of stock in the marketplace. We can move very quickly. But Thoma Bravo probably has it joined their radar screen, begins to engage with the company. We can buy, in this case with a partner at 9% of the company, and Thoma Bravo can work more slowly and ultimately negotiate a deal to take the business private. And it's a win-win, because my guess is they're not buying it at 11.5 times consensus 2023 next year's revenue to not invest in the business and help make it more valuable. And I'm sure as a private company, there's things that, in this case, Anaplan can do with the help and partnership of Thoma Bravo that they may not have been able to do in a myopically short-sighted public markets that we're thinking day in and day out. And over 3 to 5 years, my guess is with this ownership structure, Anaplan can be more successful, more valuable. And what we were able to do, and I think this is very important in this environment, by having a strong balance sheet, by being liquid, we were able to take advantage of a market overreaction and provide capital into a very idiosyncratic situation. And as if I think about the last decade, money was made by owning beta. The central banks had our back, interest rates went down, and most assets inflated. My guess is the next decade's not going to be all horrible, but it's not going to be as easy. And money will be made by being more opportunistic and helping to make value or create value in the companies in which we invest, and also being on trend thematically.
It's interesting. I've got Nike earnings coming in less than a minute, and one more question before they do hit the tape. If I have to interrupt you, bear with me. I hope you'll do that. Your positioning is interesting to me. 1/4 of your portfolio in Amazon, Microsoft, and Google, another 1/4 of it in small technology, as you describe it, and then another 50% in idiosyncratic things.
Yeah, that's how we're positioned. Why do we have 25% in Amazon, Microsoft, and Google? They're amazing businesses with great growth profiles that are being transitioned in each case from being founder-led to managed with best-in-class professional management. They have amazing moats and they have great growth profiles, and they trade actually at relatively reasonable valuations. And if you think about the inflationary pressures in the world, tech is a tremendous deflationary force. When times are tough and you need to get costs out of your business, businesses will invest more in software, and businesses like Amazon, Google, and Microsoft are really well positioned to benefit from that at very reasonable valuations. So we're very happy having a chunk of our portfolio there. With that said, for a lot of tech, the move up in rates, while it may make the businesses have higher nominal growth and higher earnings, does affect the valuation. So we're much more comfortable playing in the GARPy side of tech and not the high multiple growth side. With that said, we were able to put new positions on in businesses like Anaplan and Five9, really chasing capital out of our GARPy names when those stocks all went down by about 50% peak to trough. And they're proven, SaaS, enterprise software is God's gift to capitalism. I heard a very smart investor once say, these businesses have 100% recurring revenue. They grow up to 20% a year from existing customers. So without any new sales, they have 20% revenue growth. It's all recurring revenue. It's 80+% gross margin. And when we talk about labor being up, when we talk about food prices, when we talk about commodity prices, they don't have these pressures, and they help real businesses solve these pressures. So I think their future's bright. Their valuations got ahead of themselves, and we had an opportunity to reallocate some capital. I would say this.
Let me do this.
Surprising.
Let me do this if I could. If you'll just bear with me. I see Nike is moving as we speak. Let me get the numbers out. Some quick analysis here. We'll watch the stock move, and then I'll take a break and come back with more from Keith Meister. You've got a beat on the top and bottom from Nike. Of course, there's much more to the story that we need to know. Supply chain, what the business in China was like. Earnings was expected to fall from a year ago. The stock has already declined, so you have to wonder how much was already in the stock. You can see it jumping by 3.5%. Sarah, what do we know about the key details here, specifically China supply chain?
Well, China's coming in a little bit better than expected. It was expected to be a weak spot, and China revenues were down 5%, Scott, but that was pretty much expected to be $2 billion. They were $2.16 billion. We knew that was happening. They're dealing with rolling shutdowns because of COVID, and they're also dealing with a little bit of brand pressure. We saw it from Adidas and really all the Western brands as China has gotten a little more nationalistic. The North America numbers also come in line, which is very important for Nike because that's the home market. Saw 9% growth there, about $3.9 billion. That was expected. I think the overall top and bottom lines look much better. And then there are two things that I would highlight, Scott, in terms of what is important for Nike and for investors to see that the brand strength is still there. That is the digital sales up 19%. Why is that important? Well, these are tough comps for digital. Remember, we're looking at it compared to last year when we were still in the depths of the pandemic with a lot of stores shut. And I would also compare it to what Adidas, I just went back and looked at what Adidas showed for the current quarter, which is digital sales declined 2% on the back of those tough comps. So it shows Nike's strength there. And also the direct sales up 15%. Scott, this is what Nike has had an edge over its competitors, the direct-to-consumer business and the online business. They got a head start, and they continue to grow that business during and now out of the pandemic. So if you're looking for signs that the brand strength is intact amid all these macro factors that impact Nike, you see that in those numbers. Now, they're still vulnerable to the strong dollar, obviously the war in Ukraine, the potential spillover effect on Europe and China, but it looks like they are putting up better numbers. The guidance comes on the call, and that will be key.
Yeah,
that's why the stock is up.
Market likes it thus far. Sarah Eisen, thanks to you, know this company better than anybody. I'll tell you, 87 cents, guys, for an earnings number is strong compared to what the market, I guess, had feared. Look, 90 cents a year ago and 71 cents per share was the estimate. So it comes way ahead of that at 87 cents a share. Sarah's going to have more, I'm sure, in the next 24 hours about the real nuts and bolts of what's happening at Nike. For now, let's bring in Pete Najarian with some instant reaction. He, of course, is the co-founder of MarketRebellion.com. He made a trade in Nike just ahead of the number. What'd you do, Pete?
Well, we had some call buying in there today, Scott. They were buying the March 140 calls. Last week, they were buying the March 135 calls. And when I say March, that means these expire on Friday. But I can tell you, listening to Sarah and going through it myself, I tell you, what stands out for me is that direct-to-consumer up 15% is a huge number because that is where the margins are for Nike. That's what we were looking for. We're looking for any kind of supply, constraints of any kind, and we know how strong Vietnam has been. 80% of the shoes are manufactured in Vietnam. 50% of the apparel manufactured in Vietnam. So very, very critical, and apparently that supply chain not so bad, at least not as bad as maybe expected. And then when you look at China, as she mentioned, China not great, but still down 5% is not the worst thing in the world. And then you get those digital sales up 19%. That shows you the power of the brand, and brands can be monsters, as we know, Scott. So I like what we're seeing here, and this includes obviously not just China, but Europe, Russia, everything across the globe, because this this is such a monster of a company. But I think most importantly, we wanted to see what would happen in China and how's North America holding up. And I think what we're finding out is it's holding up not even just okay, but doing much better than okay, and things are moving along pretty nicely.
Quickly, before I let you go, is it a table turner for you, Pete, somebody who has always said over the last at least year plus, no, I like Lulu better. Nope, I like Lulu better. I don't want to own this stock. And even today, you have an options position on. What makes you buy shares?
Well, I think I'd buy shares, Scott, on any kind of a drop over on the macro side of things, because then I would be a bigger believer in Nike, only because of the fact that we know how stretched the company was. When you looked at those PEs going back to November, we were talking about mid-40s, high 40s. Now, if you look at the forward right now, based upon everything we're seeing, we're talking about close to a 25 PE. So because of that, that attracts me a lot. I still think there's a little bit of a room to the downside. We know we bounced off 117 pretty strong to get to these levels. I think on any pullback close to 117, get to 120, I'd absolutely start filling it up and buying some stock.
Appreciate it very much. Pete Najarian on the phone. We'll see you on the half. I know we will. Thank you, Pete. Coming up, we'll have much more of our exclusive interview with star investor Keith Meister, the stocks he is making big money moves in right now. And later, Skybridge Capital founder Anthony Scaramucci. He is here at Post 9. He's got a lot to say after Jim Chanos revealed a short position in Coinbase on this very program. Stick around. Overtime is right back. We're back now with Corvex Management's Keith Meister with us exclusively today. Thank you so much for being patient with us. Had to get the Nike earnings out in overtime and see what that stock was doing. We mentioned part of your portfolio, in fact, half of it is what you call or characterize idiosyncratic ideas. And you mentioned a name in passing, and I just want to hit a little more on it. 5.9 is one of your best ideas, and then we're going to talk a new position, but why 5.9?
Well, 5.9 is a stock that is 30+% growing company tied to great end markets, which is distributed workforces and something called CCaaS, which is contact center automation. And one of the things that happened as a result of COVID is people realized that workers can be anywhere and you need to have a different way to communicate with your customer. And the concept of moving from old school call centers to distributed cloud-based solutions where you could use automation and AI to take costs out and drive outcomes has really accelerated revenue growth for 5.9. So today the company is growing at over 35% and trades at a lower revenue multiple than prior to COVID. So if I compare 5.9 to Anaplan today was bought at 11.5 times 2023 revenue. If you put a similar multiple on 5.9, you would have a double. 5.9 clearly had strategic interest less than a year ago when they thought about doing a change of control transaction with Zoom at a value of 210. Today, the stock's trading at 105, and they've done a great job of accelerating revenue growth by moving up market, by moving international. Now, why has the stock gone from 210 to 105? A lot of it's because of this existential question about interest rates and valuation. So the business clearly could be worth less in a higher interest rate environment because the NPV of future cash flows may be lower, but the fundamentals of the business are better because of the change that's going on. So because interest rates are higher, because labor costs are higher, more businesses are trying to move more things to the cloud and use companies like Five9 to take costs out. So we think they're a well-managed business with great long-term prospects that could be a highly strategic asset over time.
Yeah, good looking move in the overtime as well, as you're talking about it. You have a new position that we should talk about, Constellation Energy Group, ticker CEG.
Sure. So one of the things I talked about was being thematic. And one of the areas where we're spending a lot of time thinking thematically is about energy transition. And clearly the debate on energy has been way too political over the last few years. But clearly we could all agree on what's needed, which is some level of balance. The US consumer wants access to affordable, reliable energy. And we also want to reduce carbon emissions. And if you think about how we'll do that in the US, the bridge fuel is nuclear. Constellation was spun out of a utility by the name of Exelon on February of this year. It's a $20 billion enterprise with $4 billion of debt, so $16 billion of equity, and open EBITDA of about $3.5 billion. So if it was not hedged in the market today, they'd be making $3.5 billion. So we'd be buying the company at about 5.5 times EBITDA with less than 1 turn leverage and investment grade rating. The business nuclear generates 25% of the electricity in the US, and of that 25%, 20+% is generated by Exelon. So 12.5% of the carbon-free energy in North America is generated by Exelon, yet the company only has a valuation of $16 billion. So our guess of what happens over time is we need to move to more renewables. Nuclear is the bridge fuel, and as gas and oil prices spike as a result of one-off things, as a result of less capital being put into oil and gas because of ESG, there's a nice long-term earnings stream for a company like Exelon. And what happens is nuclear becomes baseload and Exelon becomes an energy infrastructure asset. And there's no reason in the fullness of time why energy infrastructure assets shouldn't trade at 10 or 12 times EBITDA, and the business grows. So we think there's a path to double. And I think one of the real things that happened over the last 18, 24 months is the renewable carbon. The world realized if we want to get to our goals of being carbon free in individual states by 2030 and the like, the way we're going to do it is by embracing nuclear. So we think what that does is it creates these as sort of baseload infrastructure assets and should result in multiple expansion. The opportunity to buy a business that's spun off from utility shareholders during a period of market dislocation where there is no comp, where it is the only large pure play nuclear power plant company in North America is, we think, really attractive. So we think we found a very interesting idiosyncratic situation. We could never have expected to get Build Back Better. If we get Build Back Better, that's incentives for nuclear. There's production tax credits that would increase EBITDA. We never expected the awful tragedy of what's going on in Europe with the energy crisis. But what I think that's helped people realize is we need to invest in nuclear, and having nuclear as a bridge fuel is really, really important. And it's shocking to me that the largest owner of nuclear assets can be bought in the markets for an equity value of $16 billion.
Wow. Okay, we'll keep our eye there too. Lastly, and briefly before I let you go, MGM, I believe you're still on the board. What's the view of Vegas? There's a lot of talk of, certainly in the casino business, about China, impact on Macau. Just how do you see the landscape briefly before I let you run?
Sure. So I guess I would say, simply put, Vegas is back. If you were in Las Vegas this week during March Madness, you would have seen assets that were running essentially at 100% occupancy. MGM did a great job of, there's an expression, never let a crisis go to waste. The team led by Bill Hornbuckle at MGM did an amazing job of looking in during the crisis and saying, how do we manage this business better? No better way to zero-based budget than to actually have to close all of your assets. So in March of 2020, MGM furloughed almost 100% of their employees and had to say, what are we going to do to survive? And then as the pandemic and the world began to reopen, they reopened the assets and they said, if we were starting from scratch, what do we want to keep? And as a result, last quarter, I think MGM had 40% margins versus pre-pandemic historic margins of 30%. Over time, they won't be able to maintain that 1,000 basis points of margin, but they'll maintain a lot of it. So MGM's in a really unique position where they have the best assets in the industry. The U.S. consumer is ready to go back out and be social. And MGM is sitting with assets that are really, really well managed. We have $5 billion plus of net cash. So in addition to moving very aggressively to reduce our equity capitalization through buybacks, we're investing for growth. We bought the 50% of City Center we did not own. We bought the Cosmopolitan from Blackstone. We have a once-in-a-generation potential opportunity to develop a mega resort in Japan. So I think MGM's future is bright. There'll be ups and downs because it is a consumer levered cyclical, but it's got a great management, great asset base. And I think the other thing, which I can't believe I haven't talked about, which is sports betting and iGaming, the MGM brand and what we've done with BetMGM has been nothing short of amazing. We took a business from zero to, I think it's supposed to do over $1.435 billion of revenue this year from scratch. And I think if we look forward a decade, you'll see as much gambling done online as you'll see in brick and mortar casinos, and MGM's in a great position to be one of the winners there.
Good to see you in overtime, Keith. I appreciate it very much. That's Keith Meister of Corvex Management. We'll see you soon. All right, it's time for a CNBC News update now with Shepard Smith. Hey, Shep.
Hey, Scott. From the news on CNBC, here's what's happening now. On the verge of a stalemate. That's how a senior NATO intelligence officer is describing the situation in Ukraine to NBC News. Ukrainian forces have Russian troops stalled, they tell us, but Putin shows no sign of backing down. The assessment comes just 2 days before President Biden heads to Europe for a major NATO summit on Thursday. A historic Senate confirmation hearing underway today. Judge Ketanji Brown Jackson made her opening statement to the Senate Judiciary Committee. The first black woman ever nominated, she pledged transparency. Judge Jackson thanked her family for a lifetime of support and acknowledged many mentors, including the man she is nominated to replace, Justice Stephen Breyer.
It is extremely humbling to be considered for Justice Breyer's seat, and I know that I could never fill his shoes. But if confirmed, I would hope to carry on his spirit.
Well, beginning tomorrow, senators from both sides of the political aisle will question Judge Jackson on her judicial philosophy. And a crackdown on spring breakers in South Florida. The city of Miami Beach just declared a state of emergency this afternoon. It follows a weekend of violence with 2 separate shootings that hospitalized 5 people. Curfews will now be in place in Miami Beach, beginning Thursdays through the weekends during spring break. Tonight, searching the wreckage in China. Investigators try to determine what caused a Boeing 737 passenger jet to crash with more than 130 people reported on board. We're live in Beijing right after Jim Cramer, 7 Eastern, CNBC. Scott, back to you.
All right, Shep, appreciate that. We'll see you then. Up next, the coin collapse. Coinbase falling hard in today's session. Legendary short seller Jim Chanos telling us right here on Friday he is short that stock. The move has Skybridge Capital founder Anthony Scaramucci all fired up. You haven't seen that before. Why he says proceed with caution. The mooch is here. We'll talk next. Give you a quick look at Nike shares in the OT. A beat on the top and the bottom line. Obviously, the stock likes that story. Highs of the session now in overtime up almost 6%. Keep our eyes on that one for certain. In today's halftime overtime, reaction to Jim Chanos' Coinbase short revealed right here in overtime on Friday. And Bryn Talkington's rebuttal today. Listen.
We think that as competition increases in crypto, and this is not a call on crypto or Bitcoin prices or anything like that, but we think as competition increases amongst the exchanges, you're going to see fee compression. And as it is, Coinbase will probably not be profitable this year with a $40 billion market cap.
I think his thesis that he shared with you on Friday that, over time margins will come down because fees compression from trading will come down. I don't think that's a secret, and I think you would need more to short the stock. There's so many different verticals that are happening that I think shorting that today is just short-sighted when you're only looking at the trading aspect.
All right, for more, let's bring in Anthony Scaramucci, the founder of Skybridge Capital, a CNBC contributor. Welcome to Overtime. It's good to have you.
It's great to be here, and congratulations on the new show.
Thank you. They said you're all fired up. Are you defending Coinbase, or what's the story?
Oh, listen, I have an enormous amount of respect for Jim, but I think he's analyzing it like a brokerage stock, like it was a Morgan Stanley.
Yeah, like a Schwab back in the day.
Yeah, and I think that's where he's making the mistake.
Why?
Because there's an exponential growth in what's going to happen in the cryptocurrency markets. There's a likelihood of a cash ETF, if not at the end of this year, certainly by the end of next year. And there's going to be a proliferation of the market. So even though if the margins are coming down, and he's probably right about that, there will be just explosive growth that Coinbase is going to capture. And what's interesting about what Jim is saying, nowhere have I read anywhere that he thinks that there's fraud at the company like he did in things like Enron and other things that he potentially shorted. So this could be, and I'm not being offensive to him because he's a brilliant guy, so I'm actually analyzing my position. And we do own the stock, Scott, so I want to be clear about that. But it's like a TradeFi guy looking at DeFi space with TradeFi analytics. And I would actually caution him to do that and spend some more time with the company to see all the different things that they're working on and all the potential revenue avenues. I should also point out I own privately FTX and Kraken.
The Goldman move today, the first over-the-counter trade in options. Yeah. How significant is it? I mean, you did that 18 months ago, but for the credibility, if you will, of the asset class itself, does it mean anything for that?
Well, I think it does, and I'll take people back to the junk bond market in the early 80s. Goldman Sachs was very, very reluctant in that market. They waited longer than the other people, but then they built a massive junk bond department. And I think this is apropos to Goldman's culture. They like to sit back and wait and see other people potentially innovate. But then when they come in, they usually come in very large size and scale, and they have a tendency to dominate markets. So I like that. That's telling me that they have demand for Bitcoin and crypto-related products. And I would imagine that business is going to be a very big growth business for them over the next 6 to 12 months. And by the way, their competitors are looking at that, and they're also going to get in that space, which again speaks against the long-term macro fundamentals of what Jim is saying.
So I know you heard the conversation I had with Jeffrey Gundlach last week about Bitcoin versus gold and what was the better bet in this new Fed environment, at least for the near term. He said Bitcoin, which obviously I know you agree with, but let me ask you this. When does Bitcoin stop being such a speculative asset? I ask you that in the context of you've got people like Jack Dorsey saying, well, Bitcoin's going to replace the dollar. The dollar's not a speculative asset, right? The dollar does not move wildly like Bitcoin does. When does it stop, and what stops that?
Well, we've had these conversations off the air. I have never said Bitcoin is an inflation hedge. I don't believe it is. I have not said that it's a store of value today. I believe it can become those things, Scott. It has about 3% market saturation. However you want to measure it, Mike Novogratz says there's 140 million Bitcoin owners. Glassnode says there's 240 million wallets. However you want to measure it, it's 2 to 3% market saturated. Take Goldman Sachs' example, stepping in now. If there's a cash ETF, there'll be broader demand for Bitcoin. If Bitcoin got to 1 billion wallets, then I would look at you and say this is probably a $300,000 to $400,000 coin, and it becomes more stable. And I would go back to Amazon. Amazon went from a $10,000 investment on its IPO to $21 million. But Scott, you had to go through 8 or 9 times where it dipped 50% in value, once where it was down 90. And so these things take a while to mature. But look at Amazon last year. It was one of the least volatile stocks in the marketplace because it was saturated. So you need Bitcoin to get saturated in terms of its ownership before you and I can look at it as a store of value or an inflation.
Well, how long is that going to take?
I think it's.
But we got people making that argument today that it's a store of value and all this other stuff. It sounds nonsensical.
Well, I think it's a premature argument based on what Bitcoin is doing and based on the tactical properties of Bitcoin and all the fear and uncertainty and doubt. Warren Buffett's calling it rat poison. Charlie Munger says it's the worst thing that ever happened to the civilization. But Goldman Sachs wading into it, you're one step closer to that. But I think it's 3 or 4 years from now. If you look at the exponential adoption of Bitcoin, where it is today, could it be at 3 to 500 million wallets by year end? It's very, very possible. Could it be at 1 billion wallets by the end of 2024? Kathy Wood says so. She's a very smart analyst. Let's take her word on that. If that's the case, Bitcoin is a $400,000 to $500,000 coin asset. It's saturated. You and I will be discussing it as a store of value and a potential inflation hedge.
I hope we're discussing it many times in overtime.
Yeah, me too.
Thanks for being here. It's good to see you in person, by the way. That's Anthony Scaramucci of Skybridge. Coming up, a turning tide. Deutsche Bank out with a big call on EV maker NIO. The analyst thinks the stock could double. We'll press him on that call next. Breaking news, a change in forecast and a big one from the White House on supply chain issues. Our Kayla Tausche has those details right now. Kayla?
Well, Scott, the increasingly pessimistic outlook is wrought by one thing in particular, and that is the
Russian invasion of Ukraine that has prolonged the geopolitical and financial uncertainty. That was the focus of a conversation today at the White House with top officials on the economic and national security realm and 16 executives ranging from the CEOs of JP Morgan Chase, Bank of America, Visa to ExxonMobil and Chevron. Earlier this afternoon, after that meeting concluded, I spoke to Commerce Secretary Gina Raimondo, who participated in that meeting, and this was her recap of the conversation as it took place and that outlook that you just mentioned.
We need to be prepared for the worst, which is quite a long-term disruption. We're also prepared for this to last quite a long time. And that was the message to the CEOs, but they are all already thinking that way and preparing. We're in a scenario planning situation.
She said that the export controls that the Commerce Department has already announced have had a significant, in her words, impact on the Russian economy, and that the administration remains committed to using every tool available to try to end the war and pressure President Putin to end the war as quickly as possible, but acknowledging that just simply might not be possible. I also asked her about the administration's stance toward China, what consideration it is giving to possible sanctions, counter sanctions on China if it does decide to assist Russia in its efforts. She would not go there, but Scott, that is going to be a big topic of discussion this week in Brussels when leaders of allied countries meet there. Scott?
All right. Kayla, appreciate it. That's Kayla Tausche, the White House, the backdrop for us. Thank you. Still ahead, the stocks making the biggest moves in overtime. Plus, Santoli's last word, why he thinks Powell's path to a soft landing could be rockier than expected. News alert on Disney. Our Julia Borson has those details. Julia?
Yes, Scott, an update on Disney's meeting with its employees to address frustration around its handling of the so-called Don't Say Gay bill in Florida. CEO Bob Chapek saying he knew he made mistakes and wanted to use this as a catalyst for meaningful change, announcing that he's going on a listening tour. He also said they're starting a company-wide task force to develop strategy and concrete actions to engage LGBTQ plus employees and creators to be a force for good for those LGBTQ plus communities, with a focus on developing more content in this arena. Also saying they signed the Human Rights Campaign opposing the policy in Texas that criminalizes parents providing gender-affirming care for transgender minors. Guys, back over to you.
All right, that's Julia Borson for us. Thank you for that. After the break, Santoli's last word and the hard truth about a soft landing. We'll be right back. Oh, it's time for Mike Santoli and Santoli's last word, which is today.
Well, soft landing is two words. Might be a little bit of a tough road to get there. Jay Powell today saying he believes that they can engineer a soft landing. It's plausible. I remember '94. I think that's when Greenspan basically made his bones about Maestro. Shock value to the initial rate hikes and then feathering the brake and then letting off. Now, the issue is the market has a lot of room to spook itself along the way when you have the opportunity for accelerating bigger hikes, things like that. I think that's what we're in for. Any rally in risk assets loosens financial conditions and basically gives the Fed more slack to tighten them up again. So that's the cycle we might be on.
Look at the 210 spread here. This is the market casting its doubt as to whether they think Powell and company can do it.
Look, it's
at
still
least in
plausible. They think that they're going to have a path to 2% plus on the short end. The question is, if something breaks along the way, and that's always the issue, then they're not going to have clearance to just go that in a straight line. And therefore, the economy is either going to moderate or inflation's going to come back into line and they can calm down a little bit.
Tightest it's been in this cycle, at least,
Absolutely.
right? These 17 bips. All right, Mike Santoli, thank you very much. Coming up, it's our 2-minute drill, 3 picks for your portfolio overtime. We'll be right back. Now to the results of our Twitter question of the day in OT. We asked how many basis points will the Fed hike interest rates at the next meeting, 25 or 50? And I'm not surprised at all by this answer. 50 basis points is the winner. 58% of you thought that, compared to 42% for 25 bips. We're going to see what happens, but it certainly seems like Jay Powell and company are setting the table. Now it's the 2-minute drill. Vanrian Capital Management founder and president Shana Sissel joins us now with her top picks. Good to see you in overtime. Your top pick right now, or at least one of them, Camden Property Trust, CPT. Why?
Well, primarily because housing and rental housing are in big demand right now, especially in certain geographies. There is a huge migratory trend going on, and Camden is in the sweet spots. They have 30% of their properties in Texas. They have exposure to Nashville, North Carolina, Florida, Phoenix, Denver, all the places where people are moving. So there's a big demand for their properties. They have 95% occupancy, 98% rent collection. And this is an area where I think in this market, you want the dividend yield. It's a good place to be right now when you look at high inflation and rising rates.
The next one is just absolutely shocking. Not Apple.
Apple is, I'd like to say it's the favorite of the talking heads, and I say that facetiously because I'm one of those talking heads. But it is a name that has strong brand loyalty, has steady growth, good management, strong balance sheet. It's trading at a 26-time forward multiple. This is the time I want to be buying Apple. Tech is definitely going to have headwinds as rates go up, but there are pockets of opportunity here, and Apple is one of those names.
All right, I appreciate it. The last one is NVIDIA, which is just ahead of its, I think it's shareholder meeting or analyst day, or one or the other. Anyway, it's good to see you. Shana, thanks. We'll have you back in overtime sometime soon. Want to remind you as well, tomorrow, don't miss our interview with legendary investor Carl Icahn. He's going to be right here to talk about the markets. Haven't heard from him in a while. We'll see how he is positioned. That does it for us today in overtime. I'll see you tomorrow. Fast Money begins now.
Live from the NASDAQ market site overlooking New York City's Times Square, this is Fast Money. I'm Melissa Lee. Tonight's trader lineup, Tim Seymour, Guy Adami, Dan Nathan, and Brian Kelly ahead on Fast. Nike just does it. Shares jumping after the company's latest earnings report. We're dialed into the call. We'll bring you all the details. Plus, the C-suite at Disney, not exactly the happiest place on earth. There's a rift in the relationship between former CEO Bob Iger and the man who replaced him, Bob Chapek. And beyond the frosty relationship, the moves by the new boss have been getting a cold shoulder on Wall Street. Inside Disney's rocky ride straight ahead. And later, another headbanging day for the metals and the miners. The XME, the ETF that tracks the sector, up for the 5th straight day, hitting its highest level in over a decade. Tim and BK ready to rock out on that heavy metal trade. But we start off with Jerome Powell sounding the alarm on inflation. The Fed chair admitting the central bank has widely underestimated the rise in prices and suggesting even more aggressive rate hikes than he just laid out last week. His comments said markets on a roller coaster ride this afternoon. The S&P sank nearly 1% immediately after Powell spoke. And despite a late day comeback, end of the day with its first loss in 5 sessions. So will this more hawkish tone put a permanent end to last week's rally? It was how many days? It wasn't even a week ago.
4.
It was 4 days ago, including a weekend.
Yes.
Including a weekend. So what happened?
They were talking.
What happened, Tim?
Well, I think what we heard from Bullard last week, and I think on Friday he said, hey, why is it we have to hear this now when in September there was no sign of inflation and they're telling us about 50 now? And these were the first real comments after the Powell press conference. And look, you get the sense that the Fed it's not just concerned about inflation, but really understands that there are structural issues in this inflation. So if you look at the curve, it was actually the short end that outperformed and took over from where we zigzagged a bit on Wednesday of the Fed meeting. You're up 19 points, 19 basis points on the short end of the curve. Market did a lot of pricing in today, and as we just heard on Scott's show, I mean, there are people that kind of believe 50 is the status quo, but the long end, Treasury rates are breaking out. It's not great for equities. I will say, I thought stocks were champs today on a day when after, an 11% rally in the NASDAQ off of last Monday's low and Powell dropping this bomb on you. Great job by equities.
Especially because it wasn't just one 50 basis point hike. I mean, it sounded like he was opening the door to a couple of 50 basis points. There's nothing to prevent the Fed, I'm paraphrasing, but nothing to prevent the Fed from multiple 50 basis point hikes.
So they're finally on the right track without question. And Tim is spot on. We play a lot of games on the show, as you know.
So many.
And one of the games is, if you had told me 24 hours ago, Mel, what would happen?
One of our favorites.
That's one of my personal
Mine
favorites.
too.
No, it's not. You're lying like a rug. But I got to tell you something. Given the rally we saw last week that Tim just alluded to, if you had told me those comments were going to come out around 12:45, BK was watching them as we were on our call, I'd be like, easy, the S&P's down 80 handles, given what we saw last week in that rally. And at one point, the S&P was down, 25, 30 handles, until it rallied back about 35 handles. It's a remarkable the day. Now, we could say that the bond market is pricing this all in, but I'm here to tell you there's no way the equity market is pricing
And volatility was down. Again, in a world where I've always said more Fed equals more volatility, I don't feel very rewarded by that statement right now.
So what do we need to do? And I use we, I guess like the royal we, or we as in the markets, we, Brian Kelly. I mean, if we are to believe that 50 basis points, even maybe more than 50 basis points can happen at the next couple of meetings, what do we need to price in at this point? What is not priced in?
Well, there's a couple things not priced in. Number one is earnings downgrades, right? We haven't seen really any earnings downgrades from anybody out there. That would be a shock to the market. And then number two, this is going to sound a little strange, but if you go further out on the curve to 2 or 3 years, you're actually starting to see the market price in rate cuts. And I think that's what's buoying stocks, because analysts are saying, hey, listen, Fed's going to raise rates by 50 basis points, 100 basis points. It's going to be short and sharp. You're going to crush inflation. Yeah, we might have a quarter or two of a growth scare, but after that, it's clear sailing. So what we need to price in is actually the Fed raising rates for a longer period of time before the equity market says, hey, this is a problem. To me right now, though, the bond market, short the bond market's the easiest trade. Long dollar, short bonds. You guys can all trade your equities. I'd rather trade those.
Dan, what's your take?
Yeah, I just tell you this. In my career, when we've had surprise moves by the Fed, either cutting because they're worried about some sort of shock to the system, or in the instance of maybe a surprise rate hike, the stock market usually does the opposite of what they intended to do. So I don't think stock market investors are really braced particularly well for any sort of big surprises. I think that you made the point, Mel, that last week we heard from Powell, and then today we hear from Powell, and they don't seem to like the kind of ratcheting up of the hawkish sort of sentiment. And to Tim's point, fine, yeah, stocks acted pretty well today in the face of that. But if there are any surprise hikes here, I think the knee-jerk reaction is lower. And then BK mentioned the one thing that the equity market participants don't seem to be kind of focused on right here is that current consensus for S&P 500 earnings this year are expected to be up 8.5%, 9% year over year. That's just not happening. That's taking us back to that PPI reading that you're seeing in Germany right now. And I don't care. I know we're going to talk about Nike in a few minutes here. I don't care what they just printed on this backward-looking quarter. I want to hear about the visibility they have going forward here. And I don't think it's going to be particularly great. I don't mean to sound so dire about this, but it really does seem like a lot of analysts right now are kind of whistling past the graveyard here. This is not going to set up to be the 2022 earnings per share year for the S&P 500 that most strategists had just 3 months ago.
Not sure that a lot of strategists, a lot of analysts have priced in a major slowdown in Europe, a major price spike in Europe. And we showed it is not too often on Fast Money where we talk about German PPI, but 25.9% is an eye catcher. And of course, that's a leading indicator for consumer price spikes to come. And this, by the way, has not factored in the impact, the inflationary impact from the Russia-Ukraine conflict. And that is the problem. So what are we haven't priced in a whole lot, Tim.
Where 45% of German gas is coming from the east. And look, if you look at Germany, if you look at European stocks, look at the Euro Stoxx 50. It actually traded back almost 5-year levels at the lows of last week. So I think European stocks have actually reacted to the downside. They've priced in a lot. Look at the 10-year Bund yield. And again, I'm sure people are not doing this every day when they wake up, but higher rates across Europe certainly are good in the short term for their banks. But remember, we were worried about Europe about a decade ago, and that's just something I would caution. I'd quickly just say, though, Dan talked about the bond market. A 2-year at 210, 215, 220, and this gets to what you were saying, Mel, about maybe at some point the market believes that the Fed's going to overshoot and they're starting to price in. BK was saying this too. Buy me some 2-year at 220. I think that's a great trade, and I actually think you're going to be well rewarded for owning the 2-year here.
You know, it's interesting. We do talk about Europe once in a while. I mean, Germany, I think, still the 5th largest economy on the planet. When you add together the Eurozone, that's the largest economy in the world, and it's 450 million people. We're about 330. It's significant, is my point, and they're clearly slowing down. It will have ramifications here. And talk about the yield curve. We talk about 2s, 10s flattening. Well, 5 10s have inverted effectively, or now flat. I mean, that's not particularly bullish for equities. And again, you have to ask yourself, to Dan's point about earnings, what's the right multiple in a slowing growth, in my opinion, rising interest rate environment? And I don't think we're anywhere close to where we should be.
So then you go back to a big cap technology, Brian Kelly, and do you think that we are in the setup that supports the notion that you want to be in growth that is idiosyncratic? That during a time of economic slowdown here, you want to be in sort of these solid companies that have the growth and have the balance sheets?
Yeah, I mean, I'm not sure that this is that exact same environment. You know, we're looking at there are a lot of risks out there that have not been priced in, and the Nasdaq has shown you that the higher rates go, the more they trade as a monolith, right? So that idiosyncratic growth, it might be good for a trade here or there, but I'm not sure that you can stake your entire portfolio on that. Because, you know, as Guy just said, everybody's just talking about Europe slowing down. We already know that China slowed. They're starting to stimulate a bit, so maybe something happens there. But Powell said today they're going to raise rates, and they're going to raise rates above the neutral rate, meaning they are going to slow the economy down. So the U.S. economy is going to slow. So I don't care if you have a great balance sheet, a fortress balance sheet, whatever people want to say. If the U.S. economy slows, your earnings are going to go lower, and therefore your stock price goes lower. At least that's what I was taught.
If you can't stake your portfolio on these big cap tech companies, then that's just too bad for most Americans out there, unfortunately, Dan, because that's what people have.
Yeah, and I guess we've had this conversation. You know, when you think about those top 5 or 6 names, and they make up close to 25% of the S&P 500 and about half of the NASDAQ or the NDX, the NASDAQ 100, I mean, you know, if you own funds, if you own these ETFs, I mean, you're there. But here's the good news, Mel. They act pretty well. You know, I'm looking at the Dow Jones Industrial Average down 5% on the year, and the S&P 500 down only 6.5% of the year. So it's become a very concentrated trade. Guy talks about all the time how many different funds and ETFs all of those big names are in. So we're all in this together. We talk about single names kind of often, and this show's called Fast Money, and there's been plenty of volatility. If you were nimble and you want to trade, there's lots of money to be made and to be lost here. And what's proving to be true is that the safest place to be is obviously in the SPY, in the QQQ, in this sort of volatile environment.
So I hear you on the We Are the World, We Are the Children, Dan. But I was doing some screening today of where stocks have moved after this big move, and even with last week's snapback, and Google jumps off the page. Google times, based upon 22 EPS, is trading at a 0.5 PEG ratio. So a quick trade school for folks. What is a PEG ratio? It's price to earnings growth. It's clearly a measure of what you're paying for a company and how much growth is there. And Google, to me, which is one of the largest companies in the world, is absurdly cheap at these levels now. If I'm making my list and checking it twice, it's absolutely looking for companies like this, even in down days. Guys smirking over here. I can't wait for this. But this is a place where you are putting that list together. And if you don't own Google, it's very cheap now. It may get cheaper, but nobody rings a bell.
Do you think if Tim was in that We Are the World video, he wore his vest for it? It's my sense.
Maybe just a vest, guy.
Just a vest. That would have been.
It's a family show, gentlemen.
Where's the Paris Hilton drop?
Is that all you have to say, or do you have a trade?
No, I don't. I just was visualizing Tim in that video with a vest on.
You can't unsee certain things, so let's not keep talking about it. We've got an earnings alert here we want to move on to. Nike shares just swooshing higher after its latest report. The company's conference call is underway. Sarah Eisen is listening in. Hi, Sarah.
Hi, Melissa. Nike again showing its resilience here in the face of everything going on in the world. Slower global growth, of course, weakness around Europe, potentially in the war in Ukraine, supply chain issues. John Donahoe, the CEO, just kicking off the conference call. He starts, as he always starts, naming some of the highlights from the quarter from the sports world, including the Winter Olympics, the fact that a lot of Nike teams are live in the men's and women's March Madness brackets, that sort of stuff that keeps investors excited. As far as the results, 2 things that were positive surprises that I wanted to flag. Digital growth 19% there. That was better than expected. Also lapping some tough comparisons from the middle of the pandemic last year. So that was a highlight. Also saw some weakness there on the Adidas quarter recently. Also direct to consumer. This has been Nike's really strong force and its higher profit business where it sells directly through its sneaker app, digital, or its stores, also growing 15%. If you go beneath the surface, some of the worries in terms of the geographies came in pretty much in line. China sales, for instance, at $2 billion, that was what the market was expecting. It's a decline of 5%, but it was out there. North American sales, the key market, up 9%, also coming in line with what was expected. Now, coming into this quarter, the stock was down 22% for the year so far. There was a lot of hand-wringing over issues like supply chain, which has hurt Nike sales in the past. And the company CFO in the earnings release does note that the supply chains are ongoing and says that marketplace demand continues to significantly exceed available inventory supply. On that note, inventories were a little bloated. They're up 15% from last year, but the company did say consumer demand is helping to offset that. So, Melissa, the key will be from here, what does this company say about the outlook? The outlook and the guidance always comes on the earnings call, so I should expect that from the CFO in a few minutes. I'll let you know what they say, but that's going to be key, especially around China, given potential deterioration in the outlook because of the rolling shutdowns around COVID and supply chain, and what they're going to say overall, given that we're in a different picture here with global growth than we were just 3 months ago. So far, it's all been coming in either in line or better than expected, and that's why you see the stock reacting with a sigh of relief.
All right, Sarah, keep us posted. Thank you, Sarah Eisen from the NYSE on Nike. So the quarter ended February 28th. So that includes some of the impact that we saw in terms of commodities, supply chain issues, et cetera. But the nuance and the contours, I think, of demand throughout the quarter will be key, Tim.
They will. I don't think Nike can have outlook into the end of the year right now, and I think you have to be careful here, but there's no question we want to hear it. This is what I said. These are the types of headlines we've looked at various times with Nike. It's been a leader. Dan's right. You know, we don't know. We know what maybe the Fed is pricing in. We know what multiple the market's going to put on stocks that are in the face of a different economy as we get into the third quarter. And I think we hope Nike can do that. But if you think about DT sales up 17% off a really tough comp, and think about where we were a year ago when that's all people could do, and in many cases, it is actually a way to deal with lean inventories. You walk into a lot of stores, they don't have the Nike products, go straight to Nike. Certainly helps margins. Long Nike, but at 36 to 37 times in this environment times next year, be careful.
Go back and look at last summer. The stock sold off. It traded, I think, from like the mid 150s down to sort of 148, 150, and then bounced to an all-time high. The 50% retracement of that recent all-time high and this low we just made comes in around 150. And I will tell you, Mel, because I remember like that large animal, that large land animal with the tough
rhino. Yes.
Rhino, I have a memory like one that Carter Worth was on last week and said exactly this would happen. And we pointed out the opportunity for it to get back to that 148 level. So I think it actually gets there. I think you fade it when it does.
36, 35 forward. Brian Kelly, what does that price in your view? Tim said be careful.
Yeah, well, listen, it prices in a consumer that is going to continue to spend and a Federal Reserve and an economy that's going to be, that you're going to be okay with. I happen to think that's not right. I happen to think that Powell just told you they do not want the consumer to spend more. That's what demand destruction is all about. But it's probably what's been priced into the stock down from $180. So I'm kind of with Guy on this. Up to 150, you probably fade that. You get a bear market rally here. And then when people realize that the consumer is not going to hold up, that's when you want to sell this thing again.
Yeah, but the consumer is pretty, I mean, they're holding up right now. They've got good balance sheets. They've got jobs. Dan, maybe this is the exact kind of stock you want to be in this environment.
Hey, Mel, what show are you participating in here? I mean, I don't know if you saw where gas at the pump is, where mortgage rates are going, where the Fed is raising rates here, and how quickly they're doing it. Wait, Tim, you just eye-rolled me. I have return here, buddy. I can see that.
It was,
okay?
You know, it wasn't an eye roll as much as it was a smirk. I mean, it was,
okay,
you know, it's
fair
an aggressive
enough. Okay,
statement.
but I just want you to be very clear on that. I mean, I'll just say it's like, to me, when you're looking at estimates for earnings and sales to be up double digits here, you know, sales is expected to be up next year, fiscal 2023. 2023 up 13, 14%, and earnings up 20%. And on a PE to growth, Tim might say at 27 times next year, that might be reasonable, but you have to believe that number for next year. The good news here is all that discussion about DTC, they're expected to have the highest gross margin in fiscal 2023 than they've had in a decade, about 47.5% or so. And that really does speak to some of the changes that have been underfoot. See what I did there? For this company over the last few years. I just don't know if those out-year estimates are reliable right now.
All right, coming up, a Disney dispute, relationship strains between CEO Bob Iger and former head, between CEO Bob Chapek and former head Robert Iger. So what does that mean for the future of the company? We'll break it down next. But first, Boeing in focus after a fatal 737 crash in China. Investigators still working to discover the cause. We've got more on that next. Don't go anywhere. Fast Money's back in 2. Welcome back to Fast Money. Boeing shares dropping more than 3.5% today after a Boeing 737-800 plane crashed in southern China. It was operated by China Eastern Airlines and had 132 people on board. The stock has lost more than half its value over the last 3 years. 3.5%. Tim, you still own this one?
I do. Look, this is a horrible tragedy. And unfortunately, there's been too much of this around Boeing. The big issue for Boeing out of this is one of the drivers for the stock was essentially recommissioning and redelivering MAX 737s to China. And that was part of where analysts were getting ready to upgrade this stock. If you look at the overall airline sector as well today, look, the spike in oil is really what I think is pushing down not only Boeing and airlines, and I think they were very highly correlated today. But this is something to watch. How the Chinese government responds to this is very important for the direction of Boeing stock.
It seems like the response is pretty swift. I mean, China Eastern grounded all of its Boeing 737-800s immediately, and President Xi stepped in and said that he wants to know the cause of this. So he was calling for an investigation that was, going to be very speedy. Brian Kelly, Phil LeBeau early this morning, initially when the news hit, he made the point that in the past, Boeing shares usually drop on the back of such news and then recover. But do you think that that playbook is still in play now?
I don't, because I think there's too many cross currents here. So, I mean, number one, you saw how swiftly, you mentioned how swiftly they moved, and the fact that, they're going to ground all of those things. That would have never happened in the past. So that's something relatively new. But secondarily, we talk about the slowing economy, slowing global economy. That's really what the driver of Boeing is. Are you going to sell more planes? And I don't think there's going to be that demand. So I think this is a little different situation here. You want to trade Boeing between, where is it, 170 and 200? As Dan would say, have at it. But I don't think you're going to have a nice trend in Boeing here.
What's interesting about Boeing, and I think Tim would agree with this, at this price, I'm not saying you're totally dismissing their defense part of their company, but to a large extent you are. I mean, this is a company that would still probably do $100 billion in revenue for the year, trades about $105 billion market cap. I mean, you can start doing back of the envelope math and say, at a certain point, it's too cheap. Now, the headline risk, as we've all learned, is significant, but you're going to get to a point where you almost have to buy it just for the defense portion by itself, in my opinion.
But if you wanted the defense play, you would just have a defense stock, right? I mean, why would you bother?
Yes, except for the fact that it's being punished as it only has a business selling commercial airlines and aircraft into the airlines, and defense is 40-ish% of their business. So I hear that, and I do think that we've also had an enormous run in defense names, and I don't think Boeing got that same benefit.
All right, we are just getting started here on Fast Money. Here's what's coming up next.
A mouse house divided. Past and present heads of Disney falling out. Should investors fear this Disney dissension? The details are next. Plus, get ready for some heavy metal. The group hitting its highest level in over a decade. So, time to crank this trade to 11? The traders break it down ahead. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money. There's a battle going on at Disney, a new CNBC exclusive from our Alex Sherman of CNBC.com detailing the rift between current CEO Bob Chapek and his storied predecessor Bob Iger. And beyond the tension between the execs, there are growing concerns about the course the current regime is charting. Disney's had a rough go of it this year, down over 10%. Today, it dropped to just over 1%. Let's bring in a New York Times columnist who wrote the book on Disney, CNBC contributor Jim Stewart. Jim, always great to get your take on these things.
Great, good to be with you.
Is it your sense that there is a rift going on? Before, the men seemed to be close. It was reported that they would talk almost every single day, and that just has not happened lately.
No, as CNBC really has been out in front on that story. But I think this is really the tip of an iceberg, if you want to call it that. The rift is just part of a much broader problem, I think, that the new management, led by CEO Bob Chapek, is confronting at Disney. There have been growing morale problems, ever more open criticism of some of the management decisions that have been made, these constant reshufflings of executive lines of authority, and then finally culminating in this fiasco over the Don't Say Gay law in Florida, which has now managed to alienate pretty much everybody. It is, I think, a growing cause for concern among many investors about, after years of a very smooth, well-oiled managed machine there, a company that in some ways looks like it might be going off the rails.
Would it be too big of a jump to say that perhaps Bob Chapek's days are numbered?
I wouldn't want to go there yet. After all, this board put him in place not that long ago. To now decide they need to replace him would be essentially admitting that they made a monumental mistake. And I don't know that the data is there yet to take such a precipitous step. But something has got to change there. I mean, I've been hearing now for months from many of my sources in Disney about the mounting dismay and the dissatisfaction there. The sort of the tone-deaf quality coming out of the executive suite. The decisions that, have really caused morale issues. Take the decision to move the Imagineers from Southern California to Florida to save $500 million over 20 years. The people on the outside, I think, don't understand the Imagineers. That is the heart of the Disney company. That was Walt Disney's personal baby, and they're highly creative, highly respected within the company. And they're all extremely upset about this. And while the money sounds good, when you realize it's $500 million over 20 years, that's $25 million a year in savings. Really, for a company like Disney, that's barely a rounding error. And it has created this massive dissatisfaction there.
Hey, Jim, it's Tim Seymour. Hear you on that, and certainly that kind of dysfunction at the top could hinder the creative process. But quickly, as you look at the studio and you look at the release schedule and the slate, and really what is this powerful flywheel dynamic for Disney into their distribution and their theme parks, how are you assessing the next 12 months?
Well, I think they have been performing very well. I mean, the recent earnings were quite good. The stock has not responded for reasons I think that go beyond the immediate earnings issues, but I think the company has been working well. The problem is that that the creative thing is the heart of the company, and there is no more industry than Hollywood entertainment that depends on relationships. And Bob Iger was the master of that. He could take a star, a director, a studio executive to lunch or dinner, and they always came out feeling great about it. It's going to be hard to replace him in that respect, but Chapek has not shown that interest in or affinity for the creative people that fuel that pipeline into Disney. And many of these recent successful projects have their roots, years ago. And Iger himself continued to play a very big role in the creative process until he left finally not that long ago. So I think that this is one of the things that people worry most about, which is Chapek's relationship to the creative community.
Any chance maybe that Bob Iger could come back down the road? I mean, we just saw it with between Kevin Johnson and Howard Schultz, so it's making everybody think, bring back the storied predecessor.
Well, I would never say never. I think that's an unlikely scenario. Bob had a long run there, very, very successful. I'm not sure that he would want to step back in, except on maybe a very short-term basis. But there is, and again, I don't think the board is anywhere near replacing Chapek at this point, but there are candidates out there. I mean, Disney has a long tradition of promoting from within, but in their former COO, Tom Staggs, and Kevin Mayer, who was the architect of their very successful streaming strategy on which they've now pinned the company, they do have two former executives sitting out there who would certainly seem to be very viable replacements should they reach the decision that they need to do that. But by no way am I suggesting that the board is at the point of getting rid of their recently handpicked choice as CEO.
Yeah. Jim, always great to speak with you. Thank you for your time.
Thank you.
James Stewart of the New York Times. Guy, what's Disney's biggest problem?
I think that's exactly their biggest problem. The fact that now they have the bullseye on their back and the market's shooting first and asking questions later. That's a big problem. What's really working for them, go back to February 9th, look at that first quarter. $1.07, I think they came out, I think 30% better on EPS than the street was looking for. Stock close at day at 147, it was 160 like this. Gave it all back for a myriad of different reasons. But I would submit for the first time in a while, especially at this price, I think you can make a case for Disney just on valuation alone for the first time in the last few years. Disney, the D in my dawn trade, as you know, and I'm going to stand by that. I think the second half of the year could be great for the stock.
Yeah. Dan, your take?
Yeah, I mean, the stock's in a really tough spot. If you look at the low in the pandemic in 2020 to its recent high last year, it's right at the midpoint from 80 to 200. It's back near 140 here, and it just doesn't seem like there's much of a direction. And I would just say this to your question to Jim about whether Iger comes back. Mel, I mean, if this guy Chapek makes a couple more moves that, let's make no mistake about it. This got to be Iger's board. He just left as the chairman here. Iger's coming back. He is a legendary CEO. He probably did 3 of the best deals in the history of media, and that's Lucas, Marvel, and Pixar. And that's the sort of mojo that you would put back in place before you'd go to a Staggs or a Kevin Mayer or something like that. So to me, Iger comes back, any more problems, but I think the stock's in a tough spot for a little bit.
I mean, Iger comes back and the stock goes up, what, Brian Kelly? But can the stock stay there? Because is it just a problem at the top? Or is it a real, deep problem in terms of the direction of Disney and how it's being run?
Yeah, well, if Iger comes back, then it's going to be run like it was before. I actually think the stock sets up pretty well here because all of this dirty laundry's out there. What is it? Sunlight is the best disinfectant. Pick your cliche, but this is all out there now, right? So any positive note, whether it's Chapek doing something different, Iger coming back, them picking somebody else, anything actually gets this stock higher, I think. So for a trade, and I would say for a trade only, you could probably buy it here against 130 as your stop.
Okay, Tim, the shareholder, who do you want to see as CEO?
I tell you what, all the points on Iger are accurate. I think Chapek, I want to see him still stay in that chair. That would signify way too much tumult at Disney. I recognize there may be a culture change. That happens all the time. They've also restructured the entire company. I mean, and they had to. So around their distribution platforms and versus their content. So let's give this one some time. I own the stock. I don't think it's expensive. It's not cheap.
All right, coming up, a tale of two banks, Wells Fargo and JP Morgan traveling 2 different paths over the past year. One of our traders is sounding a warning call on one of these names. You got the details next. Plus, the trade goes to 11. The XME metals and mining ETF surging to its highest level in more than a decade. We are digging into that when Fast Money returns.
Get your trades to go with the Fast Money Podcast. Catch us anytime, anywhere. Follow today on your favorite podcasting app. We're back right after this.
Welcome back to Fast Money. The heavy metal trade is, well, rocking. And take a look at the XME. The metals and mining ETF trading at levels not seen since August 2011. Shares of Century Aluminum, Uranium Energy Corp, and Alcoa leading the way. BK, you've been in the uranium space. You are out now?
Yeah, unfortunately, I sold most of my position last Friday, but I'll be looking to get back into uranium for a couple different reasons. I mean, number one, the reason why it was up today is Russia said they were likely going to not going to export any more uranium. But ultimately, the solution to all of Europe's energy problems and, frankly, all of the U.S. and the world's energy problems, if you want to go green, you can't go green without yellow. Yellow cake, that is. Uranium's the solution, and there's not a lot of it around. So I still like the uranium trade. I'll be buyer, and I'll pull back.
So what's the blue? Anyway, Tim, where are you on the trade?
CCJ, Cameco is one way to play. It's the pure U.S. way to play. We talked about this story on Friday. Been talking about it now for a month, really since Russia invaded Ukraine, because today, as Brian pointed out, was the day. Friday, we had Secretary Granholm point out that the U.S. needs to actually provide more aid and more supplies to U.S. enrichment. We heard from Russia today they are going to ban Russian uranium exports. So I think this story continues. Diversified miners, BHP, Rio Tinto. BHP is the one that didn't blow itself up back in 2008 and 9. I think is the best vertically integrated, multi-factor diversified mining company.
Alcoa went to 92, back down to 71, back to $90. I still think it's going to trade at levels we last saw in 07. We had the general on, I think, last week when U.S. Steel reported. Tim was on as well. We talked about earnings. I think collectively we said, you know what, don't get caught up in an earnings story. It's not about earnings. It's about your belief that they're going to continue to operate well in this environment where steel prices continue to go higher. Look at what U.S. Steel has done since, Melissa Lee.
Does it matter that energy prices have spiked so much when it comes to the miners as an input cost?
It's an input cost, but again, they're so levered to the underlying price of their commodity, and I don't think these are dropping. I think you've had some ag response. You will have some ag response, I think, with some of the metals and certainly the PGMs. I don't think you can see that type of a supply response, even though the best thing for higher commodity prices is
higher commodity prices. Mel, before we go, and I know we got to go to break, are you a fan of This Is Spinal Tap? And don't make the face at me. Are you a Nigel Tufnell person?
Sure.
Yeah, I know you were. By the way, folks, go to your local Blockbuster over this weekend and rent This Is Spinal Tap. You won't be disappointed.
Get your Betamax out.
Yeah, please.
Coming up, financial fork in the road. Shares of Wells Fargo and JP Morgan going in different directions this year. But do the charts tell the whole story? The bank trade is next. Plus, cloudy with a chance of options. Some software M&A action has traders betting on moves in another big player. We got the details when Fast Money returns. Welcome back to Fast Money. Call it a tale of two banks. Wells Fargo and JP Morgan heading in wildly different directions over the past year. Wells is up nearly 30%, while JP Morgan is down 10%. Dan, you pointed this out.
Yeah, I mean, Mel, one of the things that sticks out to me here is just that, Wells is up 7% on the year. It's down 15% from its recent high. JP Morgan acts very, very differently, in my opinion. It started going down precipitously after that Q4 report. I know investors were very disappointed about some of their expenses. But since then, since the war, I think the focus on their exposure internationally is one of the reasons that's weighing on this stock. They get 23 or 4% of their sales from overseas, whereas Wells Fargo gets none. And that might be one of the reasons for the relative outperformance year to date of Wells. But going back to that first discussion that we had about a yield curve inverting, about mortgage rates going higher, about rates going higher, Wells is very exposed to U.S. consumer here. So this one might look a little bit like a value trap on a price to book. It's trading about 1.1 versus, let's say, JP and Bank America near 1.4-ish or something like that. So to me, keep an eye on Wells Fargo. If it were to lose that relative outperformance, that might be telling you something about what's going on here in the U.S. as relates to the consumer and maybe expectations for the balance of the year.
So this is really one of our most favorite games that we play here on Fast Money, value trade or value trap, Brian Kelly. So how would you characterize Wells Fargo?
Oh, I would call that a value trap for sure. For all the things that Dan pointed out, I think it is benefiting from its relative insulation from the outside world, where JP Morgan, we know even just last week, it was revealed that they were the largest counterparty to the nickel trade that went bad. So that is going to be a headwind for JP Morgan stock, but that does not mean that Wells Fargo is in a better place. Like we said, when you look further out on the yield curve, it is flattening out. That's not a great environment for banks as well. If you look at some of the investment grade bonds, those yields are going up. Maybe there's some default risk being priced in there. I, again, think that is what makes it a trap rather than a trade or whatever the value thing that you said it was. Trap or trade, fade it, I don't know.
Speaking of nickel, they just canceled a bunch of trades. Again, a second round of trades got canceled on this exchange.
Extraordinary. And we've, it sets a horrible precedent, and we haven't seen this before. This is a major concern, and it looks like they can almost do whatever they want, which is not why you're at an exchange.
No, markets are broken. I mean, when something like that happens, I mean, that's a 147-year-old exchange, I believe. First time in the history something like that happened. And I won't play the game, but what I will say is in January of 2020, before everything cratered, JP Morgan was making an all-time high of about $138. Past resistance becomes support, and we are there now. So I actually think you could be long JP Morgan off a 20% sell-off at current levels.
All right, let's take another look at Nike here. Sarah Eisen's been listening to the calls, got the latest. Sarah.
Hi, Melissa. I can share with you the guidance, which should come as a relief for investors. That is, they're sticking with their numbers for 2022. They expect revenues to be up mid-single digits. They expect that the gross margins will expand at least 150 basis points. Both of those things they had said previously in the December quarter. The only thing a little bit different is SG&A growth, so their costs are going to grow in the mid-teens, and that was actually better than the mid to high teens, which is what they had before. So a lot of concern going in that they would have to change numbers given the increased shutdowns in China over COVID, the supply chain delays. They actually strike a tone of optimism, the Nike executives, that is, saying that those things are improving. They said all the Vietnam factories are back online, that inventory is beginning to improve, though transit times are a little bit longer. And as for the all-important China question, the CFO, Matt Friend, just now on the call said that they expect to see another quarter of sequential improvement in China. They do expect to see a decline in North America for this coming quarter, but that's because of tougher comparisons. And then next quarter is their last fiscal fourth quarter of the year. So they said, looking ahead to 2023, they remain optimistic that it's going to be another year of growth, but they're going to give a little more color on that in the next quarter. So overall, Melissa, I would say a much more confident projection. And the only other piece of news I'll add is that the business remains shut down in Russia and Ukraine. The CFO communicated that's less than 1% of total company revenue. And then if you've been watching Foot Locker stock lately, you've noticed the big declines. Nike did confirm in this call that they have cut 50% of their wholesale accounts just over the last few years or so, as they have really relooked at that business and focused on direct to consumer. They said that the communication, though, is finished with those big account pivots, and now they're going to look forward to collaborating a little bit more. So maybe some pain ease there at the Foot Lockers of the world who were worried about Nike cutting off these accounts. But that has happened on a large scale. I'll send it back to you.
Yeah, we see the reaction in the after-hour session. Sarah, thank you. Sarah Eisen. So basically, they're sticking by their numbers for the current quarter, Tim, but not setting any sort of bar for the next year, since their year ends in this current quarter.
And they just talked about, though, their fiscal Q4 coming. The comps are very difficult and that they're going to be down somewhat. Very much relief, as it sounds, in terms of inventories and supply in different geographies that are thawing, and the concerns that they have on China. I mean, these are all things that we knew. And again, China was down 5% last quarter. As it looks to this quarter, doesn't sound like they're terribly optimistic there either.
So is this just everything's fine?
I don't think everything's fine at all, but I think you got another 5 to 6%. BK, I think, would reiterate that as well. That 145 level will be resistance. Now, you could say inventory is up 15% year over year. That's a good thing against 5% sales growth year over year. Yeah, the flip side of that coin is if you have an inventory build and you don't have the demand on the back of it, you're going to hurt margins. So I think you can continue to own the stock for another $7-ish from current levels. But then I think in trading parlance, it's a French word, you sell the double.
You sell the
Yeah, you've learned that over the years. That's not really
Nobody
inside
talks
baseball.
like that anymore.
That's false. Patently false. I just said it, so by definition, that's false.
You say it, not people in general. Brian Kelly, what Sarah had mentioned about cutting off some of the distribution channel, that's really interesting. Karen Feinerman, the chairwoman, has been in that trade for a long time and had signaled, some concern about Foot Locker, and here we are. We're actually hearing it from Nike itself.
Yeah, exactly. That's just another headwind for any of these retailers out there. Yeah, but I actually found this Nike report, this Nike conference call to be relatively positive, I think. They're saying, listen, things aren't going to be as bad as everybody expected. And I think it feeds into that more broader equity narrative that, hey, listen, Fed's going to crush inflation in a very short period of time, which I think is false, but that's what the equity market thinks. And then everything's going to be okay because the consumer's still strong. That's basically what Nike just told you. So I think, I agree with Guy. You can own this for a little bit more. It's a trade. I think you'd be all right.
So, Dan, just a quick question. Is Nike a bellwether or is it an exception? How do we read this news?
No, I think that's a good point. I think it is a bellwether, and I think it always trades at a premium, and it will trade at a premium. And I just think that, it's down an awful lot. I think at its lows just recently was down maybe 26, 27% from its highs made last year. So the question is just whether you believe that Q4 is going to come in the way that they just guided. I suspect it's a disappointment. And then Q1 is also going to be kind of murky. So to me, I just probably think near term, get it up to 145, maybe take some profits and look for a lower entry.
Coming up, cloud options, a big deal in the software space with options traders eyeing another big name. We'll tell you how they're playing this one when Fast Money returns. Welcome back to Fast Money. Check out the huge move in Anaplan, the cloud stock in agreement to be bought by private equity firm Thoma Bravo. The deal sparking a flurry of options activity. Mike Coe is with us with the action. Mike.
Yeah, if you had known about Anaplan, what would you have wanted to do if you were trading options? The thing is, you expect the stock to rise, but then you expect it to cease to exist after the cash buyout. So basically, you want to buy near-dated calls and sell out-of-the-money long-dated calls, and that's exactly what we saw in Coupa Software, which traded more than 2.5 times its average daily options volume. The trade that caught my eye was a purchase of 1,000 of the April 115 calls. Those were trading for about $2.30. That same buyer then sold 1,000 of the January 2023 175 strike calls for $4.40 a contract. They were collecting premium, trying to take advantage of that dynamic, maybe making a similar bet to what we saw in Anaplan.
Thanks, Mike. Options Action full show Friday, 5:30 p.m. Eastern Time. Up next, final trade. Take a look at the final trades for this Monday evening. Thanks for watching Fast. See you back here tomorrow at 5 for more Fast. Meantime, Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends, just trying to make a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. The long knives, they're out for J-Pal. Hardly a day goes by without someone taking a shot at him for being too slow to stamp out inflation. I think it's ridiculous, especially because just today he said he's willing to raise interest rates even faster if the situation gets out of control. That sent the average into a tailspin, the Dow sinking 202 points, S&P dipping 0.04%. It was worse at one point, the Nasdaq losing 0.40%. I think Powell is doing what is necessary. You can't ask for more than that. So because the market's now hostage to Powell's decision-making, why don't I give you a snapshot of what he's really facing here, because it's not easy. You need to understand that this business cycle is like no other business cycle in years. Fortunately, he's not like any other Fed chief. He's better. First, there have been some monumental changes in how we live our lives, courtesy of COVID-19 that no one could have seen. Thousands upon thousands of companies went virtual. And while many have since gone back to normal, many others, including some of the largest ones, haven't. If you work in a business that can be conducted remotely, odds are you aren't coming back to the office that often. 3 days a week might be the most for many, especially workers with young children. These people cannot be cajoled into coming back in person. They'll just resign because there's plenty of jobs out there. So what does the Fed have to do? What does that have to do with the Fed? Simple. There are enough people in this country who can afford to buy a second home, outfit it nicely, and work from there for half the week. No wonder we have only a little more than a month's inventory of homes right now. That's a gigantic shortage, people. Historically, even 4 months would be considered tight. We know from Lennar's excellent conference call last week that rents have gotten out of control, perhaps from the same process, so there isn't enough supply there either. Even if Jay Powell had taken rates up to 6%, I don't think it would have mattered here because remote work has become such a game changer for housing and for rich people. So why doesn't Lennar just build more homes? Well, first, it's hard to get enough land together for a scaled operation. But more important, the land for the second home is often not available because of environmental or zoning regulations, and they can't be negotiated fast enough. Surely Powell should have seen that coming, right? I mean, it was so pronounced that people didn't want to come back to the office that any Fed Reserve factotum, let alone the chief, should have seen this coming. I disagree. Powell, like many people, never thought the pandemic would last this long. Just when we think we're out of the woods, we get another more contagious strain. You could say Powell should have had the data. I say, what data? The CDC director, Dr. Rochelle Walensky, was just on CBS this weekend. She revealed that they haven't been able to get good data from many states because they can't compel governors to release it. Have you ever noticed how much of our COVID data comes from Israel? That's because they have a national health system they're willing to share with us. Our information simply isn't good enough. So is it going to be enough for Jay Powell? Either way, Jay Powell's not an epidemiologist. I think he's a very smart guy. But we can't expect him to do a better job of responding to the pandemic than our own health authorities. This whole thing has been a public health debacle/nightmare from the very beginning. Mask, no mask. Testing, no testing. Lockdown, no lockdown. Handshake, no, it's aerosol spray. I mean, come on. As I see it, Powell's done an excellent job of coping with the pandemic. He saved us during the lockdown phase when the whole economy was collapsing. But at the end of the day, public health is outside of the Fed's purview. I mean, it's just not fair. You can't blame him. Of course, COVID keeps creating weird dynamics that the Fed needs to respond to. Right now, we're seeing tons of consumer spending, but a lot of that's pent-up demand. People want to see their families again. People want to get married. They want to take trips. They've been stuck isolating for too long. They wouldn't change it, even with higher interest rates. You think you can go out less with higher interest rates? Come on. Third big change that was hard to see coming, the state and local tax hit. Thanks to remote work, people are flooding into the Sun Belt, especially Arizona, Georgia, Florida, and Texas. Lennar says Houston's the hottest market. The last two are just incredible. I mean, California, Florida. I mean, they have far lower taxes. Florida and Texas. They have far lower taxes than California or anywhere in the Northeast, which matters now. Because remember, Trump's tax reform package got rid of the state and local deduction for your federal income tax. Maybe this is something Powell should have seen coming. But this mass migration has shocked the home builders. So why wouldn't it shock him, too? I mean, it was just so hard to figure. Next, if you're going to a new country house or if you fear getting COVID from riding in public transit, well, guess what? You got to have an additional car. Now, new cars are filled with semiconductors. The automakers had come up with forecasts based on nothing special happening this year, let alone a pandemic that would upend how we live and make cars more essential. So why not just make more semiconductors? Why not have more semiconductors on hand? Well, because we're not like that. We do just-in-time inventory. And because the kinds of chips the automakers need are the lowest end variety that typically carry the lowest margins. The semiconductor manufacturers rather use their capacity to make high-end chips for the data center. That's where the money is. So now we got a car shortage based on semiconductors. Should Powell seen that coming? What is he, like some semi-analyst? I mean, are you kidding me? If the heads of the major semi companies, the major foundries, and the major automakers didn't see this chip shortage coming, what do you think? Like Jay Powell just says, oh, I know this business. I know the way it works. It's going to be a shortage? No. Of course, it's not just the semis that are in short supply. The housing boom caught all suppliers empty-handed, from cabinet makers to appliance builders, garage openers, and lumberjacks. So everybody had to pay up, and inflation became ingrained in the housing cycle. Food started going up in price, too, as the patterns of where food went were upended by where people suddenly started shopping. If there was a lockdown, then you got your food from essential service stores that then had to pay up to get everything they needed. Our food distribution system was not set up to move food to new places, which meant a shortage of drivers to get things to where they had to go. It was a total mismatch and mismatch. Finally, when we were worried about food and energy inflation, there's no worse place to have a war than Russia, the gas station of Europe, invading Ukraine, the breadbasket of Europe. Obviously, the real tragedy of this war is the horrendous loss of life, and it's tough to think about. But if Ukraine can't harvest or export its wheat, we're looking at a global food shortage. And of course, if the West won't buy Russian oil and gas, that gives you a global energy shortage. I could have had a half dozen other sources of inflation, but at the end of the day, Jay Powell's been dealt an insanely bad hand. So of course he's fallen behind. Hence why he said the Fed will move with alacrity from here on out. So feel free to blame him for not seeing what was coming. If he has to do 50 basis points, he will. But the bottom line, never forget that Powell's been asked to do the impossible here. Figure out how fast to raise interest rates when so many things should be slowing the economy and cooling inflation naturally, yet nothing has worked out the way we expected or the textbook said it would. Just a crazy moment where he has to contend with a ton of forces that are beyond the Fed's control and do it in a way that no one is good enough to navigate, least of all the armchair chiefs who would wilt under his agenda. Herbert in Florida. Herbert.
Dr. Kramer, Mr. Dooley, I got these questions, AGTC and Intel.
Which one? I can answer the Intel. What was the first one?
AGTC.
AGTC. We're not following those little dollar stocks. But I will tell you that I think that Intel is still not a stock that you want to own. There's too many others that are doing far better. Intel has to cut a lot of price in order to be able to get the customers it needs, and that's not so good. Eddie in Indiana. Eddie.
Hey, Jim, how you doing?
I am doing well. How about you?
I'm fantastic, Jim. Thanks for taking my call. Hey, Jim, you had recommended a stock in January, Devon Energy and also Walt Disney. Devon is up pretty good. I don't know. I wonder, should I trim a little bit? And Walt Disney, the time to cut and run and go long.
Well, look, Devon was a great one for the investing club, just terrific. Disney is a longer-term play. I simply do not believe that Disney's franchise is at all hurt by what's going on, if anything's going on at all. I think Disney's a strong buy right here. Let's go to Wayne in California, please. Wayne.
Mr. Kramer.
Yes, Wayne.
I thank you for taking my call. I have followed you for years. I read your books.
Thank you.
I just want to thank you for your willingness to share your wisdom with little guys like me.
Oh, thank you. Thank you, and to all the kind mentioners, too, today, who are really terrific on Twitter. A lot of them mentioned my mom. So go ahead.
Okay, so here's my situation. I have a position in GM, and I got into it the way you recommend. I didn't go in all at once. I've tiptoed in over time. So some of the shares are underwater. Some of them are slightly up right now. I do see General Motors as a long-term winner in the EV space, and I just wanted your opinion about, whether GM's current stock problems are temporary and it's safe for me to continue tiptoeing into the shares, or if there's something more fundamental underlying the downturn, and maybe I
think it's temporary, sir. Thank you for giving me the opportunity to talk about this, because first of all, I think it's a self-driving unit that they're way ahead on. They're going to make real hay. I don't know if you saw that deal this week for Cruise, where they got out of the SoftBank, they bought SoftBank stock. Now they have 80%. I like their EV strategy. I think it's just terrific. I think Mary Barr is doing a great job. It's one of the stocks when people say, oh, this market's so expensive. I say, how about the stock of General Motors? All right, now Powell has been asked to do the complete impossible. I think we should just sheathe the long knives already. Let him work. He's contending with forces far beyond control, but he's going to contend well. Well, Mad Money tonight. Today's action made last week's rally look extra enticing. So I'm digging into last week's moves and see what it could mean going forward. Then, how did Kroger get its groove back? I'm taking a close look at the supermarket chain. And as I discussed, Jay Powell's a tough job in front of him. But how could Powell's moves impact a really good financial like Stifel? I'm talking to the company CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
With the market pulling back again, this is the perfect time, perfect moment to look back on last week's incredible run. Now, keep in mind the S&P 500 has only had 4 up weeks this whole year, and last week's 6.16% run was the best performance of the benchmark index since November of 2020, when we first started hearing that the COVID vaccines were ready. Quite a feat. But before we get too carried away, you need to understand that we're just not out of the woods yet. We consulted with multiple chartists and technicians last week, and some of the smartest were adamant that this market has yet to put in a true bottom. Rather than a sea change, something that would make it so that the market's a different coloration, you need to think of last week's miraculous run as giving you an opportunity to reposition your portfolio. These levels are a chance to sell the most beaten down stocks of the past few months and pivot into the kinds of names that can thrive in a rising interest rate environment, because boy, are we ever going to have one. However, that doesn't mean we can just dismiss this move as a temporary counter-trend rally with no staying power. The fact is, you almost never see the S&P 500 vaulting 6% in a single week, and this action can teach us a great deal about the current moment. And look, it's not just the S&P. All of the major averages were up more than 5%. The beaten down NASDAQ surging 8% is really quite a feat. So first of all, how did it happen? Let's talk about the ingredients that make this kind of rally possible, because it is so rare. First, you need the market to be down so hard that it becomes a coiled spring. Ever since Russia invaded Ukraine nearly a month ago, the averages have gone into a tailspin. That's on top of the earlier Fed-mandated decline that started in November, when Fed Chief Jay Powell decided it was time to start cracking down on rampant inflation by hitting the brakes on the economy. That November was really, if you take a look, that was the peak of much. And the week before last was particularly ugly, the second worst week of 2022, at least so far. That pain continued last Monday, but then on Tuesday, all of the major averages turned around Tuesday, and they kept running through the end of the week, with the tech-heavy NASDAQ leading the way. Why? Because we got a host of meaningful positives at a time when Wall Street was full of doom and gloom. When Russia invaded Ukraine, everybody figured the Ukrainian army would collapse like a wet paper bag. But by last week, we realized the opposite. It's more like Russia is a paper tiger, albeit a paper tiger with nukes. The stalling of the Russian advance and President Zelensky's magnificent performance created a renewed sense of optimism. At the same time, the price of oil pulled back from its highs substantially, which is always a positive because oil is a gigantic tax on the system. Of course, crude rebounded hard today. West Texas up 7%, and that's a major reason why the averages are getting hit again. Perhaps most important, last Wednesday, we had the big bad event that everyone on Wall Street was worrying about, the Fed meeting. But Fed Chief Jay Powell did exactly what we wanted. He explained how you get tough on inflation, preparing us for a series of additional rate hikes, while staying measured and assuring us that if inflation moderates, he won't keep tightening for no reason. Remember, we need to kill inflation now. Persistent price increases are bad for business and bad for you. So Powell's giving us what we need. And he was even more aggressive in his comments today. Throw in an incredibly oversold market, and you had all the necessary ingredients for a fabulous rally that was, some people call it a relief rally. Some people say it was the real deal. So what specifically led the way higher last week? Now, this is really interesting to see the makeup. When you look at the biggest winners, they were some of the most beaten down stocks in the market. Chinese stocks, Cathie Wood's ARK Innovation Fund, recent IPOs and SPAC stocks, even the cloud names. Even the pot stocks caught fire in the end. In short, some of the riskiest stocks of the moment had a terrific time last week. Most of these groups did not have a specific catalyst. They just fallen too far too fast. They were due for a bounce. But the Chinese stocks had an actual reason to run. Last year, the People's Republic of China practically declared war on free market capitalism. If you listened to their government, it sounded like they were finally rediscovering their Maoist roots. Turns out that this kind of thing is terrible for your economy. Who could have guessed? So last week, the Chinese government made some reassuring moves to keep their stock market stable and mollify big business. Now, I have zero faith in the Chinese Communist Party. I am recommending avoiding anything that's listed out there. I want the strength used to be able to sell. But obviously, it's good news when the second largest country in the world says it's willing to be less anti-business. All right, how about the IPOs and the SPAC names and the cloud names? Some of their strength is simply because they'd fallen farthest from their highs. So anytime the broader market makes a comeback, they'll bounce the hardest. At the same time, these former high flyers went out of style because of Wall Street's terrified of inflation. They trade entirely on their earnings prospects in the far future. And inflation erodes the value of those future dollars. That's something you have to take from me. I know it's Act 10, but you just got to trust me. So the Fed cracking down on inflation with last week's rate hike is good news for these unprofitable growth stories. Plus, the IPO door has been just completely shut. Always a good thing, because it means nobody needs to sell something to buy something new. You know the pain in the money-losing software stocks might be coming to an end when something like an Anaplan, a cloud-based financial planning platform, catches a takeover bid from a private equity firm of some note, like it did this weekend. Private equity guys are opportunistic. They don't like to pay up. They also don't have to worry about justice investigations. The FTC doesn't mind. The possibility of more leveraged buyouts can put a floor under many of these names. Now, let's go sector by sector. We ran a screen on the Russell 3000, the 3,000 largest stocks that trade in the United States. Then we cut anything smaller than $2 billion and sorted the remainder by industry group. Biggest winners? You had some huge gains in internet and direct marketing and retail. Think DoorDash, which had a tremendous quarter. Etsy, great quarter. Revolve Group, tremendous quarter. eBay, better than expected. Amazon, terrific quarter. Overstock, okay. You had a fabulous run in the airlines, along with life science tools, information technology services, the department stores, the auto industry, especially electric vehicles like Rivian, Tesla, Fisker. At the same time, we saw an explosive move in the semiconductor group, with Global Foundries, that's the companies that make the semis, up 31%, and NVIDIA up nearly 20%. Tomorrow, big keynote by Jensen Huang. He's the CEO of NVIDIA. Same goes for the credit card stocks, social media, and all sorts of software names. So what do we make of this move? The most important lesson of last week is that you never want to get too negative, because once the market gets oversold, it doesn't take much good news to create an explosive rebound. And yet I know so many people who sold the day before this rally happened. Second, when the whole market roars, you need to recognize that not everything has the same kind of staying power. Many downtrading groups make a comeback thanks in part to short covering. But those are the stocks you need to sell into strength. Think the Chinese names, the ARC innovation names, and the super expensive money-losing stocks that simply don't work in this environment. But some other groups look a lot more durable. Witness the strength of consumer discretionary stocks, which should work just fine in a rising interest rate environment, as long as we don't have a full-blown recession. What do I like? I like Macy's here, 6 times earnings. And I think the travel place can continue to do well, Delta, but in particular, American Express. But the bottom line, while the last week gave you a tremendous opportunity to reposition, it has not changed my fundamental thesis. We have a narrower universe of potential winners here, so stick to profitable companies with real products or real services, especially ones that return capital to their shareholders, and will make this through this whole period together. Stick with Cramer.
Coming up, how did Kroger get its groove back? Rush down the aisles with Cramer for a supermarket sweep. Next.
always searching the new high list for potential winners. Although lately the list has gotten a little more limited. I mean, you got some energy names, some material plays, some ag stocks, and some healthcare winners. Pretty much what you'd expect at this point in the business cycle. But earlier this month, there was a surprise entry on the new high list that came out of nowhere. And now that it's pulled back from these levels, we got to take a closer look. I'm talking about Kroger, the largest pure-play supermarket chain in the entire country. You got to understand, the grocery business is plagued by razor-thin margins, even when times are good. Right now, we've got the worst inflation we've seen in decades. You'd think that would be bad news for Kroger and its compadres, but this stock shot to $62 and change earlier this month, a new all-time high. Since then, it's pulled back about 11% to the mid-50s, yet it's still up nearly 25% year-to-date and close to 60% over the last 12 months. That is impressive. But more than that, it's shocking. Before the pandemic, Kroger spent years in the penalty box, in part because of heightened competition in the supermarket space. They naturally got a boost when COVID first hit and we went into lockdown, forcing millions of people to cook at home. That was 2 years ago, though. And most of the other pandemic winners, well, they've rolled over, as you know. But Kroger spent the last couple of years steadily churning higher before exploding to new highs after its most recent quarter. So how the heck can a supermarket chain be doing this well? Well, let's not forget, Kroger's been doing well for a while now. They put up excellent numbers in 2020 and 2021, but even with that track record in mind, the most recent quarter was a true standout. On March 3rd, the supermarket kingpin delivered a blowout set of numbers. Same-store sales, excluding fuel, were up 4%. Wall Street was only looking for 2.1%. Digital sales more than doubled from the same period 2 years ago. Their gross margin, what they keep after the cost of goods sold, came in at 22.2%. Analysts only expecting 22%. Remember, we're in the middle of an inflationary spiral that's crushed earnings for all sorts of companies across a host of industries. Yet Kroger's margins are doing just fine. I thought they were going to get slammed. But that's how they posted a 17-cent earnings beat off a 74-cent basis. That's extraordinary. Even better, Kroger gave us an extremely bullish full-year forecast for 2022, talking about how low to mid-single-digit earnings growth, which may not sound like much, but that's very impressive in the grocery business. The analysts were expecting a decline. Well, in response, the stock jumped over 20% over the next couple of days, something like what I expect could happen with Nike after that great quarter tonight. Although a lot of the strength was caused by panic short sellers closing out their position in a Kroger short gone wrong. Once the shorts finished covering, the stock came back down, which is why it's now back in the mid-50s. The question here is, how did Kroger manage to put up such excellent numbers? A supermarket in the midst of tremendous inflation? I mean, tremendous. Well, first, let's talk about margins, because that's the key. Remember, Kroger's not just any grocer. They're the largest pure-play grocery chain in the country. 2,726 stores across 35 states and Washington, D.C. In other words, they've got tremendous scale, and that gives them clout. The ability to lean on their suppliers and keep their cost of goods sold as low as possible, lower than almost anybody. At the same time, they've got a really good private label business. I know, I love the stuff. They knock off store brand stuff that they make themselves. It's got a really good brand. Kroger gets 20% of its sales from private label, and that's all much more profitable than selling somebody else's nationally branded merchandise. They've also gotten creative about drawing in traffic. For example, they now give their customers fuel rewards, which is pretty enticing in a time when high gasoline prices are sky high. That's a good idea. Of course, when we're talking about controlling costs, not all of this is benign. Last month, the New York Times ran a piece headline, and I quote, "Business booms at Kroger, but workers are left behind," end quote, about how many of their workers are homeless or relying on government assistance because they're so poorly paid. That's extremely suboptimal. But Wall Street doesn't care how the sausage gets made, does it? It's just like a dollar-filled sausage. We endorse capitalism with a human face, but it's an unhappy face for some. Wall Street's not noticing. Is it forgiven? It's not my job. Second reason that Kroger keeps winning? Well, this is not your father's supermarket chain. As CEO Rodney McMullen explained when he spoke to Sarah Eisen on Closing Bell a couple of weeks ago, Kroger has built a powerful omni-channel business. They've got digital. They've got fulfillment centers all over the place. Listen to this.
We're so focused on the customer and so focused on what's going to be right for the customer in 5 years. And that's including our seamless system where people can go into a store shop, they can shop online, they can do pickup, they can do delivery, and all those things together is connecting with the customer, and that traffic is driving our alternative profit business, which has higher margins than the traditional supermarket business.
and it also gives us the capacity to make sure that customers, we minimize the amount of inflation we have to pass through too.
In short, the digital business, then the whole build out, they've given Kroger a higher margin channel to sell things directly to the customer, allowing them to hold down their own costs. Their omni-channel is now competitive with almost anyone else in the industry, including Walmart, something that I don't think Wall Street really understood until we saw that last quarter. Third, Kroger's also got some huge partnerships. They now have over 1,100 Starbucks locations within the stores. They have a deal with Bed Bath & Beyond to expand their assortment, including Bye Bye Baby products. I think that's a great division. They partnered with DoorDash for sushi delivery. So beyond building out their omni-channel apparatus, Kroger's also used these outside partnerships to fill the gaps in their business and help attract customers. It makes going to the supermarket a lot more enticing. They've also localized the supermarket, something I like. It is an amazing story, but can it continue? Especially as people now feel more comfortable about going out to eat? Well, let me put it this way. Right now, Kroger stock sells for just under 15 times this year's earnings estimates. That's a touch expensive for a grocer, but it's a heck of a lot cheaper than the average stock in the S&P 500, which trades at just under 20 times earnings and isn't doing as well as Kroger. Plus, it's worth noting that Wall Street's consensus earnings estimates for 2022 at the low end of Kroger's guidance. And it's not like these guys have a habit of overpromising. I think Kroger still isn't getting the respect it deserves from the analyst community. That's a good thing for you, because it means this company is perfectly poised to keep beating the earnings estimates like they've done for the last 9 straight quarters. No wonder Warren Buffett's a gigantic shareholder, third largest after the giant index funds. The best things about Kroger, though, is that it passes the marathon man test. Think Sir Laurence Olivier asking, is it safe? While interrogating you with some terrifying dental equipment, Kroger is as safe as it gets. At this point in the business cycle, with Fed beginning to tighten, we'd normally circle the wagons around recession-resistant stocks like the supermarkets. However, this time we've got the worst inflation in decades, which is bad news for the whole industry, except Kroger, which we know is coping just fine with inflation and even has expanding gross margins. Here's the bottom line. We know Kroger's safe because they're doing great right now. And if the Fed tightens too aggressively, causing an actual recession, this stock will only get more attractive because it's exactly what money managers like to own when they're worried about a real slowdown. Jim in North Carolina. Jim.
Yeah, Jimmy Chill.
Yo, yo.
Yeah, this is Jimmy Iceman in North Carolina. Was calling about CMG Chipotle. I love it, love the food. I bought it, and I did dollar cost average, then I did dollar cost average again, using mad money and real money. Next thing you know, I'm in a washout, so now I'm hurting a little bit. And this is real money, cash money. This is not no monopoly money.
I totally understand that, Jim, and I am sensitive to that, but I will tell you that I've liked this stock since 300. I like it at 1,500, and I will like it at 2,000, okay? That is where I think it's going. I'd like it at 2,000. So, yes, short term, little pain. Longer term, I'm predicting really great things. Dennis in Maryland. Dennis.
How are you? Jim?
Yeah.
I've been a loyal fan for decades. Thank you. You have said to invest in companies that make profits can pass on inflation.
Right.
Last summer, you said you liked this company at $36. Now its earnings are growing and should exceed $4.20. As its sales grow directly with inflation and its distribution to the majority of the 1,000 to 2,000 Amazon Fresh stores coming to America. Is UNFI, United Foods, an even better buy today at 42, given its likely 20% plus earnings growth rate?
Dennis has got horse sense. He realizes the earnings going up and the multiples are shrinking. That's wrong. This is a company that could do very well in inflation. UNFI is a buy. Thank you very much for the kind words. And again, on Chipotle, I am a believer. All right, Kroger is doing great right now. It's much better than I thought. And if the Fed tightens too aggressively, it's only going to get more attractive. I'm trying to give you ideas for what's ahead. Now, money managers like to own stocks like Kroger when they're worried about a slowdown. Oh, wow, much more mad money ahead, including my exclusive with Stifel. The financials caught a very nice break last week. But with some new uncertainty in the market, what should you make of the sector? How about this one? Small, lucrative growth. I'm getting the read on the space with the CEO. Then what's our country's plan for energy? Well, I'll reveal what I think needs to get done. And order calls rapid fire tonight's edition of the Lightning Round. So stay with Kramer. sometimes the best stories in a given industry, they're just hidden in plain sight. It's kind of like Poe's purloined letter. Take Stifel Financial, the St. Louis, Missouri-based investment bank whose research I read every day. This has been one of the best performers of the last 25 years. Ever since CEO Ron Kruszewski took over in 1997, the stock goes up, get this, roughly 4,000%, trouncing the performance of the big national investment banks. When you look under the hood here, the numbers continue to hold up. Stifel's posted 5 straight years of record earnings. It's got a rapidly growing lending business, too, with 46% loan growth last year, meaning it's poised to benefit from the Fed's rate hikes. We had to hear about that. Oh, and the company just doubled its dividend, one of my favorite signs of strength. While the stock has been range-bound for the last 12 months, could it resume its long march higher? Let's check in with Ron Kruszewski. Now, Ron is the chairman and CEO of Stifel Financial, and I think that he's also a very exciting guest because he's got a better handle of what's going on with rate hikes than anybody. Mr. Kruszewski, welcome to Mad Money.
Oh, glad to be here, Jim. Hope all's well.
Oh, Ron, it's great. You know, and I just think your research is so stupendous. That's why I'm so glad you're on the show. In your conference call, the last conference call, you were talking about 3 rate hikes and how good that would be. I mean, today we got the kind of a blueprint for as many rate hikes as the Fed chief wants. So to me, this is a good day for Stifel in terms of the net interest margin.
There's no question. I mean, we've already projected with 3 rate increases, Jim, our net interest income would be up 50%. That's $250 million. And that, you know, I think the most dovish dot plot today is for 6 rate hikes. So rising rates is good for Stifel.
Now, I have to tell you, sometimes I feel terrible that I don't know the situation myself. The growth that you have is far greater than I'm looking, say, for instance, wealth management, you're number 7. You're far greater in growth than all the others on the list. How are you doing that?
Well, we're gaining market share for one, and we're growing across all businesses. You know, Jim, we're a very diversified firm. We have wealth management, we have a bank, we have institutional equity, fixed income. We got the largest public finance department in the country in terms of number of transactions. And we're growing in Canada, the UK, Europe, Asia, and Israel, all over the place. So I just feel that we are taking advantage of what happened to the financial services industry after 2008. We're filling that void.
You spend a lot of time talking about recruiting. Now, when I speak to the big investment banks in New York, all they talk about is resignation. You are getting the right people. How are you doing that?
Yeah, it's a word that's overused, but it is culture and it's entrepreneurial, spirit. Our bankers, when they do well, we pay them well, and we give them a lot of tools to compete. So when we look at almost every market, we're looking to add people. And the good thing, Jim, is, what's amazing to me is I don't really need headhunters. People are calling me, and that's good.
Now, why is that? I mean, I know it's a great brand myself, but is that because they're just people recognize that if you go to Stifel, you can have a pretty good living?
I think if people realize no matter what business you're in, if you come to Stifel, you will share in the firm's success. And it's an incentive-based system, and people that are productive and entrepreneurial want to be recognized, and here they get recognized. So people are coming here.
Do you think people realize, I mean, in general, 4th largest provider of U.S. equity research, 4th largest U.S. investment bank by U.S. equity trading volume? I mean, these are spectacular figures. And yet, when you're on my show, I feel like I have to tell everybody because I'm afraid they don't know you.
Well, the street's kind of funny that way. It has a long memory, so it remembers that when I joined Stifel, our revenues were $100 million, Jim. Our market cap was $40 million. Today, $5 billion in revenues, market cap, has been $8 billion or so, and so that growth is hard to understand for a lot of people. They don't see it, and that's why I'm glad to be on your show because I want to share our story here.
Well, you're right too. I mean, for instance, we happen to be big fans of a fellow by the name of Brian Jordan. Okay, now he is the CEO of First Horizon. Why did we put him on? We thought chronically undervalued, every quarter, chronically undervalued. And then one day we wake up, he gets a takeover bid. Why? Because it was chronically undervalued. I look at what you're doing at Stifel and I say to myself, why aren't you a $100 billion outfit? You are up there with the other guys. And you should talk about your banking franchise, about your banking research, because it's by far the best there is.
Well, I really appreciate that. We built this firm on the institutional side around our research, and I believe that our research is second to none, both in the U.S. and in Europe. And, you know, I hear you. The one thing is that I know Brian Jordan. He's a great guy, built a great bank, and he got a great price. We got a ways to run here at Stifel. We're going to continue to gain market share. I'll tell you that.
Okay, so Ron, I'm a little worried. 2021, great year for IPOs. This year, it looks a little tougher. What the year-over-year comparisons, do we have to worry?
Well, for the first quarter, look, anyone can look at the deals and see that equity issuance, Jim, almost any way you want to look at it, equity issuance is down 75 to 80% in the first quarter. But I'll tell you why you look by that, and that is that what's going on in the world today, you have renewed inflation, you have what happened in the pandemic, you have the digitization of the world. And what that means is that people that provide thought and provide ideas and help companies move capital around are going to be busy. And that firm like that is Stifel. So when I look forward, our advisory backlog has never been greater. And the slowdown in the first quarter to me is merely just a little bit of a breather. It's been volatile, and you know that.
Right. Well, look, I've got to tell you, I'm so glad you came on. I wanted to tell your story. This is the best way to do it, is with you. Ron Kruszewski, this bank is doing so much better than so many others in this group. The symbol is SF. Ron, thank you so much for coming on Mad Money.
Jim, my pleasure.
This is a hidden gem, guys. It shouldn't be hidden. It's right in front of you. It's like the per one letter. Mad Money's back after the break.
Coming up next.
Let's make money together. What do we got?
Kramer's bringing the thunder and answering your burning questions in today's edition of The Lightning Round.
want to see this off. Play this out. And then the lightning round is over. Are you ready? Keep that down. The lightning round. Let's start with Terry in Florida. Terry.
Hey, Jim. Booyah to you.
Booyah.
And I just want you to know that Happy and Bacillia still think you're the most dynamic, attractive person on television. I'm a veteran caller, and I'd just like to know what you think of PPG.
Well, I got to get my wife to watch the show. Okay, I think PPG is down too much. I think it's okay. They're not, look, I have to tell you, this is a company that's been really hurt by roll costs. That's going to end eventually. I think it can handle disappointment at this point. I would buy the stock. Let's go to Jack in California. Jack.
Hey, Jim, big fan. What is your thoughts on ticker symbol APPF?
Really very interesting. You got a software portfolio that is meant for housing, and I think it's much needed. And it reminds me very much of Anaplan, which got a bid today from Thoma Bravo. Let's go to Ralph in New Jersey. Ralph.
Hi, Jim. In terms of diversification, does it make sense for an older investor to have BRK as more than a third of a portfolio, almost as a proxy for a growth fund?
What's the stock?
BRK, Berkeley.
Oh, yeah. Look, I think that's a lot for any one particular company, but I do love the company so much. Let's cut it to 20% so that we can sleep better at night. Let's go to Scott in Wisconsin. Scott.
Hello, Jim.
Hey, Scott.
What are your thoughts on SBLK, and is the dividend too high?
I think the dividend's too high, but for what's going on right now in Ukraine, I think it's actually going to be good for the next year. I don't like to recommend those stocks. They've been such heartbreakers, but that one I think is going to work right now. Michael in Georgia. Michael.
Yes, sir.
Let's go.
Energy, ticker EGY.
Another one.
Three quarters in a row.
This is... Yes, it will work. It will work because oil is so high, even though I don't like their business model. Let's go to Ken in New Jersey. Ken.
Booyah, Jim. Ken from Union, New Jersey.
Oh, right near me. What's up?
Yes, sir. I'm also an investment club member. Thank you very much.
Thank you. And don't miss the morning meeting at 20 after 10. Jeff Marks and I have a great day. I want everyone to join the club. It's crazy not to. Let's go to work.
Thank you. I'd like to know your thoughts on Plains All-American Pipeline, PAA.
Okay, typically I would not be a fan because they did have issues, but I've got to tell you, the pipeline companies, they're in strong demand. I think that I have to tell you, as much as I like Plains, I like EPD more, but I will back Plains. I will back it. Absolutely. Let's go to Marla in Tennessee. Marla.
Hey, greetings from Rocky Top, Jim.
How are you?
Oh, I'm kind of busted with the balls going out of the basketball bracket, but that's okay. We got the ladies coming on strong.
All right. That's good. I've got Zags. Go ahead.
Listen, looking for Truist Financial.
I like Truist. You know, it's funny. I was in Florida recently. There's a Truist in almost every quarter. They're in the right place where wealth is. They're very smart run bank. I think it's a good place to be. I like Truist. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by TD Ameritrade. Plenty of players have parts to perform to put this energy crisis out to pasture. Why oil starts but needs not end with Putin. Kramer puts it all in perspective. Next.
Kramer, you are super. You are awesome.
I'm a first-time investor.
Thank you for inspiring me to get in the game.
Your show is the best. I am so glad you're on TV.
I want you to know that you have transformed me. Thank you, Kramer.